Tap Dancing to Work. Warren Buffett on Practically Everything, 1966 to 2012. A Fortune magazine book by Carol Loomis. Narrated by Susan Boyce and Barry Press. Preface. Because I have long been the chief writer about Warren Buffett at Fortune, which for decades has covered him more closely than any other business publication, I have often been asked whether I am going to branch out and write a Buffett biography. I have always said no, sure beyond a doubt that a writer who is a good friend of the subject does not make a good biographer. And I have indeed been a close friend of Warren's for more than 40 years, a shareholder in his company Berkshire Hathaway for almost that long, and the pro bono editor of his annual letter to shareholders for 35. All of those facts can be accommodated in my Fortune articles about Buffett, simply by my informing the reader that they exist. But they are not a firm base for a wide-ranging personal and professional biography, in which there should be considerable distance between writer and subject. Its absence in this case settled the question. But then it dawned on me that the scores of Buffett articles we have published in Fortune are in themselves a business biography, and a perfect one for a book. Here you have it. Tap Dancing to Work, the description that Buffett has long applied to his love for running Berkshire. This book is a collection, arranged chronologically for the most part, of all our big articles about Warren, plus some shorter, lighter ones like Are Jimmy and Warren Buffett Related? For each of the big stories I've written an introduction or commentary, about 40 of them in total. These paragraphs explain, for example, what's particularly important about the story, what Warren forecasts that did or didn't come true, what he thinks today about the story's main point. Overall, the book's material covers a large chunk of history, 46 years, an important span of time, not only for Buffett, but for the U.S. economy in which he has so successfully operated. 46 years, Buffett would be inclined to say. That's a long time. Almost 1/5 of the years the U.S. has existed. The articles and excerpts in this book were for the most part written by me and about 40 other Fortune journalists, including 3, John Huey, Rick Kirkland, and Andy Serwer, who rose to managing editor, with John subsequently moving still higher to the post of Time Inc.'s editor-in-chief. But the authors also include Buffett himself, who wrote 2 important stories expressly for us and inserted think piece sections into his annual letters that we lifted out and made into stories. Also represented is that well-known business writer, Bill Gates. In content as well as authors, this book is enormously diverse. We had the good sense along the way not to repeat ourselves too much, and when we did, I normally edited out the repetition. Actually, not repeating ourselves was pretty easy, because Warren kept doing new things. When you finish this book, you will have seen the arc of Warren's business life. The first story in which we ever mentioned him was in 1966. He got 1 sentence then an investing piece that I wrote about another man, Alfred Winslow Jones, and in which I misspelled Buffett, giving it only 1 T. I will try, however weakly, to pardon myself for that by saying that outside Omaha, where a few investors knew Warren well because he was making them rich, he was in 1966 pretty much unknown. Jump to the early 1980s, and he hadn't gained much ground. When Fortune hired freelancer Andrew Tobias in 1983 to write a piece about Buffett's shareholder letters, Tobias had never heard of this fellow. That means, alas, that Tobias had missed the big story about inflation that Warren wrote for us in 1977, and about which he still gets mail. The middle part of the book, starting with my 1988 profile, The Inside Story of Warren Buffett, describes his adding a second profession, business management, to his old one of investor. And next, of course, he made Berkshire Hathaway a huge force in corporate America. Few people recognize the insignificance from which that company has come. In 1965, when Warren took it over, Berkshire was a New England textile manufacturer, far too small to have made the Fortune 500 list. For 2011, in contrast, it was number 7 on the 500. That rank is for revenues, which is the 500's primary criterion. In market value, a higher accomplishment in Buffett's thinking, Berkshire was number 9. And all that has happened in one man's lifetime, which of course is not over. The final years covered by the book complete the arc, so to speak, by taking Warren beyond investing and business to philanthropy. This step did not require him to invent a philosophy. He has never believed in large inheritances, and almost all of his money has always been slated to go to philanthropy. But he had always assumed that his wife, Susie, 2 years younger, would outlive him and be the one who gave away his money. Susie then died of a stroke in 2004, and the philanthropy yoke settled back, none too lightly, on Warren. Thus came his announcement in 2006 that he would start to give away his money immediately. In his 2010 move with Bill and Melinda Gates to create the Giving Pledge, Fortune broke the news in each instance, in cover stories that appear toward the end of this book. You can take the man out of investing, but you cannot take investing out of this man, for sure. The final story in this book, adapted from Warren's letter in the 2011 annual report, explains the 3 types of investments and the one he prefers. There won't be any great surprise in his choice, but a new dose of Buffett investment advice as you finish the book can't be all bad. For me, compiling this book has been a trek through my own career at Fortune, 1954 to still happening, and through endless warnings as well to put 2 T's on Buffett. More significantly, it has been an extended and rewarding reminder of Buffett's investment and business genius, creativeness, and, not the least of these, consistency of thought. A friend of well-known writer William Buckley made a statement about him that I will adapt here. Fortune and I were lucky to be standing alongside Warren Buffett as he was becoming Warren Buffett. The Joneses Nobody Keeps Up With, April 1966, by Carol Loomis. It may be odd to start a book about one man, Warren Buffett, with an article about another, Alfred Winslow Jones. But this 1966 piece about Jones deserves the lead-off position. To begin with, this is the first time that Fortune mentioned the name Buffett, except that we embarrassingly spelled it Buffett with only 1 T. I made that mistake. Yours truly, Carol Loomis, the editor of this book and the author of many of the articles in it, including this one. Later, my husband, John Loomis, then an institutional securities salesman, met Buffett, who shortly after called me up to kid me a bit about the misspelling. Further on, he and his wife Susie asked John and me to have lunch in New York. And they and we began a friendship that in time, you might say, led to this book. A second point about the article is that it rather famously introduced A.W. Jones and his concept of a hedged fund to the world. Not that Jones was the first Wall Streeter to establish such a fund. Benjamin Graham, for one, had earlier run a partnership that used hedging strategies. But Jones's skyrocketing success was a revelation to most Fortune readers, and this article took on a life of its own, becoming an unofficial prospectus for many people who hastened to start Jones-type funds of their own. Histories of the hedge fund industry almost always refer to this article as a milestone in that world's development. Close readers of the article may note the tentativeness of the first sentence. "There are reasons to believe" is hardly a ringing declaration. The explanation, of course, is that though I had the record of private investor A.W. Jones and Company and had discovered none better, my knowledge of how other private investors were doing was certainly not complete. Had the record of Omaha's Buffett Partnership Limited been then in our hands, a matchup of Buffett and Jones would have been interesting but hardly conclusive. We had a 10-year record of A.W. Jones and Company, but Buffett Partnership kept its books on the calendar year and had only 9 of those behind it. As for 5 years, Jones ended his 1965 fiscal year in May and for the period made 325%. Buffett's 1965 year ended in December, and he made 334%. But all that was history, and the paths of the two men soon diverged. As the next article discusses, Buffett closed down his partnership, while Jones stayed on to struggle with a stock market grown, for the moment, very difficult for hedge funds. CL. There are reasons to believe that the best professional manager of investors' money these days is a quiet-spoken, seldom photographed man named Alfred Winslow Jones. Few businessmen have heard of him, although some with long memories may remember his articles in Fortune. He was a staff writer in the early 1940s. In any case, his performance in the stock market in recent years has made him one of the wonders of Wall Street, and made millionaires of several of his investors. On investments left with him during the 5 years ended last May 31, when he closed his 1965 fiscal year, Jones made 325%. Fidelity Trend Fund, which had the best record of any mutual fund during those years, made only 225%. For the 10-year period ended in May, Jones made 670%. Dreyfus Fund, the leader among mutual funds that were in business all during that decade, had a 358% gain. The vehicle through which Jones operates is not a mutual fund, but a limited partnership. Jones runs 2 such partnerships, and they have slightly different investment objectives. In each case, however, the underlying investment strategy is the same. The fund's capital is both leveraged and hedged. The leverage arises from the fact that the fund margins itself to the hilt. The hedge is provided by short positions. These are always some of the fund's portfolio. There are about 60 investors in each of the 2 funds, and their average investment now works out to about $460,000. Jones's accomplishments have spawned a number of other hedge funds. In the last 2 years, 2 of Jones's principal associates have left his organization and set up limited partnerships of their own. One is known as City Associates. It has capital of about $17,500,000. The other as Fairfield Partners, $14 million. Both have had outstanding performance records. This month, a new partnership, Fleshner Becker Associates, will go into business as a hedge fund. Its principals are Wall Street brokers who have done business with Jones over the last few years. Besides these partnerships, a number of other hedge funds are operating on a small scale. In addition, a small brokerage firm named L. Hubschman & Company, which has also done business with Jones, has bypassed the partnership pattern and is setting up an open-end investment company, i.e., a mutual fund, the Hubschman Fund, which will invest on hedge fund principles. It remains to be seen whether a regulated investment company can use Jones's techniques as effectively as a private partnership does. Meanwhile, Hubschman's move opens the way for a large number of investors to buy themselves a stake in the hedge fund idea. For most of his life, Jones, who is now 65, was more interested in sociology and in writing than he was in the stock market. In 1938, he set out to get his Ph.D. in sociology at Columbia University. While working toward the degree, he served as director of Columbia's Institute for Applied Social Analysis and undertook for it a major project on class distinctions in the U.S. The project became the basis for his doctoral thesis, which was published under the title Life, Liberty, and Property. 2 years ago, it was reprinted by Octagon Books, Inc. Fortune asked Jones to condense the book into an article, February 1941, and hired him as a writer. Over the next 5 years, part of it spent with time, he wrote articles on such non-financial subjects as Atlantic convoys, farm cooperatives, and boys' prep schools. He left Time Inc. in 1946, but in March 1949 he was back in the pages of Fortune with a freelance article, Fashions in Forecasting, which reported on various technical approaches to the stock market. His research for this story convinced him that he could make a living in the stock market, and early in 1949 he and 4 friends formed A.W. Jones and Company as a general partnership. Their initial capital was $100,000, of which Jones himself put up $40,000. In its first year, the partnership's gain on its capital came to a satisfactory 17.3%. But this was only a suggestion of things to come. Not quite all the original capital had been left in the partnership, but if it had been, it would today be worth $4,920,789, before any allowance for the partners' taxes. In the early years, Jones was experimenting with a number of investment approaches, including the hedge idea, which was essentially his own. Increasingly, he began to concentrate on refining and employing this new technique. In effect, the hedge concept puts Jones in a position to make money on both rising and falling stocks, and also partially shelters him if he misjudges the general trend of the market. He assumes that a prudent investor wants to protect part of his capital from such misjudgments. Most investors would build their defenses around cash reserves or bonds, but Jones protects himself by selling short. To those investors who regard short selling with suspicion, Jones would simply say that he is using speculative techniques for conservative ends. As illustration, he is given to contrasting his methods with those of an investor who has, say, $100,000 and elects to invest $80,000 of it in stocks and the rest in safe bonds. Jones would use the $100,000 to borrow perhaps another $50,000. Under the current margin requirements of 70%, he could not borrow that much to buy listed stocks. However, he could borrow even more than $50,000 for purchases of convertible bonds and unlisted stocks. Of the $150,000 total, he might put $110,000 into stocks he likes and sell short $40,000 worth of stocks he thinks are overvalued. Thus he ends up with $40,000 of his long position hedged, i.e. offset by a short position, and the remaining $70,000 fully exposed. This figure represents 70% of his original capital, and Jones therefore describes his risk as 70. In practice, there is an added complication. Jones adjusts the dollar figures in a calculation that assumes some individual stocks to be more volatile and therefore more risky than others. Every stock in Jones's portfolio is assigned a velocity rating. For example, Syntex's is 6.61, Kerr-McGee's 1.72, and the dollars invested are multiplied by these factors. The adjusted dollars are then used to figure the risk. By Jones's method of measuring, the more conventional investor who puts $20,000 into bonds, neither borrowing nor selling short, had a risk of 80. If the stock market goes down by 10% and all stocks in these two portfolios do likewise, Jones will break even on the hedged part of his portfolio and will lose less on his unhedged position, $7,000 instead of $8,000 than the other investor. If the stocks all rise by 10%, Jones will make less than the other investor. His problem, therefore, is to buy stocks that will rise more than the general market and sell stocks short that will rise less than the averages, or will actually fall. If he succeeds in this effort, his rewards are multiplied because he is employing not just a portion of his capital, but 150% of it. The main advantage of the hedge concept, then, is that the investor's short position enables him to operate on the long side with maximum aggressiveness. Jones's record in forecasting the direction of the market seems to have been only fair. In the early part of 1962, he had his investors in a high-risk position of 140. As the market declined, he gradually increased his short position, but not as quickly as he should have. His losses that spring were heavy, and his investors ended up with a small loss for the fiscal year. This is the only losing year in Jones's history. After the break, furthermore, he turned bearish, and so did not at first benefit from the market's recovery. Last year, as it happened, Jones remained quite bullish through the May and June decline, and then got bearish just about the time the big rally began. As prices rose in August, Jones actually moved to a -18 risk, i.e., his short positions exceeded his longs, with the unhedged short position amounting to 18% of the partnership capital. Despite these miscalculations about the direction of the market, Jones's selections of individual stocks have generally been brilliant. When he finally did turn bullish in the fall, he was long on a lot of the right stocks. For example, Syntex, National Video, Fairchild Camera, the airlines. By the end of February, he had racked up gains for the fiscal year of 38% in one fund, 31% in the other, compared to an increase, including dividends, of 6% for the Dow Jones Industrials. Any hedge fund operator will explain that although the hedge concept is essential, "I need it to sleep nights," says one of them, the real secret of his success is his ability to get good information about stocks and to be able to act on it quickly. The partnership form of organization is helpful in both respects, and it is worth examining Jones's arrangements closely. Jones changed his firm from a general to a limited partnership in 1952 in order to accommodate several friends who were by then eager to have him handle their money. The new partners were let in on the understanding that they could withdraw their money from the partnership or put new money into it only at the end of each fiscal year. This agreement still exists. Moreover, Jones and the other general partners are to receive as compensation 20% of any realized profits, after deduction of realized losses, made on the limited partners' money. This arrangement is common to all the hedge funds, and the idea was not original with Jones. Benjamin Graham, for one, had once run a limited partnership along these same lines. There are also some mutual funds today. For example, Oppenheimer Fund, Equity Fund, Leon B. Allen Fund, whose managers are paid on the basis of profits. Although less liberally than Jones, the Hubschman Fund will have a similar arrangement. The limited partners would seem to have no cause for complaint about the huge profits realized by Jones. Those sensational comparative performance figures reflect the limited partners' results after deduction of the general partner's share of their profits. In other words, the figures understate Jones's actual superiority over Fidelity Trend and Dreyfus in portfolio performance. It is small wonder, then, that as the years have gone by, a lot of investors have sought to get into Jones's partnerships. But since they are organized as private, unregistered funds, Jones took in only a few additional partners each year, primarily investors who were relatives or close friends of existing partners. By now, however, the partners have got to be a diverse group. The largest limited partnership interest belongs to Louis E. Stevens, a Mexico City businessman. He is the retired general manager of General Products S.A., a chemical company, who had $2.26 million in one Jones partnership at the start of this fiscal year. Another large stake is held by A. Arlie Sineco, a physician turned professional sculptor, who, together with his family, has about $2 million invested with Jones. Most of this amount represents portfolio appreciation. Several of the Richardsons associated with Richardson Merrill, including the company's chairman, Smith Richardson, Jr., have money in the partnerships. So does Louis Fisher, author of The Life of Lenin and other books, and Samuel Stayman, the bridge expert. Stayman, whose wealth comes primarily from a woolen business, also has money in the two other big hedge funds, City Associates and Fairfield Partners, and in Buffett Partnership Limited, a $45 million Omaha operation that uses hedge principles to some extent, but that has mainly, and very successfully, concentrated on long-term investment. Other prominent businessmen in the hedge funds are Lawrence Tisch, president of Loews Theaters, and Maurice Pearlstein, ex-president of Kellwood Company. All told, Jones's limited partners had an investment with him of $44,898,000 as of June 1st. Of this amount, about $5 million represented investments by the immediate families of the 10 general partners. In addition, the general partners themselves, who have agreed to keep all of their investment funds in the partnership, had another $5 million invested. Of this, about $2 million is Jones's own. His two children, both of them limited partners, have another $2.5 million together. In total, including the gains he has made so far this fiscal year, Jones is managing close to $70 million of capital. Even with the borrowed money added in, this makes his operation no bigger than a medium-sized mutual fund. But the weight Jones swings on Wall Street is many times magnified by the fact that, like all hedge fund operators, he is a prodigious producer of commissions. Since short sales can never result in anything but short-term gains or losses, the hedge operator moves in and out of them freely. Similarly, when he has losses on the short sales, he also finds it easier to take offsetting short-term gains on long positions. In general, the hedge funds have a high portfolio turnover. One big reason the hedge funds find it natural to move in and out of stocks a lot is that, far more than most other funds, they have a special ability to get a flow of good, fresh ideas about stocks from brokers, and get them early. Most mutual funds are virtually compelled to channel a large proportion, perhaps as much as 90%, of the commissions they generate to brokers who sell the shares of their fund to the public. They have very little commission business left over for any firms that are unimportant in mutual fund sales, but that are strong on research. The partnership funds, on the other hand, have no shares to sell, and thus can afford to pay a generous portion of their commissions for research. In Jones's case, the payments take a roundabout form. The brokerage firm of Neuberger and Berman executes practically all Jones's orders, but keeps only about 50% of the commissions generated. It sends the remaining 50% in the form of give-up checks to brokers designated by Jones. A brokerage firm that Jones relies on heavily for research may get possibly $50,000 in give-ups a year, of which a third or more might go to the salesman who was covering the account and supplying those good ideas. That salesman is therefore likely to be very cooperative about keeping Jones informed. The Jones organization is set up so that decisions about purchases and sales can be made immediately without committee consultation. There are 5 portfolio managers, all general partners, each of whom has discretion over a percentage of the partnership capital. In addition, several outside advisors, one of them an investment counselor, the rest brokerage house analysts or salesmen, have been given blocks of capital to manage. Either Jones or his number 2 man, Donald Woodward, sees each order before it is executed, but they interfere only when it seems to them that the partnership is getting overloaded with a given stock. For example, if several of the portfolio managers are being sold on the stock at the same time, or is maneuvering itself into an undesirable risk position. The portfolio managers will tell you that, given the long-term trend of the market upward, their most difficult job is picking good short sales. Wall Street's analysts typically concentrate on discovering bullish corporate situations, and only rarely have promising shorts to bring to Jones. As a result, he and the other hedge fund managers normally consider themselves lucky to break even on their short portfolios. Early last month, Jones was short about 60 different stocks, including Corvette, Bristol-Myers, Admiral, and DuPont. All of the big hedge funds were short control data. Recently, Jones has devoted more and more time to traveling and philanthropic projects, many of them financed by his own foundation for voluntary service. He has made some field trips for the Peace Corps, and his own foundation is currently supporting the activities in this country of 5 young social workers from India, as a sort of reverse Peace Corps. He is also thinking of writing another book on what to do about poverty in the U.S. From Hard Times Come to the Hedge Funds, January 1970. An excerpt from an article by Carol Loomis. After years of extravagant profits, many gained in the wildly speculative market of 1968. The fledgling hedge fund industry was hammered in 1969 by a rough bear market. The hedging strategies that were supposed to protect the funds largely failed. Most funds showed losses, some suffered large withdrawals of capital, and a few folded. In contrast, Buffett Partnership, the subject of a short section in this article, made money in 1969, adding to its unbroken string of profits. The fund had meanwhile grown big, to $100 million in assets, versus the $160 million divided between 2 funds that A.W. Jones ran. But Warren Buffett, then 39, was hardly happy with this world. He regarded the speculative excesses of 1968 as insane. "This is a market I don't understand," he said. He also suspected that making money in stocks was going to become harder to do. So he announced in 1969 that, after 13 years of operation, he would close Buffett Partnership at the end of the year. That point starts off the article's 2 paragraphs about Buffett, which we reprint here. His excerpt also reports the outstanding returns that Buffett delivered his limited partners, a compounded annual return for the 13 years of 23.8%. The fund's gross record, that is, before Buffett took his incentive compensation, was naturally still more stunning, a compounded annual return of 29.5%, against a comparable total return for the Dow of 7.4%. Buffett himself accumulated a fortune of about $25 million from running the partnership. Buffett's reasoning as to why he should close the partnership turned out to be less on the money. True, over the near term the stock market ran into tough times, particularly in 1973 and 1974. But stocks, of course, proceeded over the decades to reward investors handsomely. Fortunately for Buffett, and for the investors who followed him, he stayed in the market as chief executive of Berkshire Hathaway and master investor of its excess cash. Buffett's other stated reason for closing up shop, that it was time to stop amassing money and get on to other things, simply faded into unreality. It wasn't the money that drove him on. To this day, he leads an unostentatious life. But building wealth has, to him, been an endlessly fascinating game. One inning of that game ended as he closed the partnership. The others commenced as he settled back to running Berkshire. C.L. The arrival of 1970 will mark not only the demise of certain unsuccessful hedge funds and the constriction of still others, but will also bring the liquidation of one of the country's oldest, largest, and most successful investment partnerships, Buffett Partnership Limited of Omaha. To call the Buffett operation a hedge fund is accurate only in the sense that Warren E. Buffett, 39, the general partner, shares in the profits of the limited partners. Under his quite unusual arrangement, the limited partners keep all of the annual gains up to 6%. Above that level, Buffett takes a 1/4 cut. Otherwise, he is set apart from the regular hedge funds by the fact that he has invested almost exclusively in long-term value situations. Buffett's record has been extraordinarily good. In his 13 years of operation, all of them, including 1969, profitable. He compounded his investors' money at a 24% annual rate. But now, to the immense regret of his limited partners, Buffett is quitting the game. His reasons for doing so are several, and include a strong feeling that his time and money, he is a millionaire many times over, should now be directed toward other goals than simply the making of more money. But he also suspects that some of the juice has gone out of the stock market, and that sizable gains are in the future going to be very hard to come by. Consequently, he has suggested to his investors that they may want to take the passive way out, investing their partnership money not in the stock market, but rather municipal bonds. The full text of Hard Times Come to the Hedge Funds is available at fortune.com/BuffettBook. How Inflation Swindles the Equity Investor. May 1977, by Warren Buffett. This book contains 12 articles authored by Warren Buffett. 2 are pieces that he wrote expressly for Fortune, the first of which follows. The others are 2 major speeches of his that we turned into articles, an important letter he sent to a congressman, his philanthropic pledge, and 6 excerpts from his annual Berkshire letter. For this article, the inaugural piece of the 12, a senior and very talented Fortune editor, Dan Siegelman, made a trip to Omaha to negotiate with Buffett about revisions to his first draft. Siegelman found this $1-an-article writer generally resistant to shortening the piece and not too amenable to changes of any kind. At one point, a frustrated Siegelman called Fortune's managing editor, Bob Lubar, to suggest that perhaps the magazine should not publish the article at all. But Lubar said he thought the article was worthwhile and should not be abandoned. The article that emerged, no doubt reflecting at least some Siegelman edits, was an early example of Buffett's extraordinary talent for thinking through complicated problems. To this day, the article is remembered for its erudition. Both Buffett and Fortune still get letters about it, commenting on one aspect or another. Nevertheless, the piece turned out to be wrong in several ways. First, Buffett, along with the business world in general, thought high inflation rates were here to stay and would plague investors. What he would not foresee was the genius and resolve of Paul Volcker, who took over as Fed chairman in 1979 and broke the back of inflation. Second, Buffett misjudged the course of corporate tax rates, which he thought were unlikely to fall. In reality, a succession of tax cuts beginning in 1979 brought the marginal rate down from the 48% prevailing when the article was written to 35% today. That helps explain why Buffett also erred in believing that the return on equity of major corporations would continue to be stuck around 12%. By 1981, I was writing an article titled "Profitability Breaks Through a Ceiling," which reported that the median return for the Fortune 500 over the previous 5 years had, despite high rates of inflation, leaped to an average of 14.8%. The article attributed the jump to corporations increasing their leverage a bit, enjoying reduced tax rates, and managing to raise their pre-tax profit margins. Today, Buffett says that had capitalism worked perfectly, competition would have kept profit margins down. Nonetheless, he adds, you can't get around it. I was wrong in my assumptions, particularly about tax rates. He remains convinced, however, that high rates of inflation are sure to swindle the equity investor, and he cites evidence from the years when inflation was out of control. Until Volcker pushed inflation below 8% in 1982, Buffett recalls investors who bought stocks in 1977 had suffered a clear-cut loss in purchasing power. CL.
It is no longer a secret that stocks, like bonds, do poorly in an inflationary environment. We've been in such an environment for most of the past decade, and it has indeed been a time of troubles for stocks. But the reasons for the stock market's problems in this period are still imperfectly understood. There is no mystery at all about the problems of bondholders in an era of inflation. When the value of the dollar deteriorates month after month, a security with income and principal payments denominated in those dollars isn't going to be a big winner. You hardly need a PhD in economics to figure that one out. It was long assumed that stocks were something else. For many years, the conventional wisdom insisted that stocks were a hedge against inflation. The proposition was rooted in the fact that stocks are not claims against dollars as bonds are, but represent ownership of companies with productive facilities. These, investors believed, would retain their value in real terms, let the politicians print money as they might. And why didn't it turn out that way? The main reason, I believe, is that stocks in economic substance are really very similar to bonds. I know that this belief will seem eccentric to many investors. They will immediately observe that the return on a bond, the coupon, is fixed, while the return on an equity investment, the company's earnings, can vary substantially from one year to another. True enough. But anyone who examines the aggregate returns that have been earned by companies during the post-war years will discover something extraordinary. The returns on equity have, in fact, not varied much at all. In the first 10 years after the war, the decade ending in 1955, the Dow Jones Industrials had an average annual return on year-end equity of 12.8%. In the second decade, the figure was 10.1%. In the third decade, it was 10.9%. Data for a larger universe, the Fortune 500, whose history goes back only to the mid-1950s, indicates somewhat similar results: 11.2% in the decade ending in 1965, 11.8% in the decade through 1975. The figures for a few exceptional years have been substantially higher. The high for the 500 was 14.1% in 1974, or lower, 9.5% in 1958 and 1970. But over the years, and in the aggregate, the return on book value tends to keep coming back to a level around 12%. It shows no signs of exceeding that level significantly in inflationary years, or in years of stable prices for that matter. For the moment, Let's think of those companies not as listed stocks, but as productive enterprises. Let's also assume that the owners of those enterprises have acquired them at book value. In that case, their own return would have been around 12% too. And because the return has been so consistent, it seems reasonable to think of it as an equity coupon. In the real world, of course, investors in stocks don't just buy and hold. Instead, many try to outwit their fellow investors in order to maximize their own proportions of corporate earnings. This thrashing about, obviously fruitless in the aggregate, has no impact on the equity coupon, but reduces the investor's portion of it because he incurs substantial frictional costs, such as advisory fees and brokerage charges. Throw in an active options market, which adds nothing to the productivity of American enterprise, but requires a cast of thousands to man the casino, and frictional costs rise further. It is also true that in the real world, investors in stocks don't usually get to buy at book value. Sometimes they have been able to buy in below book. Usually, however, they've had to pay more than book, and when that happens, there is further pressure on that 12%. I'll talk more about these relationships later. Meanwhile, let's focus on the main point. As inflation has increased, the return on equity capital has not. Essentially, those who buy equities receive securities with an underlying fixed return, just like those who buy bonds. Of course, there are some important differences between the bond and stock forms. For openers, bonds eventually come due. It may require a long wait, but eventually the bond investor gets to renegotiate the terms of his contract. If current and prospective rates of inflation make his old coupon look inadequate, he can refuse to play further unless coupons currently being offered rekindle his interest. Something of this sort has been going on in recent years. Stocks, on the other hand, are perpetual. They have a maturity date of infinity. Investors in stocks are stuck with whatever return corporate America happens to earn. If corporate America is destined to earn 12%, then that is the level investors must learn to live with. As a group, stock investors can neither opt out nor renegotiate. In the aggregate, their commitment is actually increasing. Individual companies can be sold or liquidated, and corporations can repurchase their own shares. On balance, however, new equity flotations and retained earnings guarantee that the equity capital locked up in the corporate system will increase. So, score one for the bond form. Bond coupons eventually will be renegotiated. Equity coupons won't. It is true, of course, that for a long time a 12% coupon did not appear in need of a whole lot of correction. There is another major difference between the garden variety of bond and our new exotic 12% equity bond that comes to the Wall Street costume ball dressed in a stock certificate. In the usual case, a bond investor receives his entire coupon in cash and is left to reinvest it as best he can. Our stock investor's equity coupon, in contrast, is partially retained by the company and is reinvested at whatever rates the company happens to be earning. In other words, going back to our corporate universe, part of the 12% earned annually is paid out in dividends, and the balance is put right back into the universe to earn 12% also. This characteristic of stocks, the reinvestment of part of the coupon, can be good or bad news depending on the relative attractiveness of that 12%. The news was very good indeed in the 1950s and early 1960s, with bonds yielding only 3 or 4%. The right to reinvest automatically a portion of the equity coupon at 12% was of enormous value. Note that investors could not just invest their own money and get that 12% return. Stock prices in this period ranged far above book value. and investors were prevented by the premium prices they had to pay from directly extracting out of the underlying corporate universe whatever rate that universe was earning. You can't pay far above par for a 12% bond and earn 12% for yourself. But on their retained earnings, investors could earn 12%. In effect, earnings retention allowed investors to buy at book value part of an enterprise that, in the economic environment then existing, was worth a great deal more than book value. It was a situation that left very little to be said for cash dividends and a lot to be said for earnings retention. Indeed, the more money that investors thought likely to be reinvested at the 12% rate, the more valuable they considered their reinvestment privilege, and the more they were willing to pay for it. In the early 1960s, investors eagerly paid top-scale prices for electric utilities situated in growth areas, knowing that these companies had the ability to reinvest very large proportions of their earnings. Utilities whose operating environment dictated a larger cash payout rated lower prices. If, during this period, a high-grade, non-callable, long-term bond with a 12% coupon had existed, it would have been sold far above par. And if it were a bond with a further unusual characteristic, which was that most of the coupon payments could be automatically reinvested at par in similar bonds, the issue would have commanded an even greater premium. In essence, growth stocks retaining most of their earnings represented just such a security. When their reinvestment rate on the added equity capital was 12%, while interest rates generally were around 4%, investors became very happy, and, of course, they paid happy prices. Looking back, stock investors can think of themselves in the 1946 to 66 period as having been ladled a truly bountiful triple dip. First, they were the beneficiaries of an underlying corporate return on equity that was far above prevailing interest rates. Second, a significant portion of that return was reinvested for them at rates that were otherwise unattainable. And third, they were afforded an escalating appraisal of underlying equity capital as the first two benefits became widely recognized. This third dip meant that, on top of the basic 12% or so earned by corporations on their equity capital, investors were receiving a bonus as the Dow Jones Industrials increased in price from 133% of book value in 1946 to 220% in 1966. Such a marking up process temporarily allowed investors to achieve a return that exceeded the inherent earning power of the enterprises in which they had invested. This heaven-on-earth situation finally was discovered in the mid-1960s by many major investing institutions. But just as these financial elephants began trampling on one another in their rush to equities, we entered an era of accelerating inflation and higher interest rates. Quite logically, the marking up process began to reverse itself. Rising interest rates ruthlessly reduced the value of all existing fixed coupon investments. And as long-term corporate bond rates began moving up, eventually reaching the 10% area, both the equity return of 12% and the reinvestment privilege began to look different. Stocks are quite properly thought of as riskier than bonds. While that equity coupon is more or less fixed over periods of time, it does fluctuate somewhat from year to year. Investors' attitudes about the future can be affected substantially, although frequently erroneously by those yearly changes. Stocks are also riskier because they come equipped with infinite maturities. Even your friendly broker wouldn't have the nerve to peddle a 100-year bond, if he had any available, as safe. Because of the additional risk, the natural reaction of investors is to expect an equity return that is comfortably above the bond return, and 12% on equity versus, say, 10% on bonds issued by the same corporate universe does not seem to qualify as comfortable. As the spread narrows, equity investors start looking for the exits. But, of course, as a group they can't get out. All they can achieve is a lot of movement, substantial frictional costs, and a new, much lower level of valuation, reflecting the lessened attractiveness of the 12% equity coupon under inflationary conditions. Bond investors have had a succession of shocks over the past decade in the course of discovering that there is no magic attached to any given coupon level. At 6% or 8% or 10%, bonds can still collapse in price. Stock investors who are, in general, not aware that they too have a coupon are still receiving their education on this point. Must we really view that 12% equity coupon as immutable? Is there any law that says the corporate return on equity capital cannot adjust itself upward in response to a permanently higher average rate of inflation? There is no such law, of course. On the other hand, corporate America cannot increase earnings by desire or decree. To raise that return on equity, corporations would need at least one of the following. 1. An increase in turnover, i.e., in the ratio between sales and total assets employed in the business. 2. Cheaper leverage. 3. More leverage. 4. Lower income taxes. 5. Wider operating margins on sales. And that's it. There simply are no other ways to increase returns on common equity. Let's see what can be done with these. We'll begin with turnover. The three major categories of assets we have to think about for this exercise are accounts receivable, inventories, and fixed assets such as plants and machinery. Accounts receivable go up proportionally as sales go up, whether the increase in dollar sales is produced by more physical volume or by inflation. No room for improvement here. With inventories, the situation is not quite so simple. Over the long term, the trend in unit inventories may be expected to follow the trend in unit sales. Over the short term, however, the physical turnover rate may bob around because of special influences, e.g., cost expectations or bottlenecks. The use of last in, first out, LIFO, inventory valuation methods serves to increase the reported turnover rate during inflationary times. When dollar sales are rising because of inflation, inventory valuations of a LIFO company either will remain level if unit sales are not rising, or will trail the rise in dollar sales if unit sales are rising. In either case, dollar turnover will increase. During the early 1970s, there was a pronounced swing by corporations toward LIFO accounting, which has the effect of lowering a company's reported earnings and tax bills. The trend now seems to have slowed. Still, the existence of a lot of LIFO companies, plus the likelihood that some others will join the crowd, ensures some further increases in the reported turnover of inventory. In the case of fixed assets, any rise in the inflation rate, assuming it affects all products equally, will initially have the effect of increasing turnover. That is true because sales will immediately reflect the new price level, while the fixed asset account will reflect the change only gradually, i.e., as existing assets are retired and replaced at the new prices. Obviously, the more slowly a company goes about this replacement process, the more the turnover ratio will rise. The action stops, however, when a replacement cycle is completed. Assuming a constant rate of inflation, sales and fixed assets will then begin to rise in concert at the rate of inflation. To sum up, inflation will produce some gains in turnover ratios. Some improvement will be certain because of LIFO, and some will be possible if inflation accelerates because of sales rising more rapidly than fixed assets. But the gains are apt to be modest and not of a magnitude to produce substantial improvement in returns on equity capital. During the decade ending in 1975, despite generally accelerating inflation and the extensive use of LIFO accounting, the turnover ratio of the Fortune 500 went only from 1.18 to 1 to 1.29 to 1. Cheaper leverage? Not likely. High rates of inflation generally cause borrowing to become dearer, not cheaper. Galloping rates of inflation create galloping capital needs, and lenders, as they become increasingly distrustful of long-term contracts, become more demanding. But even if there is no further rise in interest rates, leverage will be getting more expensive because the average cost of the debt now on corporate books is less than would be the cost of replacing it. And replacement will be required as the existing debt matures. Overall, then, future changes in the cost of leverage seem likely to have a mildly depressing effect on the return on equity. More leverage? American business already has fired many, if not most, of the more leverage bullets once available to it. Proof of that proposition can be seen in some other Fortune 500 statistics. In the 20 years ending in 1975, stockholders' equity as a percentage of total assets declined for the 500 from 63% to just under 50%. In other words, each dollar of equity capital now is leveraged much more heavily than it used to be. An irony of inflation-induced financial requirements is that the highly profitable companies, generally the best credits, require relatively little debt capital. But the laggards in profitability never can get enough. Lenders understand this problem much better than they did a decade ago, and are correspondingly less willing to let capital-hungry, low-profitability enterprises leverage themselves to the sky. Nevertheless, given inflationary conditions, many corporations seem sure in the future to turn to still more leverage as a means of shoring up equity returns. Their managements will make that move because they will need enormous amounts of capital, often merely to do the same physical volume of business, and will wish to get it without cutting dividends or making equity offerings that, because of inflation, are not apt to shape up as attractive. Their natural response will be to heap on debt almost regardless of cost. They will tend to behave like those utility companies that argued over 1/8 of a point in the 1960s and were grateful to find 12% debt financing in 1974. Added debt at present interest rates, however, will do less for equity returns than did added debt at 4% rates in the early 1960s. There is also the problem that higher debt ratios cause credit ratings to be lowered, creating a further rise in interest costs. So, that is another way to be added to those already discussed, in which the cost of leverage will be rising. In total, the higher cost of leverage are likely to offset the benefits of greater leverage. Besides, there is already far more debt in corporate America than is conveyed by conventional balance sheets. Many companies have massive pension obligations geared to whatever pay levels will be in effect when present workers retire. At the low inflation rates of 1955 to 65, the liabilities arising from such plans were reasonably predictable. Today, nobody can really know the company's ultimate obligation. But if the inflation rate averages 7% in the future, a 25-year-old employee who is now earning $12,000 and whose raises do no more than match increases in living costs will be making $180,000 when he retires at 65. Of course, There is a marvelously precise figure in many annual reports each year, purporting to be the unfunded pension liability. If that figure were really believable, a corporation could simply ante up that sum, add it to the existing pension fund assets, turn the total amount over to an insurance company, and have it assume all the corporation's present pension liabilities. In the real world, alas, it is impossible to find an insurance company willing even to listen to such a deal. Virtually every corporate treasurer in America would recoil at the idea of issuing a cost of living bond, a non-callable obligation with coupons tied to a price index. But through the private pension system, corporate America has, in fact, taken on a fantastic amount of debt that is the equivalent of such a bond. More leverage, whether through conventional debt or unbooked and indexed pension debt, should be viewed with skepticism by shareholders. A 12% return from an enterprise that is debt-free is far superior to the same return achieved by a business hucked to its eyeballs, which means that today's 12% equity returns may well be less valuable than the 12% returns of 20 years ago. Lower corporate income taxes seem unlikely. Investors in American corporations already own what might be thought of as a Class D stock. The Class A, B, and C stocks are represented by the income tax claims of the federal, state, and municipal governments. It is true that these investors have no claim on the corporation's assets. However, they get a major share of the earnings, including earnings generated by the equity buildup resulting from retention of part of the earnings owned by the Class D shareholders. A further charming characteristic of these wonderful Class A, B, and C stocks is that their share of the corporation's earnings can be increased immediately, abundantly, and without payment by the unilateral vote of any one of the stockholder classes, e.g. by congressional action in the case of the Class A. To add to the fun, one of the classes will sometimes vote to increase its ownership share in the business retroactively, as companies operating in New York discovered to their dismay in 1975. Whenever the Class A, B, or C stockholders vote themselves a larger share of the business, the portion remaining for Class D, that's the one held by the ordinary investor, declines. Looking ahead, it seems unwise to assume that those who control the A, B, and C shares will vote to reduce their own take over the long run. The Class D shares probably will have to struggle to hold their own. The last of our 5 possible sources of increased returns on equity is wider operating margins on sales. Here is where some optimists would hope to achieve major gains. There is no proof that they are wrong, but there are only 100 cents in the sales dollar, and a lot of demands on that dollar before we get down to the residual pre-tax profits. The major claimants are labor, raw materials, energy, and various non-income taxes. The relative importance of these costs hardly seems likely to decline during an age of inflation. Recent statistical evidence, furthermore, does not inspire confidence in the proposition that margins will widen in a period of inflation. In the decade ending in 1965, a period of relatively low inflation, the universe of manufacturing companies reported on quarterly by the Federal Trade Commission had an average annual pre-tax margin on sales of 8.6%. In the decade ending in 1975, the average margin was 8%. Margins were down, in other words, despite a very considerable increase in the inflation rate. If businesses were able to base its prices on replacement costs, margins would widen in inflationary periods. But the simple fact is that most large businesses despite a widespread belief in their market power, just don't manage to pull it off. Replacement cost accounting almost always shows that corporate earnings have declined significantly in the past decade. If such major industries as oil, steel, and aluminum really have the oligopolistic muscle imputed to them, one can only conclude that their pricing policies have been remarkably restrained. There you have the complete lineup. 5 factors that can improve returns on common equity, none of which, by my analysis, are likely to take us very far in that direction in periods of high inflation. You may have emerged from this exercise more optimistic than I am, but remember, returns in the 12% area have been with us a long time. Even if you agree that the 12% equity coupon is more or less immutable, you still may hope to do well with it in the years ahead. It's conceivable that you will. After all, a lot of investors did well with it for a long time. But your future results will be governed by 3 variables: the relationship between book value and market value, the tax rate, and the inflation rate. Let's wade through a little arithmetic about book and market value. When stocks consistently sell at book value, it's all very simple. If a stock has a book value of $100 and also an average market value of $100, 12% earnings by business will produce a 12% return for the investor, less those frictional costs, which we'll ignore for the moment. If the payout ratio is 50%, our investor will get $6 via dividends and a further $6 from the increase in the book value of the business, which will, of course, be reflected in the market value of his holdings. If the stock sold at 150% of book value, the picture would change. The investor would receive the same $6 cash dividend, but it would now represent only a 4% return on his $150 cost. The book value of the business would still increase by 6% to $106, and the market value of the investor's holdings, valued consistently at 150% of book value, would similarly increase by 6% to $159. But the investor's total return, i.e. from appreciation plus dividends, would be only 10% versus the underlying 12% earned by the business. When the investor buys in below book value, the process is reversed. For example, if the stock sells at 80% of book value, the same earnings and payout assumptions would yield 7.5% from dividends, $6 on an $80 price, and 6% from appreciation, a total return of 13.5%. In other words, you do better by buying at a discount rather than a premium, just as common sense would suggest. During the post-war years, the market value of the Dow Jones Industrials has been as low as 84% of book value in 1974 and as high as 230% in 1965. Most of the time, the ratio has been well over 100%. Early this spring, it was around 110%. Let's assume that in the future, the ratio will be something close to 100%, meaning that investors in stocks could earn the full 12%. At least, they could earn that figure before taxes and before inflation. How large a bite might taxes take out of the 12%? For individual investors, it seems reasonable to assume that federal, state, and local income taxes will average perhaps 50% on dividends and 30% on capital gains. A majority of investors may have marginal rates somewhat below these, but many with larger holdings will experience substantially higher rates. Under the new tax law, a high-income investor in a heavily taxed city could have a marginal rate on capital gains as high as 56%, So let's use 50% and 30% as representative for individual investors. Let's also assume, in line with recent experience, that corporations earning 12% on equity pay out 5% in cash dividends, 2.5% after tax, and retain 7%, with those retained earnings producing a corresponding market value growth, 4.9% after the 30% tax. The after-tax return, then, would be 7.4%. Probably this should be rounded down to about 7% to allow for frictional costs. To push our stocks disguised as bonds thesis one notch further, then, stocks might be regarded as the equivalent for individuals of 7% tax-exempt perpetual bonds. Which brings us to the crucial question, the inflation rate. No one knows the answer on this one, including the politicians, economists, and establishment pundits who felt a few years back that with slight nudges here and there, unemployment and inflation rates would respond like trained seals. But many signs seem negative for stable prices. The fact that inflation is now worldwide, the propensity of major groups in our society to utilize their electoral muscle to shift rather than solve economic problems, the demonstrated unwillingness to tackle even the most vital problems, e.g., energy and nuclear proliferation, if they can be postponed, and a political system that rewards legislators with re-election if their actions appear to produce short-term benefits, even though their ultimate imprint will be to compound long-term pain. Most of those in political office, quite understandably, are firmly against inflation and firmly in favor of policies producing it. This schizophrenia hasn't caused them to lose touch with reality, however. Congressmen have made sure that their pensions, unlike practically all granted in the private sector, are indexed to cost of living changes after retirement. Discussions regarding future inflation rates usually probe the subtleties of monetary and fiscal policies. These are important variables in determining the outcome of any specific inflationary equation. But at the source, peacetime inflation is a political problem, not an economic one. Human behavior, not monetary behavior, is the key. When very human politicians choose between the next election and the next generation, it's clear what usually happens. Such broad generalizations do not produce precise numbers. However, it seems quite possible to me that inflation rates will average 7% in future years. I hope this forecast proves to be wrong, and it may well be. Forecasts usually tell us more about the forecaster than of the future. You are free to factor your own inflation rate into the investor's equation, but if you foresee a rate averaging 2% or 3%, you are wearing different glasses than I am. So, there we are. 12% before taxes and inflation, 7% after taxes and before inflation, and maybe 0% after taxes and inflation. It hardly sounds like a formula that will keep all those cattle stampeding on TV. As a common stockholder, you will have more dollars, but you may have no more purchasing power. Out with Ben Franklin, a penny saved is a penny earned, and in with Milton Friedman, a man might as well consume his capital as invest it. The arithmetic makes it plain that inflation is a far more devastating tax than anything that has been enacted by our legislatures. The inflation tax has a fantastic ability to simply consume capital. It makes no difference to a widow with her savings in a 5% passbook account whether she pays 100% income tax on her interest income during a period of zero inflation or pays no income taxes during years of 5% inflation. Either way, she is taxed in a manner that leaves her no real income whatsoever. Any money she spends comes right out of capital. She would find outrageous a 120% income tax, but doesn't seem to notice that 6% inflation is the economic equivalent. If my inflation assumption is close to correct, disappointing results will occur not because the market falls, but in spite of the fact that the market rises. At around 920 early last month, the Dow was up 55 points from where it was 10 years ago. But adjusted for inflation, the Dow is down almost 345 points, from 865 to 520. And about half of the earnings of the Dow had to be withheld from their owners and reinvested in order to achieve even that result. In the next 10 years, the Dow could be doubled just by a combination of the 12% equity coupon, a 40% payout ratio, and the present 110% ratio of market to book value. And with 7% inflation, investors who sold at 1800 would still be considerably worse off than they are today after paying their capital gains taxes. I can almost hear the reaction of some investors to these downbeat thoughts. It will be to assume that whatever the difficulties presented by the new investment era, they will somehow contrive to turn in superior results for themselves. Their success is most unlikely, and in aggregate, of course, impossible. If you feel you can dance in and out of securities in a way that defeats the inflation tax, I would like to be your broker, but not your partner. Even the so-called tax-exempt investors, such as pension funds and college endowment funds, do not escape the inflation tax. If my assumption of a 7% inflation rate is correct, a college treasurer should regard the first 7% earned each year merely as a replenishment of purchasing power. Endowment funds are earning nothing until they have outpaced the inflation treadmill. At 7% inflation and, say, overall investment returns of 8%, these institutions, which believe they are tax-exempt, are in fact paying income taxes of 87.5%. Unfortunately, the major problems from high inflation rates flow not to investors but to society as a whole. Investment income is a small portion of national income, and if per capita real income could grow at a healthy rate alongside zero real investment returns, social justice might well be advanced. A market economy creates some lopsided payoffs to participants. The right endowment of vocal cords, anatomical structure, physical strength, or mental powers can produce enormous piles of claim checks, stocks, bonds, and other forms of capital on future national output. Proper selections of ancestors similarly can result in lifetime supplies of such tickets upon birth. If zero real investment returns diverted a bit greater portion of the national output from such stockholders to equally worthy and hard-working citizens lacking jackpot-producing talents, it would seem unlikely to pose such an insult to an equitable world as to risk divine intervention. But the potential for real improvement in the welfare of workers at the expense of affluent stockholders is not significant. Employee compensation already totals 28 times the amount paid out in dividends, and a lot of those dividends now go to pension funds, nonprofit institutions such as universities, and individual stockholders who are not affluent. Under these circumstances, if we now shifted all dividends of wealthy stockholders into wages, something we would do only once, like killing a cow, or if you prefer, a pig, we would increase real wages by less than we used to obtain from 1 year's growth of the economy. Therefore, diminishment of the affluent through the impact of inflation on their investments will not even provide material short-term aid to those who are not affluent. Their economic well-being will rise or fall with the general effects of inflation on the economy, and those effects are not likely to be good. Large gains in real capital invested in modern production facilities are required to produce large gains in economic well-being. Great labor availability, great consumer wants, and great government promises will lead to nothing but great frustration without continuous creation and employment of expensive new capital assets throughout industry. That's an equation understood by Russians as well as Rockefellers, and it's one that has been applied with stunning success in West Germany and Japan. High capital accumulation rates have enabled those countries to achieve gains in living standards at rates far exceeding ours, even though we have enjoyed much the superior position in energy. To understand the impact of inflation upon real capital accumulation, a little math is required. Come back for a moment to that 12% return on equity capital. Such earnings are stated after depreciation, which presumably will allow replacement of present production capacity if that plant and equipment can be purchased in the future at prices similar to their original cost. Let's assume that about half of earnings are paid out in dividends, leaving 6% of equity capital available to finance future growth. If inflation is low, say 2%, a large portion of that growth can be real growth in physical output. For under these conditions, 2% more will have to be invested in receivables, inventories, and fixed assets next year just to duplicate this year's physical output, leaving 4% for investment in assets to produce more physical goods. The 2% finances illusory dollar growth, reflecting inflation, and the remaining 4% finances real growth. If population growth is 1%, the 4% gain in real output translates to a 3% gain in real per capita net income. That, very roughly, is what used to happen in our economy. Now, move the inflation rate to 7% and compute what is left for real growth after the financing of the mandatory inflation component. The answer is nothing, if dividend policies and leverage ratios remain unchanged. After half of the 12% earnings are paid out, the same 6% is left, but it is all conscripted to provide the added dollars needed to transact last year's physical volume of business. Many companies, faced with no real retained earnings with which to finance physical expansion after normal dividend payments, will improvise. How, they will ask themselves, can we stop or reduce dividends without risking stockholder wrath? I have good news for them. A ready-made set of blueprints is available. In recent years, the electric utility industry has had little or no dividend-paying capacity, or rather, it has had the power to pay dividends if investors agree to buy stock from them. In 1975, electric utilities paid common dividends of $3.3 billion and asked investors to return $3.4 billion. Of course, they mixed in a little solicit Peter to pay Paul technique so as not to acquire a Con Ed reputation. Con Ed, you will remember, was unwise enough in 1974 to simply tell its shareholders it didn't have the money to pay the dividend. Candor was rewarded with calamity in the marketplace. The more sophisticated utility maintains, perhaps increases, the quarterly dividend and then asks shareholders, either old or new, to mail back the money. In other words, the company issues new stock. This procedure diverts massive amounts of capital to the tax collector and substantial sums to underwriters. Everyone, however, seems to remain in good spirits, particularly the underwriters. Encouraged by such success, some utilities have devised a further shortcut. In this case, the company declares the dividend, the shareholder pays the tax, and presto, more shares are issued. No cash changes hands, although the IRS, spoilsport as always, persists in treating the transaction as if it had. AT&T, for example, instituted a dividend reinvestment program in 1973. This company, in fairness, must be described as very stockholder-minded, and its adoption of this program, considering the folkways of financing, must be regarded as totally understandable. But the substance of the program is out of Alice in Wonderland. In 1976, AT&T paid $2.3 billion in cash dividends to about 2.9 million owners of its common stock. At the end of the year, 648,000 holders, up from 601,000 the previous year, reinvested $432 million, up from $327 million, in additional shares supplied directly by the company. Just for fun, let's assume that all AT&T shareholders ultimately sign up for this program. In that case, no cash at all would be mailed to shareholders, just as when Con Ed passed a dividend. However, each of the 2.9 million owners would be notified that he should pay income taxes on his share of the retained earnings that had that year been called a dividend. Assuming that dividends totaled $2.3 billion as in 1976, and that shareholders paid an average tax of 30% on these, they would end up, courtesy of this marvelous plan, paying nearly $700 million to the IRS. Imagine the joy of shareholders in such circumstances if the directors were then to double the dividend. We can expect to see more use of disguised payout reductions as business struggles with the problem of real capital accumulation. But throttling back shareholders somewhat will not entirely solve the problem. A combination of 7% inflation and 12% returns will reduce the stream of corporate capital available to finance real growth. And so, as conventional private capital accumulation methods falter under inflation, our government will increasingly attempt to influence capital flows to industry, either unsuccessfully, as in England, or successfully, as in Japan. The necessary cultural and historical underpinning for a Japanese-style enthusiastic partnership of government, business, and labor seems lacking here. If we are lucky, we will avoid following the English path, where all segments fight over divisions of the pie rather than pool their energies to enlarge it. On balance, however, it seems likely that we will hear a great deal more as the years unfold about underinvestment, stagflation, and the failures of the private sector to fulfill needs.
Addendum. A sidebar explaining who Buffett was, that's how unfamous he was in 1977, accompanied this article. Most of the details included there are now widely familiar, and we will not repeat them here. But we will report that Buffett's Berkshire holdings were then worth $35 million, and his blue chip stamps stake almost $10 million. And both of those companies were active investors as well. So why, the last paragraph of the box sensibly asked, does a man so gloomy about stocks own so much of them? Partly it's habit, Buffett answered. Partly it's that stocks mean business, and owning businesses is much more interesting than owning gold or farmland. Besides, stocks are probably still the best of all the poor alternatives in an era of inflation. At least they are if you buy in at appropriate prices. C.L. A small college scores big in the investment game. December 18, 1978. By Lee Smith. Grinnell College's remarkable Buffett-aided success with its endowment fund was a story not known nationally until Fortune published this article. The story describes an important component of this success: Grinnell's unorthodox purchase in 1976 of a television station in Dayton, and ends with Buffett's thought that it might be one hell of an asset to keep holding. But prices for stations continued to rise, and a short time later, Buffett was ready for Grinnell to exit. The station, bought only 4 years earlier for $12.9 million, only $2 million of that cash, the rest a non-recourse loan, was sold to Hearst in 1980 for $50 million. Joe Rosenfield, who persuaded Buffett to join the Grinnell board, stayed close to the college, an institution he loved, until his death in 2000. Buffett remained as active trustee until 1987 and a lifetime trustee until 2011. He meanwhile harbored some doubts about his board experience. What bothered him the most was that the outsized gains he and Rosenfield attained for Grinnell's endowment, multiplying it more than 60 times, seemed otherwise not to lead to much. Today, Buffett says, it was a fine school with 1,200 students when it had an $8 million endowment, and it was a fine school with 1,200 students when it had a $500 million endowment. To bring Grinnell up to date, in its 2011-2012 year, it had about 1,600 students, and its endowment was around $1.5 billion. CL.
Grinnell College has always been a little bit improbable. Its 90-acre campus sits on the edge of a typical mid-Iowa farm community, where the tallest structure in town is the grain elevator, and where a college might be expected to emphasize the animal husbandry and go easy on the humanities. Not Grinnell. It offers its 1,200 or so students a rigorous, traditional curriculum based on such staples as American colonial history, the poetry of John Milton, and an introduction to quantum theory. It has thus earned a reputation as one of America's fine liberal arts colleges. These days, Grinnell is surprising for quite another reason. The little school in the Corn Belt has managed its endowment fund so adroitly that the fund has doubled in the past 5 years to $37.5 million, and that appraisal is conservative. If all its assets were marked up to their true market value, the total would be closer to $60 million. New contributions to the endowment have amounted to only about $5.4 million. The fund has grown mainly because of the stunning appreciation of its assets. Even using the conservative valuation, appreciation, along with income, has yielded for the fund an average total return of 16.2% annually over the last 5 years. During that same period, college and university endowments in general have fared dismally. The median return for the 150 endowment funds tracked by A.G. Becker in that 5-year period has been a meager 1.7% annually. To accomplish what it did, Grinnell employed investment strategies and ventured into enterprises that educational institutions normally shun. For example, rather than tuck its eggs cautiously into a variety of conventional baskets in the equity and bond markets, Grinnell has not hesitated to stash a lot of eggs in 1 or 2 baskets or to take a flyer on a speculative issue. Its most unusual and dramatic move was to buy a commercial television station for $12.9 million. The trustees of Grinnell, unlike those of many other schools, have not relinquished day-to-day control of the endowment to a bank or an outside portfolio manager or even to a professional in-house manager. They have deliberately kept it in their own hands, or, more precisely, they have entrusted it to their finance committee, principally to 2 members of the committee who have demonstrated their fitness for the job by having previously accumulated considerable fortunes for themselves. One is Joseph F. Rosenfield of Des Moines, a retired attorney and active investor who was once chairman of Yonkers Brothers, a prosperous department store chain operating in 5 Midwestern states. The second key member of the committee is Warren E. Buffett. Buffett achieved considerable fame as the Omaha investor who parlayed a small stake from family and friends into an investment partnership that grew to a phenomenal average annual rate, 29.5% over a 13-year period, and was worth $100 million by the time he liquidated it and distributed the profits in 1969. Through his own holdings, he still controls a substantial number of companies, including financial institutions and newspapers. When Rosenfield, class of 25, joined the board in 1941, the endowment was worth only about $100 million. It included a few farms the school had inherited and $2,500,000 in securities. The first windfall came in the early 1950s when the school was left about $5 million in assets from the estate of oilman Fred Darby. A second boost followed in the early 60s when the Ford Foundation promised that if Grinnell could raise $4 million on its own, Ford would contribute $2 million. Grinnell raised the money, with $400,000 coming directly from the pocket of Joe Rosenfield. Rosenfield has continued to contribute to the school, and most of his donations have been placed in a special kitty within the endowment that has come to be known as the J.F. Rosenfield Fund. It is into this fund that he and Warren Buffett have dipped to take some limited risks with small amounts of money that would not have yielded very much if they had been left in the traditional blue-chip stocks and bonds. The two investors have been strikingly successful. The hypothetical share in the fund would have increased about 18-fold in the past 15 years. The Rosenfield Fund made its first spectacularly successful investment 10 years ago. Robert N. Noyce, one of the founders of Fairchild Semiconductor, was a Grinnell trustee and alumnus, having been a somewhat mischievous student who was once suspended for stealing a farmer's pig for a midnight barbecue. Rosenfield and another trustee, Chicago attorney Samuel R. Rosenthal, were far-sighted enough to recognize that Noyce's genius could be put to work for the college. "We told Bob that when he went into his own business, the college wanted part of it," Rosenfield recalls. And so, when Noyce left Fairchild in 1968 to form Intel, a company that would make tiny semiconductor memory chips for computers, he gave the college the opportunity to buy $300,000 worth of Intel convertible bonds. Rosenthal and Rosenfield each contributed $100,000. The final third came from the Rosenfield Fund. As Intel flourished, the school's investment increased in value about 46 times. The endowment fund converted the bonds and, over the years, has sold off most of its Intel stock at a profit of close to $12 million. It holds on to some 37,000 shares with a market value of about $2 million. Buffett is not a Grinnell alumnus. He attended the Wharton School and the University of Nebraska as an undergraduate, and later got a master's degree in economics from the Columbia University Graduate School of Business. He was persuaded to become a Grinnell trustee only because of Rosenfield, whom he had met through mutual friends. Although they are a generation apart, Rosenfield is 74 and Buffett is 48. The two are very close. And so, in 1968, at Rosenfield's request, Buffett joined the board. "Joe is not the kind of guy you can say no to," muses Buffett. "For one thing, he's the one guy I know who actually seems to take his net worth down with his contributions. Others just give to the limit of what's tax deductible." The two men consult frequently with one another, sometimes with other members of the Finance Committee, especially the chairman, 38-year-old Tom Hutchison, a wealthy Des Moines investment counselor, but rarely with the entire 32-member board. Buffett, in particular, is a loner, restless at the daytime board meetings that are held 3 times a year at the Grinnell Library, and impatient with committee proceedings. Buffett's and Rosenfield's investment strategies are similar, but one may be more enthusiastic about an idea than the other. During the Intel purchase, for example, Buffett stood quietly on the sidelines. "I wasn't against it," he explains, It's just that I don't understand the semiconductor business, and I don't go into businesses that I can't understand that my sister can't understand. Buffett is at heart a disciple of Benjamin Graham, under whom he studied at Columbia, and as such, he believes in seeking out an undervalued company and investing in it heavily. Buffett, in fact, carries the Graham philosophy even further than Graham himself. For Graham was willing to sell out when the price of the stock rose to what he considered its true value. Buffett prefers to buy stocks that he will want to hold indefinitely. These days, his notion of an ideal opportunity is to buy into a business for $100 million when it is really worth $2 million and will be worth $4 million in 5 years. Such situations, he acknowledges, are not easy to find. We don't have a lot of good ideas, he says, and therefore we don't do a lot of things. Buffett found Grinnell's main chance almost by accident in 1976. During a conference on newspaper economics in New Orleans, Thomas S. Murphy, chairman of Capital Cities Communications and a friend of Buffett's, mentioned to him over breakfast that Avco Corp was selling its television stations. Buffett would have been interested in buying a station for himself, or Berkshire Hathaway, a company he controls, were it not for a possible conflict of interest. Berkshire Hathaway owns 12% of the Washington Post Company. Any one owner is limited to 5 television stations, 7 if at least 2 are the less desirable UHF stations. The Post Company already owns 4 VHF stations. It was conceivable that, even though Berkshire's stock in the Post is not voting stock, the government would count a purchase of the Avco station by either Buffett or Berkshire in the Post's column, using up the Post's last bullet, so to speak. He was about to forget about the idea when, during a telephone conversation with Rosenfield, it suddenly occurred to him that a television station might be just the thing for Grinnell. Because of cash problems, Avco was willing to dispose of the stations, and so Grinnell was likely to acquire just the sort of solid, undervalued asset Buffett prizes. It was not unheard of for a college to own a television station. The leading commercial television station in New Orleans is a division of Loyola University. But it was extraordinary for a college to go out into a market and bid on one. The board went along, but there was so much delay while they discussed how they were going to finance the purchase that Grinnell lost out on its first choice, Avco's Cincinnati station, which Multimedia Incorporated bought for $16 million. Grinnell managed to salve its disappointment by quickly purchasing $350,000 worth of multimedia stock, which has since tripled in value. In the second attempt, aimed at Avco's Dayton station, Buffett decided simply to plunge ahead and worry about the financing later. He offered $12.9 million for station WLWD-TV2, an NBC affiliate, a price that represented about 2.5 times the station's gross revenues. Not overly generous in view of the fact that stations often sell for at least 3 times revenues. But Avco accepted. The station, housed in a converted roller skating rink just outside the Dayton city limits in Moraine, Ohio, is the number 2 station in a 3-station market. Grinnell changed the call letters to WDTN and formed a separate company, Grinnell Communications, to run it. The company pays corporate income taxes on its earnings, just as it would if it were owned by an organization run for profit rather than education. Grinnell Communications invested about $1.3 million in capital improvements, including $750,000 to double the height of its broadcast tower and thereby expand its audience. Running the station has presented little problem so far. Ray W. Coley, general manager of the station under Avco, has stayed on to operate it under Grinnell, and although the company's 6-member board is dominated by Grinnell trustees, they leave Coley and his staff pretty much alone. As the station was ultimately financed, the Rosenfield Fund supplied $2 million in equity and Grinnell borrowed the other $11 million, half from outside lenders and half from the endowment fund itself. The truly noteworthy aspect of the investment has been its impressive appreciation. Television stations in the top 50 markets, Dayton is number 46, have sold recently for as much as 4 times revenues. WDTN expects revenues of about $9 million this year, which means it likely has a market value in the neighborhood of $35 million, more than 2.5 times what the school paid for it. The value of the station is understated considerably on Grinnell's books. The original $2 million equity investment is shown at cost, along with about $5 million in debt still owed the endowment. Some of the debt has been paid off. That $7 million would rise dramatically if WDTN were accounted for realistically, at its market value less the $4.7 million debt still owed to the outsiders. The value of the endowment would then be closer to $60 million than the $37.5 million at which Grinnell appreciates it. Buffett believes there is no reason why even large schools with immense endowments cannot adopt the same strategy that he has applied at Grinnell, limiting the portfolio to relatively few areas. That certainly leads to some fascinating possibilities. What if Harvard had been able to acquire control of American Broadcasting Company at the start of 1978, when the market value of the stock was about $700 million, half the size of Harvard's endowment? As fanciful as the idea is, a $700 million investment in ABC would have given Harvard a commitment to broadcasting roughly proportional to Grinnell's. It seems highly unlikely that any large school is going to move quite as boldly as Grinnell. In fact, even some of Grinnell's trustees are beginning to worry about the imbalance of their portfolio. Paradoxically, the more WDTN appreciates in value, the more uneasy they get. Their discomfort is understandable enough. The station now accounts for somewhere around half of the real wealth of the endowment, and there is a question as to whether it is prudent for a fiduciary to permit such a concentration. I can envision a situation in which the value of the station goes down, says one Grinnell trustee, and a student brings a class action against us, claiming that his tuition would have been lower if we had sold the station. Buffett says that, of course, if the trustees want to sell the station eventually, it is their right to do so. Clearly, however, he would be reluctant to vote in favor of such a sale, at least for now. I am always re-evaluating things, he says, and pauses. But that's one hell of an asset. When Buffett looks into the future, he focuses not on the chance of a lawsuit, but on another possibility. He sees a school that owns perhaps a cluster of businesses worth 20 times more than the amount of the operating budget. With a 5% real return on that investment, the school could be perpetually funded by its endowment. A school, in short, with no tuition at all.
Berkshire's shareholder contributions. Departing from our largely chronological format in this book, we pair 2 articles that are related. The first, from 1981, describes a Buffett innovation through which Berkshire shareholders were able to designate charities to which the company made gifts. The second, published 22 years later, reports Buffett's decision to close down the program because it had angered the opponents of abortion, who believed it favored pro-choice charities. Their ire was certainly not based on the range of charities that received contributions. Among the designees in 2002, for example, were 790 schools and 437 churches and synagogues. Reporting those numbers in his chairman's letter, Buffett also addressed the abortion issue and said he thought Berkshire's shareholders were probably on both sides of it in roughly the same proportion as the American population. But both Buffett and his late first wife Susie, and also Berkshire's vice chairman Charlie Munger, another very large shareholder, were known to be pro-choice in their thinking. So the pro-life forces assumed that charities they didn't wish to see flourish, such as Planned Parenthood, were getting a disproportionate share of the total contributions. The Buffetts' contributions to, say, Planned Parenthood would have flowed through their foundation, of which I am a director. The pro-life opposition did not sway Buffett when the anger was aimed mainly at him and Munger. But it then began to be focused on a Berkshire subsidiary, Pampered Chef, and the independent consultants, mostly housewives, who sold its kitchen goods. It seemed unfair to Buffett that these women should lose their livelihood because of the Berkshire Contributions program, so he closed it down. Over its 22-year history, the program, a sort of charitable dividend, had dispensed $197 million and pleased many a shareholder. With the program's end, many Berkshire holders no doubt increased their personal gifts to charity. It seems likely, though, that these increases did not entirely offset the disappearance of Berkshire's contributions, and that total shareholder giving therefore declined. C.L. Shareholders Get to Vote on Charity, November 30th, 1981, by Lee Smith.
Unconscionable as it may seem, large corporations usually deprive their shareholders of the right to vote on which charities the companies give money to. Management decides where most of the dough will go. Employees get their say by using increasingly popular matching gift plans, but owners, for the most part, remain disenfranchised. That inequity for the people who hold equity has long bothered Warren E. Buffett, a noted investor and chairman of Berkshire Hathaway, Inc. So last month, Buffett gave Berkshire Hathaway's shareholders the right to distribute about $2 million to the colleges, churches, museums, social agencies, and other nonprofit organizations they believe in. I wouldn't want shareholders to write checks on my bank account for charities of their choice, he says. So I feel it inappropriate to write checks on their corporate bank account for charities of my choice. As Buffett sees it, most corporate managers give reflexively to whatever causes their peers support. Buffett, 51, is one manager who goes his own way. Barely out of college, he formed a partnership with friends and relatives and raised $100,000. Adding new capital from time to time, he ultimately parlayed the fund into $100 million in the stock market. In 1965, he took over and reorganized Berkshire Hathaway, which controls, among other things, See's Candies, Blue Chip Stamps, and a dozen insurance companies. It also owns 5% of General Foods and 13% of the Washington Post Company. Earnings are sizable, $53 million, or 51.72 cents a share last year. The stock currently sells over the counter for around $500 a share. Berkshire Hathaway hasn't paid a dividend since 1967, but net worth has grown an average of 20% a year. Despite its wealth, the company has given relatively little to charity, $200,000 or so a year. That's little more than 2% of 1980's pre-tax profits versus contributions averaging 1% for U.S. companies in general. Buffett was tight-fisted because he didn't know how to improve on the methods other big corporations used to choose recipients. His new scheme, he thinks, is both fair and practical. It imitates closely held corporations that poll shareholders on their preferences. But instead of polling a dozen or so shareholders, Buffett is contacting 1,500. The ballots go in the mail this month. With some 1 million shares outstanding, each share gives its owner the right to allocate $2 to charity. A shareholder with 1,000 shares, in other words, can instruct the company to send out $2,000. The most important shareholders by far will not have to be polled. Buffett and his wife own 47% of the company and will be able to assign $935,000 to their favorite charities. The money will go initially to the Buffett Foundation, established 15 years ago, and then to organizations promoting birth control. Buffett's plan has tax advantages. Berkshire Hathaway could pay shareholders dividends, which they, in turn, could pass along to charity. But before profits are distributed to shareholders, they are taxed. Corporate charitable contributions, on the other hand, are treated as business expenses and are not taxed. So, every dollar that leaves Berkshire Hathaway's coffers, more goes to charity and less to the taxman. At first glance, Buffett seems to be inviting a blizzard of paperwork that will bury the 5-member staff at his 4-room corporate office in Omaha. Buffett's shareholders will send in forms giving the names and addresses of up to 3 charities to receive contributions. If a designated recipient is not obviously tax-exempt under Internal Revenue Service rules, Buffett's staff will ask for proof. What's obviously a charity to a widow in Winnetka might not be so obvious to Buffett. The staff will also have to verify the number of shares owned, make out the checks, and mail them, along with notes explaining that the gifts are being sent at the shareholder's request. Each shareholder must swear that the gift fulfills no other pledge he has made, or the IRS could treat the money as a dividend and increase Berkshire Hathaway's taxes accordingly. Despite these complications, Buffett says the paperwork shouldn't amount to much more than the minor storm of proxy votes for an annual meeting. If I'm wrong, he says, I'll be down here working Saturdays and Sundays. The contributions made in shareholders' names could reduce Berkshire Hathaway's net income by $1 million or more. Assuming a 46% tax rate, the effect of giving away $2 million is to cut after-tax profits by $1,080,000. But not all the charity money will be spoken for. Stock held in street names for customers by brokerage houses and other institutions can't be voted, and some individuals won't bother to vote or may prefer that the money not go to charity. Unallocated funds will be returned to corporate earnings. After sizing up the immediate reaction, Buffett estimates that many as 85% of the shareholders will respond. There's a lot of enthusiasm, he says. I know of one elderly woman who is very religious, but doesn't have much income and can give only $5 a month to her church. She has quite a bit of our stock, so she'll now be able to give $60 or $70 a month. Buffett's plan is similar to, but less problematical than, a proposal by Robert A. Sproul, president of the University of Rochester, who has come up with a scheme by which a shareholder could send a gift to charity nearly double the size of his dividend at no additional cost to anyone, except the U.S. Treasury. The shareholder would tell the company that he would forego, say, his $100 third-quarter dividend if the company would send that amount, plus whatever income tax would have been paid on those earnings, to the American Red Cross, the University of Rochester, or some other charity. As Sproul reckons it, a corporation paying 46% of its earnings in taxes shouldn't care whether it sent $185 before taxes to charity or a $100 dividend to a shareholder and $85 to the government. Ingenious though it is, Sproul's plan is illegal. Senator Daniel Patrick Moynihan is trying to persuade Congress to legalize the plan, but he isn't likely to have much success, given current concern about the deficit. Corporations, moreover, seem lukewarm to the idea. AT&T, for one, is concerned that it might compete with a system under which its shareholders may automatically reinvest their dividends in stock. In 1980 alone, Ma Bell raised almost $1 billion through dividend reinvestment. Whether Buffett's plan will be imitated remains to be seen. Many corporations have far more shareholders than Berkshire Hathaway, but they also presumably have larger staffs to handle the paperwork. Several corporations to which Fortune explained the idea thought it imaginative, but had reservations. One contributions manager feared a shareholder backlash against giving corporate money to religious organizations, where much of Berkshire Hathaway's is almost certain to wind up under Buffett's plan. Churches receive over half of all contributions made by individuals. To avoid controversy, most corporations give only to secular organizations. In at least one significant sense, Berkshire Hathaway is an unusual company for which Buffett's plan is particularly appropriate. Buffett says it has no important corporate goals that could be advanced by directing $2 million to charities of the management's rather than the shareholders' choice. Other corporations do have such goals. Companies that hire engineers give money to engineering schools, hoping to stimulate research and attract graduates. Oil companies contribute to public television partly to persuade people in general and legislators in particular that they are responsible citizens and not simply collectors of obscene profits. Still, many companies might well follow Berkshire Hathaway's example, especially those with strong profits, few public relations problems, and a charitable impulse. Buffett has had good ideas about philanthropy before. Several years ago, he advised Grinnell College in Iowa to invest some of its endowment in a TV station, an unconventional choice for a school. Grinnell bought a station in Dayton for $12.9 million and sold it for $50 million 2 months ago. So when Buffett wanders off on his own, it makes sense to watch where he's going.
Berkshire Gives Up on Giving, August 11, 2003, by Nicholas Varcheva.
Warren Buffett has drawn criticism in the past for supporting pro-choice causes, but it never affected Berkshire Hathaway's charitable giving, that is, until Cindy Coughlin, a 34-year-old stay-at-home mom in Peoria, Arizona, came along. Now, as a result of her campaign against pro-choice donations, the most powerful man in business has terminated Berkshire's entire contribution program, which distributed nearly $200 million over the past 2 decades to institutions ranging from schools to groups on either side of the abortion debate. The unusual program, call it a charitable dividend, allowed Berkshire shareholders to designate $18 per share annually for up to 3 charities of their choosing. Some shareholders, including Buffett, via his foundation, use the mechanism to give to pro-choice causes such as Planned Parenthood. Fortune editor-at-large Carol Loomis is a director of the Buffett Foundation. The events were set in motion this winter by Coughlin, a mother of 3, who wanted to earn some money by selling for the Pampered Chef, a recent Berkshire acquisition with $740 million in revenues. Some 70,000 freelance consultants sell kitchenwares through Tupperware-style parties in people's homes. Coughlin says she was drawn to the Pampered Chef because she felt it shares her Christian pro-family values. The company's mission statement, for example, encourages people to develop their God-given talents. But Coughlin was dismayed to learn that Berkshire's purchase of the Pampered Chef meant that some portion of the profits she'd generate could fund pro-choice groups. She emailed a petition, which asked Berkshire and Buffett to end donations to such organizations to 100 friends and family in January. Pro-life organizations such as Life Decisions International began publicizing it. Pampered Chef chairman Doris Christopher initially told consultants in an April email that though my personal views on some issues differ from Warren Buffett's, it is not my place to ask or to judge. But her message didn't quell the furor. Consultants were resigning, says Coughlin, and customers complaining. Coughlin numbers the petitioners at less than 1,000. By late June, the pressure had become intolerable, and Christopher, went to Warren with a heavy heart, according to an email she wrote to consultants. It troubled him deeply that charitable donations from Berkshire Hathaway were causing you difficulty. On July 3rd, Berkshire announced the end of the charity program. Before this year, Berkshire seemed impervious to such pressures. Pro-life activists had picketed its annual meetings and boycotted it for years. Last year, a shareholder resolution to cancel the charity program was soundly defeated, with 97% of shares voted against it. And Buffett defended the program in Berkshire's 2001 annual report, saying Berkshire makes no contributions except those designated by shareholders who are probably on both sides of the abortion issue in roughly the same proportion as the American population. So why did Berkshire abandon the program now? The company's announcement said that its ownership was now harming not only a subsidiary but also individuals. The board was willing to accept some damage from boycotts in the past because the cost was diffused across a giant corporation, but this was affecting pampered chef consultants who had nothing to do with Berkshire's policy. For her part, Coughlin is just delighted with the decision. But she says she won't be satisfied until the man she deferentially refers to as Mr. Buffett stops donating to pro-choice causes. Now, she says, the focus is on him.
Letters from Chairman Buffett, August 22, 1983, by Andrew Tobias. Buffett has written the chairman's letter in the Berkshire Hathaway annual report since 1966. But 10 years later, he served on a Securities and Exchange Commission panel studying how companies could improve their shareholder communications. And by the 1977 annual report, he was ready to renovate his own annual letter. The changes he made were gradual. By the early 1980s, though, his letters stood out for their intellectual content, humor, and individuality, and they began to attract wide attention. Fortune then determined to do a story, visualized as a kind of book review about the letters. I was not a logical candidate to be the writer because as the date drew near for the 1977 annual report, Buffett, then a friend of mine for around 10 years, asked me to weigh in with suggestions for his largely finished letter. My memory is that I advised changing a "the" to an "a." Since that time, I have been his pro bono but attentive editor. I will admit to intensifying my suggestions a lot since the 1977 letter, but the drill has never changed. He writes, I edit, and, alas, sometimes lose arguments about how a sentence should go. With my opting out of doing the 1983 article, Fortune turned to an outside writer, Andrew Tobias, who had almost come to work for the magazine several years earlier, our loss that he didn't, but who had instead embarked on a brilliant career of writing books, The Only Investment Guide You'll Ever Need, and freelance articles. Tobias says that when a Fortune editor called him about doing this piece, he had never heard of this guy, Buffett, who was said to have an almost cult following. Tobias then proceeded to do an article, far more than a book review, displaying his own humor and individuality. And did he next buy Berkshire stock, then selling around $1,000 a share, versus around $130,000 recently? Tobias answers, I tell people endlessly that Berkshire was the worst investment I ever made, for not making it. If I'd just taken the $1,500 that I remember Fortune paying me for the article, added a few dollars, and bought 2 shares, well, Tobias had the view back then, he says, that the stock was a little ahead of itself, and that when it dropped back a bit, he'd buy. He recalls thinking the same thing when the stock was $10,000 and $30,000. A redeeming fact is that Tobias and Buffett became good friends. drawn together not only by their conversations about this article, but also their mutual interest in supporting Democratic candidates. CL.
Berkshire Hathaway shareholders have come to expect two things of their annual report. Good news, book value has increased from $19 to $737 per share in the last 18 years, and the unorthodox letter of their chairman, Warren Buffett, who took over 18 years ago. Indeed, the chairman's letter practically is the Berkshire Hathaway annual report. Shareholders get no photographs, no colored inks or foil embossing, no bar charts or graphs, not even a logo. It looks like the kind of annual you see from a company whose bubble has finally burst. Only Berkshire Hathaway, an insurer with major holdings in several other industries, is no bubble. And at $955 a share, up from $85 6 years ago, it shows no signs of bursting. The conventional wisdom in reading annual reports is to glance at the auditor's opinion, then check the financial results and the footnotes. The chairman's letter? Save your time. Yet of such interest are Warren Buffett's letters that they have drawn a sophisticated following, requests for reprints even. The company has assembled a compendium of the past 5 to meet the demand. They're wonderful, says Leon Levy of Odyssey Partners, no minor Wall Street legend himself, whereupon he recounts the passage in the last letter that most amused him, the one in which Buffett says he wouldn't have wanted any part of the acquisitions most others were making in 1982. For in many of these acquisitions, Buffett writes, managerial intellect wilted in competition with managerial adrenaline. The thrill of the chase blinded pursuers to the consequences of the catch. Pascal's observation seems apt. It has struck me that all men's misfortunes spring from the single cause that they are unable to stay quietly in one room. Your chairman left the room once too often last year and almost starred in the acquisition follies of 1982. In retrospect, our major accomplishment of the year was that a very large purchase to which we had firmly committed fell through for reasons totally beyond our control. Had it come off, this transaction would have consumed extraordinary amounts of time and energy, all for a most uncertain payoff. If we were to introduce graphics to this report illustrating favorable business developments of the past year, 2 blank pages depicting this blown deal would be the appropriate centerfold. I love that, beams Levy. Buffett himself says he tries to talk to shareholders as if they were his partners. I assume I've got a very intelligent partner who has been away for a year and needs to be filled in on all that's happened. He also assumes a little turnover among his 2,000 shareholders. Rather than repeat the same things each year, he says, I take up topics that further their education. It is an exercise he seems clearly to enjoy. The letters, currently running around 12 printed pages, get longer every year. The other extreme may have been reached last year by Wisconsin banker Jack Pulisher, another iconoclastic CEO, whose letter to Marshall and Ilsley shareholders read in its entirety, Your company had a very good year in 1982. Some of it was due to luck. Some of it was due to good planning and management. We hope you enjoy the numbers and the pictures. Buffett's attention to his letters was sharpened by his service on an SEC panel formed in 1976 to study disclosure practices. The committee issued a 1,200-page document that concluded the disclosure system was basically sound. Former SEC Commissioner A.A. Sommer, Jr., who chaired the committee, himself a Berkshire Hathaway shareholder, says the group felt such letters were very important. Even so, he adds, Warren's letters are unique. Damn few CEOs are as smart in as many ways as Warren. It would be awfully hard to require that kind of discussion from all CEOs. Does Buffett ever take on unorthodox subjects in his letters? Yes, he responds. He discusses his mistakes. The textile business again had a very poor year, he reported in 1977. When Buffett first took over Berkshire Hathaway in 1965, that's all it was, a New Bedford, Massachusetts textile manufacturer. We have mistakenly predicted better results in each of the last 2 years. Many difficulties experienced have been due primarily to industry conditions, but some of the problems have been of our own making. We continue to look for ways to expand our insurance operation, he wrote his shareholders in 1979. But your reaction to this intent should not be unrestrained joy. Some of our expansion efforts, largely initiated by your chairman, have been lackluster. Others have been expensive failures. Buffett downplays the excellence of his own efforts, but like a proud coach, highlights it in his players. Berkshire Hathaway owns a big chunk of Geico, the auto insurer, and of that company's brass he writes, Jack Byrne and Bill Snyder are achieving the most elusive of human goals, keeping things simple and remembering what you set out to do. And of an 81-year-old subsidiary chief, since deceased, our experience has been that the manager of an already high-cost operation frequently is uncommonly resourceful in finding new ways to add overhead, while the manager of a tightly run operation usually continues to find additional methods to curtail costs, even when his costs are already well below those of his competitors. No one has demonstrated this latter ability better than Gene Abegg. Here and there notes of sentimentality pop up, but if Buffett wants to say something a little silly about the Washington Post Company for which he delivered papers at the age of 13, or Geico, which first caught his eye at 20, it should be remembered that Berkshire's holdings in the one have risen in value from $11 million to $103 million, and in the other from $47 million to $310 million, both in under a decade. So he can say what he likes. Happily, he says it with a sense of humor. In a characteristically rash move, he writes, we have expanded world headquarters by 252 square feet, 17%. Coincidental with the signing of a new 5-year lease. World headquarters, in Omaha, houses, in addition to Buffett, 5 other people. A compact organization lets all of us spend our time managing the business rather than managing each other. Most chairmen's letters describe how well everything went under the circumstances, hoping the shareholders will buy it. Buffett's stress the negative, knowing that they won't. In the most recent report, immediately after observing that Berkshire Hathaway's 18-year rise in book value represents a 22% compound annual rate of growth, he adds, you can be certain that this percentage will diminish in the future. Geometric progressions eventually forge their own anchors. He's right, of course. Maintaining that rate for another 18 years would mean growing in book value to $22 billion, and after 18 years more, to nearly $1 million per share. Even when stating the paper gains in the Berkshire Hathaway portfolio, up 40% in 1982, he is careful first to subtract the taxes that would be paid if those gains were taken. To be sure, it's easy to be candid and self-deprecatory when any fool can see that you're terrific. What may be a tad galling to some of his peers is that Buffett's letters review not only his own performance and mistakes, but those of the rest of the nation's managers as well. There are indications, he writes, that several large insurers opted in 1982 for obscure accounting and reserving maneuvers that masked significant deterioration in their underlying businesses. In insurance, as elsewhere, the reaction of weak managements to weak operations is often weak accounting. His recurring theme, the rights of shareholders as trampled on by so many other managers. Well known are the corporate managers who fight heroically to fend off generous tender offers. Less sharply perceived are the managers who pay too much to grow by acquisition. Managers who want to expand their domain at the expense of owners, Buffett chides wryly, might better consider a career in government. It's even worse, in his view, when the acquisition is made with stock, because the acquirer's stock so often sells in the market for a discount to its true value. The acquirer who nevertheless barges ahead is using an undervalued currency, his stock, to pay for a fully valued property. Friendly investment bankers will reassure him as to the soundness of his actions. Don't ask the barber whether you need a haircut. In light of the enormous premium required to buy all of a company, Buffett's strategy has been one of partial acquisition. Where another company will bid $48 a share for all of a company whose shares were yesterday selling at $25, Buffett is content to buy quietly at $25. What really makes us dance, he admits, is to buy 100% of a business at a good price, but that is awfully hard to do. And so it is that at year's end, Berkshire Hathaway owned, among other holdings, chunks of blue chip stamps, 60%, Geico, 35%, General Foods, 4%, precious metals fabricator Handy and Harman, 17%, R.J. Reynolds, 2.7%, Interpublic, 15%, Ogilvy and Mather, 9%, Time Inc., publisher of Fortune, 2.7%, and the Washington Post Company, 13%. Berkshire Hathaway's reported earnings include its share of the earnings at Blue Chip Stamps, which it is merging with, but only the dividend income from the other companies in its investment portfolio. So Buffett must each year remind shareholders that reported profits exclude a large portion of its true earning power. This is not a criticism of accounting procedures, he hastens to add. We would not like to have the job of designing a better system. It's simply to say that managers and investors alike must understand that accounting numbers are the beginning, not the end, of business valuation. Lamenting the complexities of accounting, he reveals that the Yanomamo Indians employ only 3 numbers, 1, 2, and more than 2. Maybe their time will come. Because of the growing importance of the company's non-consolidated holdings, Buffett argues, it's no longer appropriate for shareholders to gauge Berkshire's performance by the ratio of reported earnings to equity, as, until recently, he had been advising they should. But then he adds, you should be suspicious of such an assertion. Yardsticks seldom are discarded while yielding favorable readings, but when results deteriorate, most managers favor disposition of the yardstick rather than disposition of the manager. To managers faced with such deterioration, a more flexible measurement system often suggests itself. Just shoot the arrow of business performance into a blank canvas and then carefully draw the bullseye around the implanted arrow. We generally believe in preset, long-lived, and small bullseyes. One of the bullseyes he considers notably unimpressive is the widely trumpeted achievement of record earnings. After all, he explains, even a totally dormant savings account will produce steadily rising interest earnings each year because of compounding. It's no surprise that Buffett would champion shareholders' rights. At 52, he has long been a professional shareholder himself. He and his wife own shares in Berkshire Hathaway recently worth $460 million, and Berkshire Hathaway is itself largely in the business of owning shares. Author Jerry Goldman in Supermoney labels Buffett easily the outstanding money manager of the generation, noting that a partnership he began in 1956 and had the consummate foresight to close down in 1969 achieved a compound annual growth of 31%. What was more remarkable, writes Goodman, was that he did it with the philosophy of another generation. just pure Benjamin Graham, applied with absolute consistency. The late Benjamin Graham, of course, authored The Intelligent Investor, in print almost continuously since 1949. Buffett chose Graham as a mentor, and, years later, Graham chose Buffett to help revise his book. Although Graham and Buffett did not agree on all things, their common perception was to buy assets so cheaply that, over time, they could hardly fail to profit. This approach calls for a level head and hard work. The market, like the Lord, Buffett writes, helps those who help themselves. But, unlike the Lord, the market does not forgive those who know not what they do. Buffett's strategy of partial acquisition makes sense. When companies are selling in the marketplace at a substantial discount to their true value as ongoing businesses, but not when the market, as it periodically does, jumps over the moon. In 1972, with Avon and the rest selling at 60 times earnings, Berkshire had only 15% of its portfolio in equities versus 80% at the end of 1982. There were as many good businesses around in 1972 as in 1982, he writes, but the prices the stock market placed upon those businesses in 1972 looked absurd. Should the stock market keep climbing, he warns, Berkshire's ability to utilize capital effectively in partial ownership positions will be reduced or eliminated. We currently are seeing early traces of this problem. Damn, another bull market. One problem all Buffett's letters address is the state of the property casualty insurance industry, his core business. For much of this century, he writes, a large portion of the industry worked, in effect, within a legal quasi-administered pricing system fostered by insurance regulators. While price competition existed, it was not pervasive among the larger companies. That gentlemanly day, says Buffett, is gone. Although parts of the old structure remain, the new capacity is not reluctant to use price as a prime competitive weapon. Indeed, it relishes that use. In the process, customers have learned that insurance is no longer a one-price business. They won't forget. It is Buffett's plan to live with low volume while he waits for the shakeout that will cause prices to firm. He is less confident, letter after letter, of the prospects for the textile industry, a capital-intensive commodity business in which periods of tight supply, and hence decent prices, come around only rarely, and then last only the better part of a morning. Out of loyalty to his employees, however, and perhaps out of a certain nostalgia for Berkshire's roots, Buffett steadfastly refuses to abandon his business. Such behavior might seem to flout the interests of Berkshire shareholders. Only with 47% of the company stock, Buffett is able to summon a majority vote for his policy, or any other, practically all by himself. Even so, he assures his shareholders it's not the kind of business he is eager to enter in the future. Among the final notes in Buffett's letters is a virtual "businesses wanted" classified. It tells a lot about how Warren Buffett operates. Berkshire Hathaway, Buffett writes, is looking for large, simple businesses. If there's a lot of technology, we won't understand it. With consistent earning power, little debt, management in place, we can't supply it, and an offering price. We don't want to waste our time or that of the seller by talking, even preliminarily, when price is unknown. We will not engage in unfriendly transactions. We can promise complete confidentiality and a very fast answer as to possible interest, customarily within 5 minutes. To write an interesting chairman's letter, it helps if you are a chairman with interesting ideas. Buffett's is a refreshing style, in business as in prose.
From Can You Beat the Stock Market? December 26, 1983. An excerpt and a sidebar from an article by Daniel Siegelman. The Efficient Market Hypothesis, EMH, as this article incisively says, holds that the stock market cannot be beaten by mere mortals. To all those believing in EMH, therefore, Buffett's long record in successfully picking stocks was, at the very least, discordant. The usual reaction of the believers was to describe Buffett as just lucky, extraordinarily, damnably lucky. As Buffett's fame grew, however, he came to be viewed as an anomaly, an investor whose superb record could just not be explained away by chance. This development did not thrill Fortune's Dan Siegelman, who wrote this article. A mentor and close friend of mine, Siegelman was intellectually drawn to EMH, a leaning he discloses in the article, and much preferred that it be proved right. But his honesty and news sense told him there was a fine, unreported story here, and he proceeded to write it. We have not reprinted the entire article, only its beginning and a core section, and an accompanying sidebar that describes Buffett and his three longtime friends, Charlie Munger, the late Bill Ruan, and the late Walter Schloss. The full story is available online. But beware that it basically describes a relic, since EMH has largely been assigned to the dustbin. There was an important postscript to the article, a May 1984 debate about EMH, staged by Columbia University and pitting Buffett against a well-known business school academic, University of Rochester finance professor Michael Jensen. Speaking first, Jensen expressed his strong belief in EMH, gave his reasons cogently, and then ended with a specific reference to Fortune's article, an excellent review of EMH, he said. But it would be wrong, he contended, to think that the standout investment records of Buffett and the other three men were undeniably attributable to skill. Statistically, he said, citing coin-flipping probabilities, the records could just as easily have been compiled by luck. Not so, said Buffett, realizing he'd been given a lift-off into the very argument he had planned to make. To himself and the three other investors named above, Buffett added 5 more coin flippers, calling this group of 9 the super investors of Graham and Doddsville. All 9, he explained, describing each, had a common intellectual father, famed investor and author Ben Graham, who believed that investors should search for discrepancies between the value of a business and the price of small pieces of that business in the market. These 9 investors, however, said Buffett, had produced their records in widely different ways, with very few stocks duplicated among their portfolios. In other words, they were residents of the same intellectual village, but varied in how they plied their trade. To call their superior records luck, said Buffett, would be absurd. Attending that debate, I felt that Buffett had decisively bested Jensen, a conclusion that indeed became the consensus about the event. Buffett himself feels that of all the written and oral presentations he has given, this one was the most logically reasoned and therefore the best. The super investors of Graham and Doddsville can be accessed on the Internet. C.L.
Most people interested in the stock market fall into one of 3 categories. 1. Academic scholars who doubt anybody really knows how to beat the market. 2. Professional investors who indignantly reject this view of the matter. And 3. Amateur investors who also believe that you can beat the market, but don't realize how controversial this assumption is. I have long been a partisan of the first group, and, until the last year or so, had assumed that its case was airtight. The professors seem to have built an overwhelming case for the so-called efficiency market hypothesis, EMH. If you think of the hypothesis as a literal description of the real world, the stock market cannot be beaten by mere mortals. Question: how close to reality is EMH? Having now resurveyed the basic case made for it in the business schools and also looked at some recent findings that seem inconsistent with it, I find myself answering that EMH is extremely useful for understanding the stock market, but doubting that it's as close to reality as I had previously assumed. It seems fairly clear that some superior investors are out there beating the market systematically. Like many other EMH fans, I have been shaken by the proliferation of anomalies, this being the professor's preferred term for stock market news that seems to confound the hypothesis. One disturbing anomaly centers on the extraordinary records compiled by certain high-visibility investors. The records of one tightly knit group of investors of whom Warren Buffett is the best known are laid out below. Buffett is very much aware of the extent to which his investment record constitutes a challenge to the efficient market hypothesis. He believes that there are exploitable pockets of inefficiency in the market, and he has at several times argued his case in appearances at the Stanford Business School, on whose advisory council he serves. Speaking to the council, Professor William F. Sharp of Stanford, one of the school's academic stars and the author of a popular textbook solidly endorsing EMH, once referred to Buffett as a 5 sigma event. In business school lingo, this superlative signifies that you should think of his investment performance as being 5 standard deviations above the mean. If literally true, no one claims that it is, this should tell us that there is only about 1 chance in 3.5 million of compiling an investment record like Buffett's by chance. You Only Swing on 3-0, a sidebar by Daniel Seligman. In principle, says the efficient market hypothesis, no one can systematically beat the stock market. In applying EMH to Warren Buffett, Charles Munger, William Ruane, and Walter Schloss, you would have 3 difficulties. 1. All have outperformed the market over long periods. 2. They have generally done so in both bullish and bearish environments, so it's hard to argue that their higher returns simply reflect greater risk-taking. And 3. All are pursuing strategies that reflect the ideas of the late Benjamin Graham, so it's hard to view their performance as a random event. Buffett, Ruane, and Schloss all studied under Graham, and all 4 have been influenced by his classic security analysis written with David L. Dodd and first published in 1934. Graham's core idea: look for companies that for some reason are undervalued and hold the stocks for as long as it takes the market to see the values. Obviously, such companies are hard to find. Says Buffett, you wait for the 3-0 pitch. Prize example of what you get by waiting? The Washington Post Company in 1974, when its market value was $80 million, and its TV stations alone were worth more than that. Now its market value is about $1 billion, and Buffett's Berkshire Hathaway owns 13%. Buffett himself has not formally been in the money management business since 1969, when he dissolved the Buffett Partnership Limited after nearly 14 years of operation. One reason for the dissolution? Buffett had stopped finding undervalued securities. During its lifetime, the partnership had an annual average return of 29.5% versus 8.2% for the S&P 500. Like the figures below, these assume annual reinvestment of dividends. Charles Munger's partnership, Wheeler, Munger & Company, operated from 1962 to 1975. It had an average return of 19.8% versus 5.3% for the S&P 500. Bill Ruane runs the immensely successful Sequoia Fund, which was first offered to the public in July 1970, and since then has had an average return of 18.6% versus 10.6% for the S&P. Sequoia now has $333 million of assets and has suspended sales to new investors because, says Ruane, the money was coming in faster than I had ideas. The private partnership run by Walter Schloss since 1956 has had an average return of 21.3% versus 8.7% for the S&P. In a recent sentimental letter to his partners, Schloss saluted Graham and security analysis, which helped many of us along a rocky road.
Buffett and Capital Cities ABC. The acquisition of American broadcasting companies by Capital Cities Communications in 1985 and Berkshire's involvement in the deal was a combination and investment that Buffett liked from the beginning, particularly because it put him into business with his longtime friend, Cap Cities chairman Thomas S. Murphy. The deal did not disappoint. Cap Cities ABC flourished and in 1996 was bought by Walt Disney Company, with Berkshire more than quadrupling its original investment. Here are 4 Fortune excerpts that describe key moments along the way. CL. From Capital Cities' Capital Coup, April 15, 1985. An excerpt from an article by Stratford Sherman.
Buffett says of Murphy, "I think he is the top manager in the U.S." No slouch as a manager himself, Buffett has placed a substantial part of his future in Murphy's hands. Buffett helped bring off the friendly acquisition by agreeing to buy about 18% of the merged company Capital Cities ABC Inc. for $518 million. More extraordinary, Buffett agreed to vote with management for 11 years on condition that either Murphy or President Daniel Burke be in charge, and accepted severe limitations on his freedom to buy and sell the stock.
From Merger Fees That Bend the Mind, January 20, 1986, by Peter Petrie.
Faced with towering investment banker fees, some corporate chieftains play do-it-yourself. Successful do-it-yourselfers tend to be financiers with extraordinary talent for sizing up a transaction. One of these faced down 2 of Wall Street's most famous gunslingers. Warren Buffett stepped in last March on behalf of Capital Cities Communications in its effort to acquire American broadcasting companies. He went into negotiations assisted by merger lawyer Martin Lipton of the law firm Wachtell, Lipton, Rosen & Katz. Across the table were Bruce Wasserstein, co-director of First Boston's Mergers and Acquisitions Department, and takeover specialist Joseph Flom of the law firms Skadden, Arps, Slate, Meagher, and Flom. As the 2 sides neared an argument, the professional deal-makers held out for more. "Buffett is so smart," remembers Wasserstein, "that you had to be careful to avoid being picked." As the deal-maker tells it, he and Flom demanded that Cap Cities sweeten its cash offer for ABC with stock. But Buffett, who was not to be pushed far, finally closed by throwing in some small change, a thin veneer of warrants that raised the deal's value by perhaps 3%. Buffett has declined to comment.
From The Inside Story of Time Warner, November 20, 1989, by Bill Saporito.
In the mid-'80s, Time Inc. CEO J. Richard Monroe saw a way to attack all of his big problems: hook up through acquisition or merger with another media giant. In the fall of 1988, Warren Buffett came by with his friends from Capital Cities ABC, in which he was a major investor. Monroe and Time Inc. President Nicholas J. "Nick" Nicholas Jr. met with Buffett and Cap Cities CEO Thomas Murphy and President Daniel Burke. The meetings continued into December until, according to Nicholas, Murphy mentioned that in any deal there should be 1 or 2 more Cap City directors than Time directors. Monroe says he told Murphy, a good friend, "Thank you very much, but Time Inc. is not for sale." A Cap Cities source says the 2 men couldn't agree on who would be boss. Time had rebuffed Buffett before. In 1984, He had asked Monroe informally about acquiring up to 10% of Time Inc.'s stock, enough to frighten a raider. Buffett's practice with other large stockholding is to hang on to them for years or decades and become a trusted board member and advisor. But when Monroe took Buffett's feeler to the Time Inc. board, the directors, to Monroe's regret, discouraged him from pursuing it.
From Buffett to Disney, all thumbs up. April 1st, 1996. By Carol Loomis. Just in from Omaha and making a do-it-yourself delivery, Berkshire Hathaway chairman Warren Buffett strolled into the downtown Manhattan offices of Harris Trust on March 5th and handed 2 envelopes to a Harris officer. In envelope number 1 was stock worth, gulp, $2.5 billion, Berkshire's 20 million shares of Capital Cities ABC, being delivered to the company's purchaser, Walt Disney Company. In envelope number 2, sealed and marked "Do not open until 4:30 p.m. on March 7," were Buffett's wishes, kept secret even from the managements of Disney and Cap Cities, as to how he wanted Berkshire to be paid for the contents of envelope number 1. Like any ordinary Cap Cities stockholder, Buffett had the option of taking the standard package, which was Disney stock plus cash, or requesting all stock or all cash. And the envelope, please? Giving Disney a huge thumbs up, Buffett asked for stock only. Talking to Disney CEO Michael Eisner late on the 7th, Buffett said he had paid the company and its boss his ultimate compliment by entrusting them with Berkshire's money. Eisner assured Buffett he'd work to make the decision right. In Berkshire's 1995 annual report, due out momentarily, Buffett will acknowledge that he is returning to the scene of an investing crime. Attracted to Disney in 1966 by its film library, its burgeoning theme park business, and its peanut gallery stock price, the market capitalization of the entire company was less than $90 million. Buffett invested a large chunk of Buffett partnership money in the stock at a split-adjusted price of 31 cents a share. The stock recently sold for $65. But did Buffett hang around for the ride? No. He sold out in 1967 at 48 cents a share. Oh well, says Buffett, with surely a wince, it's nice to be back. Editor's note: back, yes, but not for long. For a time, true, Buffett liked Disney, even adding shares to the large Disney stake that Berkshire received when the deal closed. But then Disney went through a period of management turmoil. Frank Wells died. Michael Ovitz failed as a manager. And Buffett turned thumbs down on the investment. By 1999, Berkshire was completely out of Disney. The full text of the 4 Cap Cities articles excerpted is available at fortune.com/BuffettBook. From Beating the Market by Buying Back Stock, April 29, 1985. An excerpt from an article by Carol Loomis. Making a groundbreaking study of stock buybacks, Fortune found that, on average, large benefits accrued to the stockholders of companies buying insignificant quantities of their own stock. This article also presented many pro and con opinions, some of them Buffett's, about repurchases. Buffett was then, as now, a fan of managements who bought in stocks for the right reason, because they knew their stocks to be undervalued. Conversely, he has always disdained managers who buy because they are trying to prop their stock or counteract the effects of stock options, which tend to shovel new shares into the market. The only reason for a company to repurchase its stock, Buffett has often said, is because it is selling for less than it's worth. Buffett's views about repurchases sometimes have drawn perplexed, or even indignant questions at Berkshire annual meetings because he has not appeared to be practicing what he preaches. Why, shareholders would ask, had not Berkshire itself repurchased shares when they were undervalued? In 2009, in fact, one questioner virtually quoted from this article, reminding Buffett that he has said, "The stock market will discount the prices of companies that should be buying back their stock and don't." Over the years, Buffett has responded in several ways. The Internet bubble days, when Berkshire was thought antediluvian and its shares were sinking toward $40,000, Buffett conceded that in the past he had sometimes erred in not making repurchases. "My appraisal of Berkshire's value," he wrote in the 1999 annual report letter, "was then too conservative, or I was too enthused about some alternative use of funds." He then used the letter to open the door to repurchases. He said that after shareholders had a chance to read his discussion and understand the issues, Berkshire would entertain the offers of shareholders who wished to sell stock. And what happened? Nothing that led to Berkshire buying shares. Buffett says that the very few offers that came in were asking for prices that he was unwilling to pay. After that non-event, Buffett said on more than one occasion that a move by Berkshire to buy in shares would be self-defeating. That is, the mere announcement by the company that it would repurchase stock, a disclosure that would be required, he said, would send up the price and make the shares no longer attractive to buy. In other words, these are my words, definitely not his, if Warren Buffett, a genius at identifying undervalued stocks, were to indicate that Berkshire was so cheap it should be bought, it would immediately rise to a price not cheap. An acid test of this proposition came on September 26, 2011, when book value of Berkshire A stock was about $96,900, and the stock had on some days dipped below $100,000. Buffett announced then that Berkshire's board had authorized the company to buy shares, A or B, at a price no higher than 10% above book value. Within the day, the stock jumped to a price over Buffett's limit, and by all rights, Berkshire should not have been able to buy any shares. But a few shareholders nevertheless made offers within Buffett's range. Berkshire bought in 98 shares of A stock and 802,000 of B for about $67 million in total. Pocket change for a company that could have, and probably would have, paid billions to buy. One message from this episode. If Berkshire stock gets down close to book value, a figure that changes every day, of course, Buffett will no doubt, again, consider it cheap. Here, from the 1985 article, are the paragraphs about Buffett. CL. One buyback enthusiast is Warren E. Buffett, the noted Omaha investor. The company he controls is due to acquire 18% of Capital Cities in the ABC deal, in which Cap Cities acquired ABC. And that will become his biggest investment. But right now his 4 largest common stock holdings are in corporations that have, as Cap Cities has, repurchased substantial amounts of stock: Geico, General Foods, Exxon, and Washington Post. The Exxon investment is new, built up only after the company started acquiring its shares in 1983. A big reason I got in, Buffett says, is that the company has recognized the values in its stock and been smart enough and pro-shareholder enough to repurchase it. On the other hand, Buffett has sold the stocks of certain companies because they would not make repurchases. He is convinced, in fact, that the market discounts the prices of companies that should be making repurchases and don't, instead frittering away their money on acquisitions or other investments of far less value. The corollary, he says, is a markup in prices for companies that do repurchase shares, because investors identify the buybacks as a sign that management will be consistently inclined to act in the interests of shareholders. All managements say they're acting in the shareholders' interests, he observes. What you'd like to do as an investor is hook them up to a machine and run a polygraph to see whether it's true. Short of a polygraph, the best sign of a shareholder-oriented management, assuming its stock is undervalued, is repurchases. A polygraph proxy. That's what it is. The full text of Beating the Market by Buying Back Stock is available at fortune.com/BuffettBook. Guess Who's Bought Whoops Bonds? April 29, 1985. By Kenneth Labiche. By the mid-1980s, Buffett's reputation had grown to the point that every investment move he made was news. And in early 1985, the revelation was Berkshire's purchase of that frequent butt of investment jokes, Whoops bonds. In his chairman's letter in Berkshire's 1985 annual report, published days before this article came out, Buffett took pains to explain both this off-the-wall investment and the prosaic considerations, beware inflation, for example, that go into buying bonds generally. Investors, Buffett stressed, need to think about the prices of securities, or more precisely, the mispricing that an investor hopes to identify and exploit. Said that letter, Charlie, Munger, and I judged the risks at the time we purchased the bonds and at the prices Berkshire paid, much lower than present prices, to be considerably more than compensated for by prospects of profit. In that letter, Buffett also stated his opinions, laid out in many of his annual reports, about buying businesses in their entirety or in the pieces that stock, and occasionally bonds, represent. He wrote, "We feel that if we can buy small pieces of businesses with satisfactory underlying economic at a fraction of the per-share value of the entire business, something good is likely to happen to us." It did in the Whoops case. In the aggregate, Berkshire bought $260 million of the bonds, holding varying quantities from 1983 into the early 1990s. On this investment, Berkshire reaped tax-free interest of $263 million and in time, upon disposing of the bonds, recorded capital gains of $68 million. CL.
In building his reputation as one of America's most astute investors, Warren Buffett has often startled Wall Street with bold, unexpected moves. Lately, he's been springing them fortnightly, having just played a big part in Capital Cities Communications' deal to take over American Broadcasting Company's. The 54-year-old chairman of Omaha-based Berkshire Hathaway, Inc., has come up with another stunner. Buffett revealed in the Berkshire Hathaway annual report that he has spent $139 million to buy long-term bonds issued by the Washington Public Power Supply System, WPPSS, the notorious nuclear construction agency in Washington state, that defaulted on $2.25 billion of bonds in 1983 and has come to be known as Whoops. The municipal corporation composed of towns and utility districts, WPPSS began construction of 5 huge nuclear power plants in the 1970s. Buffett didn't buy the defaulted bonds issued to finance nuclear generating units 4 and 5. WPPSS scrapped these 2 plants during the earlier stages of construction after costs ran way over budget and evidence emerged that the region had overestimated its power needs. Buffett's bonds are tied to Units 1, 2, and 3. They have continued to pay interest because, unlike the bonds for Units 4 and 5, they are backed by a regional federal power agency. So far, Buffett seems to have triumphed again. Because he started buying the bonds not long after the well-publicized default brought a plunge in all WPPSS bonds, he locked in an attractive 16.3% tax-free current yield, a $22.7 million annual return on his investment. In addition, his 1, 2, and 3 bonds appreciated by about 13% by the end of 1984. Still, the WPPSS venture is a departure for Buffett. Though Berkshire Hathaway, an insurance, retail, and publishing conglomerate, holds large amounts of bonds, Buffett's forte is buying shares in companies whose values he believes have been underestimated by the stock market. His WPPSS purchases are a dicier proposition, as he is quick to admit. Only one of the 3 nuclear reactors financed by the bonds has gone online. Work on the other 2 has been suspended because their output won't be needed until the mid-1990s. The mothballing calls into question WPPSS's long-term financial stability. Investors holding the defaulted bonds and other parties have filed dozens of lawsuits against WPPSS, and interest payments could be interrupted. Buffett even warns shareholders of a very slight risk that the business could be worth nothing within a year or 2. Buffett doesn't seem concerned about such an outcome. Neither does he judge himself or expect to be judged by others on the basis of one investment decision. It's the overall record that counts. Buffett's record has been astounding. Owner of 41% of Berkshire Hathaway, he currently manages more than $1.7 billion in company investments. Berkshire Hathaway shares that were selling for $40 10 years ago now command well over $1,800. Slumped on a couch in his modest office, the genial Nebraskan compares the WPPSS investment to other unconventional moves he's made over the years, most notably his plunge into American Express stock right after a 1963 contretemps involving master swindler Tino de Angelis. The case, which became known as the Salad Oil Scandal, involved an obscure American Express warehousing subsidiary that issued receipts for large quantities of cottonseed and soybean oil that proved non-existent. Though many on Wall Street feared the affair would bankrupt American Express, Buffett and some partners took a chance and bought 5% of the company's shares at fire sale prices. In the end, American Express's liability turned out to be far less than originally suspected. The stock skyrocketed, and Buffett's contrariety triumphed. "Things aren't right just because they are unpopular," Buffett says with a chuckle. "But it is a good pond in which to fish. You pay a lot on Wall Street for a cheery consensus." WPPSS is a contrarian's paradise. Bondholders in Units 1, 2, and 3 have just survived a hair-raising legal challenge. They get their interest payments because the federal government's Bonneville Power Administration, which sells hydroelectric power to towns and utilities throughout the Northwest, has earmarked some of its revenues to pay the 1, 2, and 3 bondholders. The town of Springfield, Oregon, which had contracted to buy power from the WPPSS nuclear projects, asked the courts to look into this setup because ratepayers had questioned its legality. In February, a U.S. appeals court in San Francisco allowed the arrangement to stand. More litigation on this issue is possible, and other worries abound. To meet the interest payments, Bonneville must have a reliable cash flow, which partly depends on adequate rainfall for the dams whose power it sells. Nor can it count on selling all the kilowatts. Aluminum smelters, the major industrial customers in the region, have been hurt by foreign competition, and Bonneville has had to lower rates to keep them going. Another fear for 1, 2, and 3 bondholders is that a court will decide that 4 and 5 bondholders are entitled to part of the revenues now being sluiced through Bonneville to 1, 2, and 3. WPPSS watchers call the current partition between the 2 classes of bondholders the Chinese wall. Most dangerous of all for 1, 2, and 3 bondholders is the possibility that WPPSS might declare bankruptcy. Since no public agency of this size has gone bankrupt in the U.S., no one is quite sure how 1, 2, and 3 bonds might fare. Given all these imponderables, many municipal bond specialists have advised clients to stay away from WPPSS. A West Coast bond expert compares a WPPSS investment to troop convoys crossing the North Atlantic during World War II. You're pretty sure some torpedoes will be aimed at you, he says, but you don't know if you're going to get hit. The 2 major bond rating agencies on Wall Street, Moody's and Standard & Poor's, have both refused to rate WPPSS 1, 2, and 3 bonds. Yet other bond experts share Buffett's enthusiasm for the high WPPSS yields. Says Robert Adler, Vice President of the Municipal Bond Department at Shearson Lehman Brothers. They're not investment-grade quality bonds, but they could work for a high-net-worth individual who understands the risks. Apparently, American Express, which owns Shearson Lehman, is less bullish. In 1984, an American Express insurance subsidiary unloaded WPPSS 1, 2, and 3 bonds worth $76 million. Howard Sitzer, Director of Municipal Bond Research at Thomson McKinnon Securities, recommends WPPSS 1, 2, and 3. He argues that Bondville, which had gross revenues of $2.7 billion in 1984, can cover its $570 million or so in WPPSS interest obligations for some time. Sitzer also sees little possibility of a WPPSS bankruptcy. Buffett maintains that his decision to buy WPPSS, like all his other investment decisions, followed a hard-headed analysis of the underlying values. He points out, for example, that the after-tax earnings on his bonds would normally require an investment at least twice as big. Before pushing ahead, Buffett says he carefully surveyed the hazards. We don't make judgments based on ratings, he adds. If we wanted Moody's and Standard & Poor's to run our money, we'd give it to them. Buffett adds rather proudly that his Omaha headquarters has no computers, and that his analyses are based on no electronic data. Says he, we read, that's about it. Buffett won't say whether he has bought more WPPSS bonds or has lightened his holdings since the end of last year. His commitment to invest $517.5 million in ABC won't necessarily force him to sell the WPPSS bonds to raise money. He can tap his company's cash flow and liquid assets or resort to his considerable borrowing power. Berkshire Hathaway also holds large blocks of communications stocks, including 4% of Time Inc., publisher of Fortune, some of which the Federal Communications Commission may force him to sell as a condition for investing in ABC. Buffett says that occasions to buy bonds in the future are likely to be few. He is concerned that the federal budget deficit will lead to substantially higher inflation and surging interest rates, a disastrous situation for bondholders. In runaway inflation, says Buffett, what you've bought is wallpaper. While Buffett has been making news lately, he doesn't make a lot of investments. My problem is I don't get 50 great ideas a year, he says. I'm lucky if I get 1 or 2. But when he does decide to plunge, he gets big. In the latest annual report, Buffett warns shareholders that betting heavily on a few ideas is bound to produce a bad year once in a while. That may be, but so far, the shareholders have had plenty to whoop about.
From Now Hear This, April 28, 1986. Our gain in net worth during the year was $613.6 million, or 48.2%. It is fitting that the visit of Halley's Comet coincided with this percentage gain. Neither will be seen again in my lifetime. Warren E. Buffett, 55, chairman of Berkshire Hathaway, in the company's 1985 annual report. Editor's note. Actually, Buffett was wrong. The gain 13 years later in 1998 was a peg higher, 48.3%, with no accompanying Halley's Comet. But in his 1998 letter, Buffett dismissed the accomplishment, saying that most of the gain was simply the effect of Berkshire's issuing shares during the year to make acquisitions, principally NetJets and General Ray, at a time when its stock was selling at a large premium over book value. It was no accident, of course, that Buffett was issuing Berkshire stock in a year when its price related to a more important indicator, intrinsic value, was also high. He would regard it as sinful to hand out Berkshire shares when they are the opposite. Cheap, so to speak. From Should You Leave It All to the Children? September 29, 1986. Excerpts from an article by Richard I. Kirkland, Jr. This story put Warren Buffett on the cover of Fortune for the first time, though certainly not the last. Still, Buffett was only the principal actor in a long story that also included a large supporting cast, all of its members rich. So we have simply excerpted the Buffett paragraphs, including those opening the article. Buffett's strongly negative views about large inheritances, opinions known to me, prompted this story. But there was definitely no shortage of other rich people willing to talk, remembers writer Rick Kirkland, who later became Fortune's managing editor. His piece proceeded to hit a nerve with readers as well. Said Fed Chairman Paul Volcker, upon spotting a Fortune editor at a Washington party, "Everyone is talking about your story. Even today, a quarter-century after the article was published, Buffett gets questions about it, as if, he says, readers had cut it out and saved it. His daughter, Susie, the oldest of 3 Buffett children, the others sons Howard and Peter, probably fields questions still more often because of one anecdote included in the story. Susie says that people she meets still ask her incredulously, 'He wouldn't give you money to fix up your kitchen?' Buffett thought then that a few $100,000 might be appropriate for a child to inherit. Even now, he remains in the parsimonious camp. But as the years passed, inflation and his own reflections changed his opinions about what his children should get and led him to revise, upwardly, those early thoughts about a few $100,000. For many years, he did not publicly disclose where his thinking had taken him. But at a 2010 dinner in New York, amid a small group of people loaded with money, Buffett made news by spelling out for the first time what his children had up to then received and would further receive at his death. He said that when his first wife, Susie, died in 2004, her will had left each of the 3 children $10 million, and that his will, which he happened to have just rewritten, provided that each would receive $15 million. For Buffett's 3 children, therefore, that's a total of $75 million, as in million with an M. His fortune, as he spoke, was close to $50 billion with a B. Obviously, he still believes that, no, you shouldn't leave it all to the children. Neither does he expect to hand the management of Berkshire Hathaway down to his children, though that matter is nuanced. Believing that a member of his family could best preserve the company's culture, Buffett has said that he hopes his older son, Howard, will succeed him as Berkshire's chairman when the need arises. But the active management of the company is to be taken over by non-family members. To all of this, there is an implied codicil relating to philanthropy. In 1999, well before Susie Buffett's death, she and Warren had encouraged their children to move into philanthropy by giving each of them $10 million for the establishment of their own foundations. Later, additional gifts, some bestowed by Susie's will, raised each of the foundations to more than $100 million in size. Then came what son and author Peter Buffett, see page 316 for an article about him, has called the Big Bang. This was Warren Buffett's stunning 2006 announcement, made by means of a Fortune article, that he would gradually give away most of his fortune to 5 foundations, the 3 run by his children among them. Since then, each of those 3 foundations has received shares worth close to $400 million at the dates of the gifts. The stakes were upped still more on August 30th, 2012, as Buffett, celebrating his 82nd birthday that day, announced that he would henceforth double the shares of stock he will give the foundations run by his children. The price of Berkshire stock over the years will determine the amount bestowed. But it is easy to imagine that the total gift emanating from the original Big Bang and its 2012 variation will reach $2 billion for each foundation and perhaps a good deal more. The Fortune article that disclosed Buffett's huge gift begins on page 256 of this book. CL. As the article begins,
Warren Buffett, 56, the chairman and guiding genius of Berkshire Hathaway, the phenomenally successful holding company, is worth at least $1.5 billion. But don't bother being jealous of his 3 children. Buffett does not believe that it is wise to bequeath great wealth and plans to give most of his money to his charitable foundation. Having put his daughter and 2 sons through college, the Omaha investor contents himself with giving them several $1,000s each at Christmas. Beyond that, says daughter Susan, 33, if I write my dad a check for $20, he cashes it. Buffett is not cutting his children out of the family fortune because they're wastrels or wantons or refuse to go into the family business. The traditional reasons rich parents withhold money. Says he, my kids are going to carve out their place in this world, and they know I'm for them whatever they want to do. But he believes that setting up his heirs with a lifetime supply of food stamps just because they came out of the right womb can be harmful for them, and is an antisocial act. To him, the perfect amount to leave children is enough money so they would feel they could do anything, but not so much that they could do nothing. For a college graduate, Buffett reckons a few $100,000 sounds about right. How much should you leave the kids? Agonizing over that question is a peculiarly American obsession. In much of the world, custom and law dictate that children, unless they have committed some particularly heinous crime, automatically receive most of the parents' wealth when they die. Only Britain and her colonies, common law countries all, give property owners the right to leave their children whatever they want.
as the article continues midway,
some rich individuals argue that not giving money to the children can cause problems too. Says one, if you're the child and you see your father with all this dough, and you get some but not much, I just can't help thinking resentment will enter in. Susan Buffett, who works in Washington as an administrative assistant to the editor of U.S. News and World Report and is married to a public interest lawyer, admits her father's position is tough to live with. My dad is one of the most honest, principled good guys I know, she says, and I basically agree with him. But it's sort of strange when you know most parents want to buy things for their kids and all you need is a small sum of money to fix up the kitchen, not to go to the beach for 6 months. He won't give it to us on principle. All my life, my father has been teaching us. Well, I feel I've learned the lesson. At a certain point, you can stop.
and further along,
Warren Buffett argues that most proprietors should forget trying to keep the management of their beloved companies in the family. He assumes current non-family management will continue running Berkshire after he is gone. He grants that occasionally an heir may be the most suitable candidate to manage a company, but believes the odds are against it. Says Buffett, would anyone say the best way to pick a championship Olympic team is to select the sons and daughters of those who won 20 years ago? Giving someone a favored position just because his old man accomplished something is a crazy way for a society to compete.
Dial BUFFETT for merger. December 22nd, 1986. From News Trends section. In one of the most unusual want ads in the Wall Street Journal has ever run, Warren E. Buffett, 56, the chairman of Berkshire Hathaway, Inc., announced that he was looking to buy businesses worth $100 million or more before December 31st, 1986. "We have the money," reads the $47,000 nearly full-page ad, "and we can act with extraordinary speed. If you have any possible interest, call promptly." The reason to act fast is the tax law that takes effect January 1st. While the jump in the federal capital gains tax rate for individuals from 20% to 28% is alarming enough, Buffett warns that business owners could pay the equivalent of a 52.5% capital gains tax if they wait until after December 31st to sell. He comes up with that figure by considering the new 34% capital gains tax that corporations must pay on the sale of a business and the 28% that shareholders owe on the remaining capital gain. Says Buffett, many companies have a reason to beat the clock. Before you rush to your telephone, however, be warned that not just any potential acquisition will do. The company must have, quote, at least $10 million of after-tax earnings and preferably much more, according to the ad, and must also boast good return on equity, little or no debt, and a management in place. It should also be in a simple business. If there's lots of technology, we won't understand it. Editor's note: Buffett got no takers. Early fears about index futures. December 7, 1987. A warning letter sent by Warren Buffett to Congressman John Dingell, Jr. In mid-October of 1987, a week of vicious selling in the stock market culminated on Black Monday, the 19th, when the Dow Industrials average dropped by 22.6%. As the causes of the crash came under intense investigation, attention focused on the role played by a derivative, S&P index futures, in which trading had been permitted for only a few years. In particular, institutional investors following a portfolio insurance strategy had repeatedly shorted S&P index futures, with their trading drawing in other institutional investors who did the same, thereby magnifying the market panic. Suddenly, there was a remarkable timeliness to, and a strong reason for Fortune to, publish a letter that Buffett had written years earlier in 1982 to Congressman John Dingell, Jr., Democrat from Michigan, then chairman of the Subcommittee on Oversight and Investigations. Congress was in that year debating whether to allow the Chicago Mercantile Exchange to begin trading futures contracts tied to the level of stock indexes. Dingell was opposed to that plan, and so, he learned, was Buffett. The two men knew each other a little because many years before, their fathers, both congressmen, had been friends, though Howard Buffett, Republican from Nebraska, was an arch conservative, and John Dingell, the senior, Democrat from Michigan, was the polar opposite. Against that background, the younger Dingell asked the younger Buffett to explain in a letter why he thought trading in stock index futures was a bad idea. Said Buffett, as he wound up his carefully reasoned letter, "We do not need more people gambling in non-essential instruments identified with the stock market in this country, nor brokers who encourage them to do so." Dingell and Buffett were, of course, on the losing side of this argument. Trading in S&P futures began on the Merc in April 1982 and, notwithstanding crises like the one in 1987, mushroomed. The contract was then eclipsed 25 years later by its electronic offspring, S&P E-mini futures, which speculators could trade in for relatively small amounts and which quickly became the king of contracts. When the flash crash of May 2010 occurred, terrifying many investors, E-mini contracts accounted for a huge portion of the volume. Below is the letter that Buffett sent to Congressman Dingell in 1982. CL.
This letter is to comment upon the likely sources for trading activity that will develop any futures market involving stock indexes. My background for this commentary is some 30 years of practice in various aspects of the investment business, including several years as a securities salesman. The last 25 years have been spent as a financial analyst, and I currently have the sole responsibility for an equity portfolio that totals over $600 million. It is impossible to predict precisely what will develop in investment or speculative markets, and you should be wary of any who claim precision. I think the following represents a reasonable expectancy. 1. A role can be performed by the stock index future contract in aiding the risk-reducing efforts of the true investor. An investor may quite logically conclude that he can identify undervalued securities, but also conclude that he has no ability whatsoever to predict the short-term movements of the stock market. This is the view I maintain in my own efforts in investment management. Such an investor may wish to zero out market fluctuations, and the continual shortening of a representative index offers him the chance to do just that. Presumably, an investor with $10 million of undervalued equities and a constant short position of $10 million in the index will achieve the net rewards or penalties attributable solely to his skill in selection of specific securities, and have no worries that these results will be swamped or even influenced by the fluctuations of the general market. Because there are costs involved, and because most investors believe that over the long term, stock prices in general will advance, I think there are relatively few investment professionals who will operate in such a constantly hedged manner. But I also believe that it is a rational way to behave, and that a few professionals who wish always to be market neutral in their attitude and behavior will do so. 2. As previously stated, I see a logical risk-reducing strategy that involves shorting the futures contract. I see no corresponding investment or hedging strategy whatsoever on the long side. By definition, therefore, a very maximum of 50% of the futures transactions can be entered into with the expectancy of risk reduction, and not less than 50%, the long side, must act in a risk-accentuating or gambling manner. 3. The actual balance would be enormously different from this maximum 50-50 division between risk reducers and risk accentuators. The propensity to gamble is always increased by a large prize versus a small entry fee, no matter how poor the true odds may be. That's why the Las Vegas casinos advertise big jackpots and why state lotteries headline big prizes. In securities, the unintelligent are seduced by the same approach in various ways, including a. penny stocks, which are manufactured by promoters precisely because they snare the gullible, creating dreams of enormous payoffs but with an actual group result of disaster, and b. low margin requirements through which financial experience attributable to a large investment is achieved by committing a relatively small stake. 4. We have had many earlier experiences in our history in which the high total commitment or low down payment phenomenon has led to trouble. The most familiar, of course, is the stock market boom in the late 20s, which was accompanied and accentuated by 10% margins. Saner heads subsequently decided that there was nothing pro-social about such thin-margined speculation, and that rather than aiding capital markets in the long run, it hurt them. Accordingly, margin regulations were introduced and made a permanent part of the investment scene. The ability to speculate in stock indexes with 10% down payments, of course, is simply a way around the margin requirements and will be immediately perceived as such by gamblers throughout the country. 5. Brokers, of course, favor new trading vehicles. Their enthusiasm tends to be in direct proportion to the amount of activity they expect. And the more the activity, the greater the cost to the public, and the greater the amount of money that will be left behind by them to be spread among the brokerage industry. As each contract dies, the only business involved is that the loser pays the winner. Since the casino, the futures market, and its supporting cast of brokers gets paid a toll each time one of these transactions takes place, you can be sure that it will have a great interest in providing very large numbers of losers and winners. But it must be remembered that for the players, it is the most clear sort of a negative-sum game. Losses and gains cancel out before expenses. After expenses, the net loss is substantial. In fact, unless such losses are quite substantial, the casino will terminate operations since the players' net losses compose the casino's sole source of revenue. This negative-sum aspect is in direct contrast to common stock investment generally, which has been a very substantial positive-sum game over the years, simply because the underlying companies, on balance, have earned substantial sums of money that eventually benefit their owners, the stockholders. 6. In my judgment, a very high percentage, probably at least 95% and more likely much higher, of the activity generated by these contracts will be strictly gambling in nature. You will have people wagering as to the short-term movements of the stock market and able to make fairly large wagers with fairly small sums. They will be encouraged to do so by brokers who will see rapid turnover of customers' capital, the best thing that can happen to a broker in terms of his immediate income. A great deal of money will be left behind by these 95% as the casino takes its bite from each transaction. 7. In the long run, gambling-dominated activities that are identified with traditional capital markets, and that leave a very high percentage of those exposed to the activity burned, are not going to be good for capital markets. Even though people participating in such gambling activity are not investors, and what they are buying really are not stocks, they will still feel that they have had a bad experience with the stock market. And after having been exposed to the worst face of capital markets, they understandably may, in the future, take a dim view of capital markets generally. Certainly that has been the experience after previous waves of speculation. You might ask if the brokerage industry is not wise enough to look after its own long-term interests. History shows brokers to be myopic. Witness the late 60s. They often have been happiest when behavior was at its silliest. And many brokers are far more concerned with how much they gross this month than whether their clients, or for that matter, the securities industry, prosper in the long run. We do not need more people gambling in non-essential instruments identified with the stock market in this country, nor brokers who encourage them to do so. What we need are investors and advisors who look at the long-term prospects for an enterprise and invest accordingly. We need the intelligent commitment of investment capital, not leveraged market wagers. The propensity to operate in the intelligent, pro-social sector of capital markets is deterred, not enhanced, by an active and exciting casino operating in somewhat the same arena, utilizing somewhat similar language, and serviced by the same workforce. In addition, low-margined activity in stock equivalents is inconsistent with expressed public policy as embodied in margin requirements. Although index futures have slight benefits to the investment professional wishing to hedge out the market, the net effect of high-volume futures markets and stock indexes is likely to be overwhelmingly detrimental to the securities buying public and, therefore, in the long run, to capital markets generally.
The Inside Story of Warren Buffett, April 11, 1988. by Carol Loomis. This story has a little more history than most. In the first 20 years after I became a friend of Warren Buffett's, and soon after a Berkshire Hathaway stockholder, and still later, the pro bono editor of his annual letter to stockholders, I wrote no more than a few paragraphs about him in Fortune. True, as his reputation grew exponentially, I suggested some Buffett stories, the Grinnell and Whoops articles, for example. But other members of the magazine's staff wrote them, and that suited me fine. In early 1988, however, Fortune's managing editor, Marshall Loeb, called me into his office and gave me a fish or cut bait choice. He said it was time we did a full profile about Buffett. "You can write it," he said to me, knowing that I knew Warren well, "or I'll assign someone else to do it." My decision, made after a hard day's thought, was to write the story myself. I knew that was the right choice for the readers of Fortune, who would get a true inside story from me because I understood Buffett's world so well. But naturally, they needed to know also that I was a friend of Buffett's, a shareholder of Berkshire, and editor of his annual letter. All of those facts were reported in the article, and have since become regulars in other pieces I have written about Buffett. Marshall's timing for the profile was excellent. My article told an important story that had up until then stayed below the radar. How Buffett, the extraordinary investor, had also come to be Buffett, the extraordinary businessman and manager. At his side, playing a critical advisory role, was his brilliant friend Charlie Munger. To an extent recognized by outsiders hardly at all, the two had put Berkshire on the path to becoming a very big and successful business. C.L. Warren Buffett, chairman of Berkshire Hathaway, calls the conglomerate his canvas, and shortly, when its annual report comes out, the world will learn precisely what kind of picture this legendary investor painted in the tumultuous year of 1987. A preview? As a work of art, the year was not a minor Buffett. Berkshire, whose shareholders I wish to say quickly and happily have long included me, chalked up a $464 million gain in net worth, an advance of no less than 19.5%. That is somewhat below the 23.1% annual average that Buffett has recorded since taking over the company 23 years ago. But in a year in which many professional investors had their heads handed to them, this latest example of Buffett brushwork has to rank as one more masterpiece. The annual report, which readers always comb for Buffett's once-a-year revelations about what he has been doing in the securities markets, will carry two special pieces of news. First, Buffett, who bought $700 million of Salomon Inc. redeemable convertible preferred stock for Berkshire just before the October crash, makes it clear in his chairman's letter that he is solidly behind the investment bank's chairman, John Gutfreund. That should put an end to the persistent rumors about divisions between the two men. Second, Buffett reveals that Berkshire began buying short-term Texaco bonds last year after the company went into bankruptcy, at a point when many other investors were bailing out of the bonds. At year-end, Berkshire had an unrealized profit in the Texaco securities. But both that holding and the Salomon preferred, which Buffett figures to have been worth about $685 million at year-end, are carried at cost on Berkshire's books and were non-events as far as the company's 1987 record is concerned. Behind that record, behind Buffett, in fact, is a double-barreled story, in which all the words that have been written about him has usually been told as a single bore only. Most of the business world knows about Warren Buffett, the investor, the Wizard of Omaha, the stock-picking genius who turned $9,800, most of it saved from paper routes, into a personal net worth that is today more than $1.6 billion. The man whose superlative, long-running investment performance has become ever more difficult for the efficient market camp to explain away as luck. That Buffett was certainly abroad in the land in 1987, having said for more than 2 years that he could not find reasonably priced stocks to buy for Berkshire. Buffett came into October 19 wearing heavy armor, owning almost no common equities besides those of 3 companies that he thinks of as permanent parts of Berkshire's portfolio. All 3, though they fell substantially in the crash, were standouts for the entire year. Geico, the auto insurance company, was up by 12%, Washington Post by 20%, Capital Cities ABC by 29%. Not bad for Buffett the investor. But the other craftsman at work in Berkshire is Buffett the businessman, a buyer and manager of companies, and a fellow whose skill is not understood widely at all. In effect, this guy grinds out the yardage, while Buffett the investor throws bombs. In 1987, the Berkshire offense was nicely balanced. The investor produced $249 million after allowances for taxes in realized and unrealized gains. The businessman generated $215 million in after-tax operating earnings from Berkshire's stable of businesses, for that total of $464 million. The operating earnings were more than the net income of Dow Jones or Pillsbury or Corning Glassworks. The vehicle through which all this got done, Berkshire, had a stock price of around $12 in 1965 when Buffett took control. It rose to a high of $4,200 in 1987 and was recently about $3,100. Buffett, a witty, straightforward man of 57, owns 42% of the company. His wife, Susan, 55, another 3%. Berkshire had more than $2 billion in revenues in 1987, will probably rank around 30th in Fortune's annual list of the largest diversified services companies, and is powerfully strange in its makeup. At Berkshire's heart is a large property and casualty insurance operation composed of several unfamous companies, such as National Indemnity, which generates float that Buffett invests. Beyond insurance, Berkshire owns a set of sizable businesses that Buffett bought one by one and that he calls his Sainted Seven. They are the Buffalo News, Feckheimer Brothers, a Cincinnati manufacturer and distributor of uniforms, the Nebraska Furniture Mart, an Omaha retailer that sells more home furnishings than any other store in the country, See's Candies, the dominant producer and retailer of candy in California, and 3 operations that Buffett took into the fold when Berkshire bought Scott and Fetzer of Cleveland in 1986, World Book, Kirby Vacuum Cleaners, and a diversified manufacturing operation that makes industrial products such as compressors and burners. A motley crew, yes. But in his 1987 annual report, Buffett the businessman comes out of the closet to point out just how good these enterprises and their managers are. Had the Sainted Seven operated as a single business in 1987, he says, they would have employed $175 million in equity capital, paid only a net $2 million in interest, and earned, after taxes, $100 million. That's a return on equity of 57%. And it is exceptional. As Buffett says, you'll seldom see such a percentage anywhere, let alone at large diversified companies with nominal leverage. A business school professor, trying gamely a few years ago to reconcile the efficient market hypothesis with Buffett's success at investing, called him a 5 sigma event, a statistical aberration so rare it practically never happens. In the buying and managing of whole companies, he may well be a phenomenon equally uncommon. He brings to buying the same acuity and discipline he brings to investing. As a manager, He disregards form and convention and sticks to business principles that he calls simple, old, and few. The Berkshire companies, for example, never lose sight of what they're trying to do, says Buffett. If we get on the main line, New York to Chicago, we don't get off at Altoona and take side trips. We also have a reverence for logic around here. But what we do is not beyond anybody else's competence. I feel the same way about managing that I do about investing. It's just not necessary to do extraordinary things to get extraordinary results. My credentials for writing about both Buffetts, the investor and the businessman, are unusual. Besides having been a staff member of this magazine for more than 30 years, I have been a friend of Buffett's for more than 20. I do some editing of his annual report, which is why I know what it's going to say. And I am an admirer of Buffett's. In this article, because it has been written by a friend, you can expect two things: an inside look at how Warren Buffett operates, and something less than total objectivity. But here is an incontestable fact. Buffett brings an immense mental brilliance to everything he does. Michael Goldberg, 41, who runs Berkshire's insurance operations and occupies the office next to Buffett's in Omaha, thinks that he saw people as smart at the Bronx High School of Science, but they all went into math and physics. Buffett's intellectual power is totally focused on business, which he loves and knows incredible amounts about. Says Goldberg, he is constantly examining all that he hears. Is it consistent and plausible? Is it wrong? He has a model in his head of the whole world. The computer there compares every new fact with all that he's ever experienced and knows about, and says, what does this mean for us? For Berkshire, that is. Buffett owns a few stocks personally, but spends little time thinking about them. He says, my ego is wrapped up with Berkshire, no question about that. Meeting him, most people would see little evidence of ego at all. Buffett is down to earth, ordinary looking in a pleasant, solid Midwestern way. As a private eye, for example, he could blend into any crowd. And in matters of dress, not snappy. He likes McDonald's and cherry Cokes, and dislikes large parties and small talk. But in the right setting, he can be highly gregarious and even a ham. This winter, at a Cap Cities management meeting, he donned a Salvation Army uniform, tooted away on a horn, and serenaded the company's chairman, Thomas Murphy, by singing What a Friend I Have in Murphy, featuring lyrics he had written. Sometimes, and particularly on intellectual subjects, Buffett talks with great intensity and speed, trying to keep up with the gyrator in his mind. When he was young, he was terrified of public speaking. So he forced himself to take a Dale Carnegie course, filled, he says, with other people equally pitiful. Today he gives speeches with ease, drawing them entirely from an outline in his head, no written speech, no notes, and lacing them with an inexhaustible supply of quips, examples, and analogies, for which a professional writer would kill. In his work, Buffett has not let the complexities of his thinking prevent him from forming a very simple view of life. The key point about the two Buffetts, the investor and the businessman, is that they look at the ownership of businesses in exactly the same way. The investor sees the chance to buy portions of a business in the stock market at a price below intrinsic value, that is, below what a rational buyer would pay to own the entire establishment. The manager sees the chance to buy the whole business at no more than that intrinsic value. The kind of merchandise that Buffett wants is simply described also: good businesses. To him, that essentially means operations with strong franchises, above-average returns on equity, a relatively small need for capital investment, and the capacity, therefore, to throw off cash. That list may sound like motherhood and apple pie, But finding and buying such businesses isn't easy. Buffett likens the hunt to bagging rare and fast-moving elephants. He has avoided straying from his strict criteria. The Sainted Seven all possess the characteristics of a good business. So do the companies in which Buffett owns stock, such as Geico, Washington Post, and Cap Cities. In his annual reports, Buffett regularly extols the managers of all these companies, most of whom rival him, if anyone can, in their conviction that working is fun. He devoutly wishes to keep them fanatics. Wonderful businesses run by wonderful people is his description of the scene he wants to look down on as a chief executive. But he believes that over the years, his largest mistakes in investing have been the failure to buy certain good business stocks just because he couldn't stomach the quality of management. I'd have been better off trusting the businesses, he says. So in the stocks he has sometimes held, though not in the businesses he owns directly, he has on occasion gritted his teeth and tolerated a fair amount of management inanity. A few years ago, when he owned many more stocks than now, he complained to a friend about the absurdities of an annual report he had just read, describing the content as misleading and self-serving of management and enough to make you throw up. The friend said, "And yet you're in the stock." "Yes," was his answer. "I want to be in businesses so good that even a dummy can make money." Naturally, good businesses do not come cheap, particularly not today when the whole world has caught on to their attributes. But Buffett has been constantly shrewd as a buyer. He simply will not overpay, and patient in waiting for opportunities. He regularly puts an ad in his annual report explaining what kind of businesses he'd like to buy. For the right business and the right people, we can provide a good home, he says. Some folks of the right sort, by the name of Heldman, read that ad and brought him their uniform business, Feckheimer, in 1986. The business had only about $6 million in profits, which is an operation smaller than Buffett thinks ideal. But the Heldmans seemed so completely the kind of managers he looks for, likable, talented, honest, and goal-driven, is his description. That he made the acquisition and is delighted he did. In buying at least one business, the Buffalo News, Buffett was particularly far-seeing. Both the Washington Post Company and Chicago's Tribune Company turned it down when it came up for sale in 1977, perhaps discouraged because it was an evening paper, a dwindling breed. The News was also a 6-day publisher with no Sunday edition and revenue stream, competing against a 7-day publisher, the Courier Express. But the News was the stronger of the two during the week, and Buffett concluded the paper had the makings to do well if it could establish a Sunday edition. Buying the paper for $32.5 million, he immediately started to publish on Sunday. The News's special introductory offers to subscribers and advertisers prompted the Courier Express to bring an antitrust suit, which he defeated. Both papers went for years, losing money, and then, in 1982, the Courier Express gave up and closed down. Last year, the News, as a flourishing monopoly paper, made $39 million in pre-tax operating profits and certainly did not do it by stinting on editorial copy. The paper delivers 1 page of news for every page of advertising, a proportion not matched by any other prosperous newspaper of its size or larger. Because Buffett loves journalism, he says that if he had not been an investor, he might well have picked journalism as a career. The News is probably his favorite property. The oddity of Buffett's intense focus on good business is that he came late to that philosophy after a couple of decades of mucking around and making prodigious amounts of money anyway. As a kid in Omaha, He was precocious and fascinated by anything having to do with numbers and money. His father, Howard Buffett, a stockbroker whom the son adored, affectionately called him Fireball. He virtually memorized a library book, 1,000 Ways to Make $1,000, fantasizing in particular about penny-weighing machines. He pictured himself starting with a single machine, pyramiding his take into thousands more, and turning himself into the world's youngest millionaire. In Presbyterian Church, he calculated the lifespans of the composers of hymns, investigating whether their religious calling had rewarded them with extra years of life. His conclusion? No. At age 11, he and a friend moved into more secular pursuits, putting out a horse racing handicapping sheet under the name Stable Boy Selections. Through it all, he thought about stocks. He got his first books on the market when he was 8, bought his first stock, Cities Services Preferred, at 11, and went on to experiment with all manner of trading methodologies. He was a teenager stock chartist for a while, and later a market timer. His base from 1943 on was Washington, where his family moved upon Howard Buffett's election to Congress. Deeply homesick for Omaha, young Warren once ran away from home and also got disastrous grades for a while in junior high, even in the math at which he was naturally gifted. Only when his father threatened to make Warren give up his lucrative and much-loved paper routes did his grades improve. Graduating from high school at 16, Buffett went through 2 years at the University of Pennsylvania and then transferred to the University of Nebraska. There, in early 1950, while a senior, he read Benjamin Graham's newly published book, The Intelligent Investor. The book encouraged the reader to pay attention to the intrinsic value of companies and to invest with a margin of safety, and to Buffett it all made enormous sense. To this day, there is a Graham flavor to Buffett's only articulated rules of investment. The first rule is not to lose. The second rule is not to forget the first rule. In the summer of 1950, having applied to Harvard Business School, Buffett took the train to Chicago and was interviewed by a local alum. What this representative of higher learning surveyed, Buffett says, was a scrawny 19-year-old who looked 16 and had the social poise of a 12-year-old. After 10 minutes, the interview was over, and so were Buffett's prospects of going to Harvard. The rejection stung. But Buffett now considers it the luckiest thing ever to have happened to him because upon returning to Omaha, he chanced to learn that Ben Graham was teaching at Columbia's business school and immediately, and this time successfully, applied. Another student in Graham's class was William Ruane, who today runs the top-performing Sequoia Fund and is one of Buffett's closest friends. Ruane says that a kind of intellectual electricity coursed between Graham and Buffett from the start, and that the rest of the class was mainly an audience. At the end of the school year, Buffett offered to work for Graham's investment company, Graham Newman, for nothing. But Ben, says Buffett, made his customary calculation of value to price and said no. Buffett did not succeed in getting a job offer from Graham until 1954, when he started at Graham Newman as a jack-of-all-trades and student of his mentor's mechanistic, value-based investment techniques. Basically, Graham looked for bargains, which he rigidly defined as stocks that could be bought at no more than 2/3 of their net working capital. Most companies, he figured, could be liquidated for at least their net working capital. So in buying for still less, he saw himself building in the necessary margin of safety. Today, few stocks would meet Graham's standards. In the early 1950s, many did. Buffett returned to Omaha in 1956 at age 25, imbued with Graham's theories and ready to embark upon the course that was to make him rich and famous. assembling $105,000 in limited partnership funds from a few family members and friends, he started Buffett Partnership Limited. The economics of the partnership were simple. The limited partners earned 6% on their funds and got 75% of all profits made in addition. Buffett, as general partner, got the remaining 25%. The partnership earned impressive profits from the start, and as word spread about this young man's abilities, new partners climbed aboard, bearing money. When Buffett decided in 1969 to disband the partnership, having grown disenchanted with a market that had turned wildly speculative, he had $100 million under management, of which $25 million was his own, most of it the fruits of his share of the profits. Over the 13 years of the partnership, he had compounded its funds at an average annual rate of 29.5%. That record is the forerunner of his performance with Berkshire, 23.1%. The drama of his Berkshire record is that he has scored colossal gains on the company's capital while retaining 100% of its earnings. Berkshire pays no dividends. This means that he has to find investment outlets for a vigorously expanding amount of money. The company's equity at year-end was $2.8 billion, an impressive figure to be compounding at superlative rates. Despite the outstanding record of the partnership, Buffett feels today that he managed its money with only part of his senses at work. In his 1987 annual report, Buffett laments 20 misspent years, a period including all of the partnership days during which he searched for bargains and, alas, had the misfortune to find some. His punishment, he says, was an education in the economics of short-line farm implement manufacturers, third-place department stores, and New England textile manufacturers. The farm implement company was Dempster Mill Manufacturing of Nebraska. The department store was Hochschild Kahn of Baltimore, and the textile manufacturer was Berkshire Hathaway itself. The Buffett partnership got in and out of Dempster and Hochschild Kahn quickly during the 1960s. Berkshire Hathaway, the textile business, of which the partnership bought control for around $11 million, was a more lasting problem. Buffett nursed the business for 20 years while deploring the benightedness that had taken him into such industrial bogs as men's suit linings, in which he was just another commodity operator with no edge of any kind. Periodically, Buffett would explain in his annual report why he stayed in an operation with such poor economics. The business, he said, was a major employer in New Bedford, Massachusetts. The operations managers had been straightforward with him and as able as the managers of his successful businesses. The unions had been reasonable. But finally, in 1985, Buffett closed the operation, unwilling to make the capital investments that would have been necessary if he was even to subsist in this deeply discouraging business. A few years earlier, for his annual report, Buffett wrote a line that has become famous. With few exceptions, when a manager with a reputation for brilliance tackles a business with a reputation for poor fundamental economics, it is the reputation of the business that remains intact. As a requiem for Buffett's textile experience, the sentiment will do nicely. In his own mind, also, this is not just a case of a relatively small investment gone bad. Calculating what Berkshire might have earned if he had not made the bet on textiles, he thinks of the opportunity cost as being around $500 million. Occasionally, during his misspent years, Buffett would be drawn toward a good business and, as if startled into unusual action, would plunge abnormal amounts into the opportunity. In 1951, then investing only his own money and mainly gravitating toward such bargains as Timely Clothes and Des Moines Railway, Buffett became fascinated by Geico, whose low distribution costs and ability to sign up a better set of policyholders than other insurers gave it a crucial advantage. Though the company did not begin to meet Ben Graham's mathematical tests, Buffett put $10,000, around 2/3 of his net worth, into Geico stock. He sold a year later at a 50% profit and did not again own the company until 1976. By then, Geico was magnitudes larger, but near bankruptcy because it had miscalculated its claim costs and was underpricing. Buffett thought, however, that the company's competitive advantage was intact, and that a newly named chief executive, John J. Byrne, could probably restore the company's health. Over 5 years, Buffett invested $45 million in Geico. Byrne did the job, becoming a close friend of Buffett's and often seeking his advice. Geico is today an industry star, and Berkshire's stake is worth $800 million. On another occasion, in 1964, while running the partnership, Buffett barreled into American Express stock at the time of the so-called salad oil scandal. An Amex Co. subsidiary that issued warehouse receipts was found to have certified the existence of mountainous quantities of oil that did not exist. On a worst-case basis, American Express might have emerged from that crisis with no net worth. The company's stock plunged. Ben Graham would have scorned the stock because, by his definitions, it offered no margin of safety. But Buffett assessed the franchises embodied in the company's charge card and traveler's checks businesses, and concluded these were assets that could carry Amex Co. through almost any storm. Buffett had an unwritten rule at the time that he would not put more than 25% of the partnership's money into one security. He broke the rule for American Express, committing 40%, which was $13 million. Some 2 years later, he sold out at a $20 million profit. Buffett considers himself to have been nudged, prodded, and shoved toward a steady, rather than intermittent, appreciation of good businesses by Charles T. Munger, 64, vice chairman of Berkshire and the Charlie of Buffett's annual reports. In the U.S. corporate system, vice chairmen have a way of often not being important. That is decidedly not the case at Berkshire Hathaway. Munger's mental ability is probably up to Buffett's, and the two can talk as equals. They differ, however, in political views. Munger is a traditional Republican, Buffett a fiscally conservative Democrat, and in demeanor. Though sometimes cutting in his annual report, Buffett employs great tact when doling out criticism in person. Munger can be incisively frank. Last year, chairing the annual meeting of Wesco, a California savings and loan 80% owned by Berkshire, Munger delivered a self-appraisal. In my whole life, nobody has ever accused me of being humble, although humility is a trait I much admire. I don't think I quite got my full share. Like Buffett, Munger is a native of Omaha, but as boys the two did not know each other. After getting the equivalent of a college degree in the Army Air Force and graduating from Harvard Law School, Munger went to Los Angeles, where he started the law firm now known as Munger, Tolles, and Olson. On a visit back to Omaha in 1959, Munger attended a dinner party that also included Buffett. Munger had heard tales of this 29-year-old who was remaking the Omaha investment scene and was prepared to be unimpressed. Instead, he was bowled over by Buffett's intellect. I would have to say, says Munger, that I recognized almost instantly what a remarkable person Warren is. Buffett's reaction was that of a proselytizer. Convinced that the law was a slow boat to wealth, he began arguing that Munger should give up his practice and start his own investment partnership. Finally, in 1962, Munger made the move, though he hedged his bets by also keeping a hand in the law. His partnership was much smaller than Buffett's, more highly concentrated, and much more volatile. Nonetheless, in the partnership's 13-year history, extending through 1975, Munger achieved an average annual gain, compounded, of 19.8%. His wealth expanded as Buffett expected. Among other holdings, he owns nearly 2% of Berkshire, recently worth about $70 million. When he met Buffett, Munger had already formed strong opinions about the chasms between good businesses and bad. He served as a director of an international harvester dealership in Bakersfield and saw how difficult it was to fix up an intrinsically mediocre business. As an Angelino, he observed the splendid prosperity of the Los Angeles Times. In his head, he did not carry a creed about bargains that had to be unlearned. So in conversations with Buffett over the years, he preached the virtues of good businesses, and in time Buffett totally accepted the logic of the case. By 1972, Blue Chip Stamps, a Berkshire affiliate that has since been merged into the parent, was paying 3 times book value to buy See's candies, and the good business era was launched. "I have been shaped tremendously by Charlie," says Buffett. "Boy, if I had listened only to Ben, would I ever be a lot poorer?" Last year, at a Los Angeles party, Munger's dinner partner turned to him and coolly asked, "Tell me, what one quality most accounts for your enormous success?" Recalling this delicious moment later, Munger said, "Can you imagine such a wonderful question? And so I looked at this marvelous creature, whom I certainly hope to sit by at every dinner party, and said, 'I'm rational.' That's the answer. I'm rational." The anecdote has a particular relevance because rationality is also the quality that Buffett thinks distinguishes the style with which he runs Berkshire, and the quality often finds lacking at other corporations. Essentially, Buffett, as chief executive officer, does the jobs for which he judges himself to have special competence: capital allocation, pricing in certain instances, and analysis of the numbers coming out of the operating divisions. "Warren would die if he didn't get the monthly figures," says Munger. As long as the numbers are looking as they should, though, Buffett does not poke into operations, but rather leaves his managers free to run their businesses as their intelligence tells them to. When he talks about the kind of companies he wishes to buy, Buffett always stipulates that they must come in the door with their own good management because, he says, we can't supply management and won't. He is solicitous of the talent working for him. Most of the people heading his operations are rich and could retire. In what he writes and says, Buffett never lets them forget that he regards their continued hard work as one of the great rewards of his life. Buffett sets the pay of the top man in an operating company, but plays no role in compensation beyond that. All the top people are paid through incentive plans that Buffett carefully tailors to achieve whatever objectives fit: higher profit margins in a business, for example, or reductions in the capital it employs, or improved underwriting results for the insurance operation, and more float for Buffett to invest. The incentives do not have ceilings, and so it is that Mike Goldberg of the insurance business earned $2.6 million in 1986 and $3.1 million last year. On the other hand, in 1983 and 1984, when the insurance business was rotten, he earned his base salary, which is roughly $100,000. Looking ahead, and running an insurance business that is souring rapidly, Goldberg thinks he could be back at base pay again by 1990. Buffett earns base pay by all definitions $100,000 per year. At the price he offers undoubtedly the best value consulting business around. His operating managers can call him whenever they wish with whatever concerns they have, and none pass up the opportunity to draw on his encyclopedic knowledge of the way businesses work. Stanford Lipsey, publisher of the Buffalo News, tends to talk to Buffett once or twice a week, usually at night. Ralph Shea, chairman of Scott Fetzer, says he saves up his questions, checking in with Buffett every week or two. With the family Buffett usually refers to as the amazing Blumkins, who run the Nebraska Furniture Mart, the drill is dinner, held every few weeks at an Omaha restaurant. The Blumkins attending usually include Louis, 68, and his sons, Ron, 39, Irv, 35, and Steve, 33. The matriarch of the family and chairman of the Furniture Mart is Rose Blumkin, who emigrated from Russia as a young woman, started a tiny furniture store that offered rock-bottom prices. Her motto is, "Sell cheap and tell the truth," and built it into a business that last year did $140 million in sales. At age 94, she still works 7 days a week in the carpet department. Buffett says in his new annual report that she is clearly gathering speed and may well reach her full potential in another 5 or 10 years. Therefore, I've persuaded the board to scrap our mandatory retirement at 100 policy. And it's about time, he adds. With every passing year, this policy has seemed sillier to me. He jests, true, but Buffett simply does not regard age as having any bearing on how able a manager is. Perhaps because he has tended to buy good managements and stick with them. He has worked over the years with an unusually large number of older executives and treasured their abilities. My God, he says, good managers are so scarce I can't afford the luxury of letting them go just because they've added a year to their age. Louis Vincenti, chairman of Wesco, until shortly before he died at age 79, used to periodically question whether he should not be training a successor. Buffett would turn him off with a big smile. "Say, Louis, how's your mother feeling these days?" The Berkshire companies do not in any way practice togetherness. There are no company-wide management meetings, and most of the operating heads do not know one another, or at most have exchanged a few words. Buffett has never visited Feckheimer in Cincinnati. Charles Chuck Huggins, president of Sears for the 16 years Berkshire has owned it, has never been to Omaha. Naturally, Buffett does not impose any systems of management on the heads of the operating companies, who are free to be as loose or structured as they wish. Shea, 63, the chief executive of Scott Fetzer, 1987 sales, $740 million, is a graduate of Harvard Business School and uses the full panoply of management tools, detailed budgets, strategic plans, annual conclaves of his executives. A few hundred miles away at Feckheimer, 1987 sales $75 million, Robert Heldman, 69, and brother George, 67, sit down every morning in a cluttered conference room and go through all the mail that comes into headquarters. Somebody slits it open for us, though, says Bob Heldman, not wanting to be thought an extremist. As the latest businesses to be acquired by Berkshire, Scott Fetzer and Feckheimer have been getting accustomed to dealing with this unusual boss in Omaha. A few years ago, before selling to Berkshire, Shea had attempted to lead a management buyout that would have taken Scott Fetzer, a listed company, private. But Ivan Boesky meddled in the deal. The company's fate grew uncertain, and in time Buffett wrote Shea an exploratory letter. Buffett and Munger met with Shea on a Tuesday in Chicago, made an offer on the spot, and waived the due diligence rigmarole that acquirers usually demand. 1 week later, Scott Fetzer's board approved the sale. Shea regards that episode as illustrative of the lack of bureaucracy he encounters working with Buffett. If I couldn't own Scott Fetzer myself, This is the next best thing. Better, he feels, than being a public company. In that life, he had institutional investors on his neck and a board that tended to be ultra-cautious about authorizing major moves. Shea's prize example is his current intention to decentralize the World Book Organization, which has been hunkered down as Chicago's merchandise mart forever. Shea's old board, he says, would probably have resisted the risk of restructuring. Buffett waved him ahead. Shea says with a grin that Buffett has also solved the recurring problems that Scott Fetzer had finding a use for all the cash its very good businesses throw off. Now, says Shea, I just ship the money to Warren. The Heldmans at Feckheimer sold 80% of their company in 1981 to a venture capital group and, on the advice of an investment counselor, put part of the proceeds into Berkshire Hathaway stock. When the venture group decided in 1985 to get out, Bob Heldman recalled Buffett's annual report pitch for acquisitions and negotiated his way into the Berkshire fold. Though their relationship with the venture capitalists was pleasant, the Heldmans thoroughly disliked 6 New York board meetings they had to attend every year, and also the lavish expense of those meetings. Buffett, says Bob Heldman, is terrific. Is there anything that you wish he would do differently? Well, says Heldman, he never second-guesses us. Maybe he should do more of that. Buffett roars upon learning of this complaint. Believe me, if they needed second-guessing, which they definitely don't, they'd get it. Buffett can actually be very tough. He recalls landing on one of the operating divisions a few years ago when it put in a new labor-saving data processing equipment and nonetheless let its head count in the accounting department go from 16.5 to 22.5. For all of his laid-back management style, Buffett knows about numbers like that and deplores them. There is a right-size staff for any operation, he thinks, whether business is good or bad, and he is totally impatient with unnecessary costs and managers who allow them to materialize. He says, whenever I read about some company undertaking a cost-cutting program, I know it's not a company that really knows what costs are all about. Spurts don't work in this area. The really good manager does not wake up in the morning and say, this is the day I'm going to cut costs, any more than he wakes up and decides to practice breathing. When they criticize him, which they do only mildly, Buffett's operating managers tend to think him too rational and demanding about numbers. No one can quite imagine him paying up for a small seed business with a possible future but no present. Buffett and Munger are not in the least suffused with animal spirits. They do not even consider making discretionary capital expenditures, say for flashy offices, that aren't going to do them any economic good. Neither are they inventors. Says Buffett, we don't have the skill to be. Above all, I guess you'd say we have a strong sense of our own limitations. They are not timid, though, about prices. Buffett works with the heads of both Seas and the Buffalo News in setting prices once a year, and he has tended to be aggressive. A chief executive, he says, can bring a perspective to pricing that a divisional manager cannot. The manager has just one business. His equation tells him that if he prices a little too low, it's not that serious. But if he prices too high, he sees himself screwing up the only thing in his life. And no one knows what raising prices will do. For the manager, it's all Russian roulette. For the chief executive, with more than one thing in his life, it really isn't. So I would argue that someone with wide experience and distance from the scene should set prices in certain cases. Buffett extends his own experience to one other kind of pricing, the setting of premium rates for large risk insurance policies, such as product liability coverage. That game is one of 7- and 8-figure premiums, probabilities, and years of float. It is a game made to order for Buffett, who tends to do a few calculations in his head and come up with a bid. He does not own a calculator, or a computer or abacus, he says, and would never see himself as needing any kind of mathematical crutch. Though the point is hardly provable, he must be the only billionaire who still does his own income tax. At his office in Omaha, in fact, he does what he pleases, leading an unhurried, unhassled, largely unscheduled life. Counting the boss, headquarters includes only 11 people, and that's a shade too many, Buffett thinks. The place is kept efficient by his assistant, Gladys Kaiser, 59, who has worked for him 20 years and for whom he wishes perpetual life. If Gladys can't have it, Buffett says, I'm not sure I want it either. He spends hours at a stretch in his office, reading, talking on the phone, and in the December to March period, agonizing over his annual report, whose fame is one of the profound satisfactions of his life. He is not in the least moody. When I talk to him, says Chuck Huggins of Seas, he's always up, always positive. But in general, he is something of a loner in his office, apt there to be less communicative and gracious than when talking on the phone to friends or the operating managers. Munger thinks it would not work for the managers to be physically in the same place as Buffett. He's so damn smart and quick that people who are around him all the time feel a constant mental pressure from trying to keep up. You'd need a strong ego to survive in headquarters. Goldberg, whose ego has been put to the test, says it's not easy. I've had a chance to see someone in action who can't be believed. The negative is, how do you ever think much of your own abilities after being around Warren Buffett? When Buffett is buying stocks, he often interrupts other phone conversations to talk on 3 direct lines that connect him with brokers. But he will say in the new annual report that he has not found much to do in stocks lately. During the break in October, he writes, a few stocks fell to prices that interested us, but we were unable to make meaningful purchases before they rebounded. At year-end, Berkshire held no stock positions worth more than $50 million. Other than his permanent holdings, and a short-term $78 million arbitrage position in Allegis, which is radically restructuring. The friends that Buffett talks to on the phone and often sees include a few other chief executives, among them the Washington Post's Katharine Graham and Cap City's Murphy. Graham has leaned on him for advice for years. As she says, I'm working on my degree from the Buffett School of Business. Buffett thinks Murphy the finest executive in the country, but Murphy tunes in for advice also. I talk to him about all the important aspects of my business, says Murphy. He's never negative and always supportive. He's got such a massive mind and such a remarkable ability to absorb information. You know, we're supposed to be pretty good managers around here, but his newspaper outdoes ours. Buffett himself thinks that his investing abilities have been helped by his business experiences, and vice versa. Investing, he says, gives you this wide exposure that you just can't get directly. As an investor, you learn where the surprises are, in retailing, for example, where business can just evaporate. And if you're a really good investor, you go back and pick up 50 years of vicarious experience. You also learn capital allocation. Instead of putting water in just one bucket, you learn what other buckets have to offer. On the other hand, he goes on, could you really explain to a fish what it's like to walk on land? One day on land is worth 1,000 years of talking about it, and one day running a business has exactly the same kind of value. Running a business really makes you feel down to your toes what it's like. His summary judgment? It's been awfully good to have a foot in both camps. Buffett and Salomon. No one made a movie out of Buffett's experience at Salomon Brothers. They could have. They could even have called it Too Big to Fail, though its ending would have been far different from the one in that 2011 movie. Buffett himself, commenting in Berkshire's 1997 annual report about Salomon's sale to Travelers, which was soon to be reconstituted as Citigroup, ended with one of his stand-up comic bits. Looking back, I think of my Salomon experience as having been both fascinating and instructional, though for a time in 1991 to 1992, I felt like the drama critic who wrote, "I would have enjoyed the play except that I had an unfortunate seat. It faced the stage." In case you don't notice the dates as you start to read the two Salomon articles that follow, please note that the two were published 9 years apart. The first of these, The Wisdom of Salomon, was a sidebar contained in The Inside Story of Warren Buffett, which you have just read. This short piece describes the beginning of the Salomon tale, the out-of-the-ordinary $700 million investment in the company that Berkshire made in 1987. What no one could then have dreamed, of course, was that within a very few years, specifically in the 1991 to 1992 period that Buffett referred to in the quotation above, Salomon would, A, get into terrible trouble for illegal trading in Treasury securities, and, B, Buffett would be forced to parachute in to try to save it. Those events are spelled out in Warren Buffett's wild ride at Salomon. But that article, for unusual reasons, did not see the light of day until a string of years had passed. The story itself, in its opening paragraphs, explains the delay in publication. To read the 1997 story today, and to realize how close Salomon came to bankruptcy in 1991, at least as Buffett saw it, is inevitably to think about Lehman Brothers, which many years later did go bankrupt. In the Salomon article is a one-sentence description of the chaos that an emotional Buffett warned Washington would ensue if the firm failed. Said the sentence, he predicted that a Salomon bankruptcy would be calamitous, having domino effects that would reach worldwide and play havoc with a financial system that subsists on the expectation of prompt payments. We'll never know about Salomon because Buffett's pleas saved it. But that is an all-too-perfect description of what happened in 2008 when Lehman went down. C.L. The Wisdom of Salomon, April 11, 1988, by Carol Loomis. We have no special insights regarding the direction or future profitability of investment banking, says Warren Buffett in the forthcoming Berkshire Hathaway annual report for 1987. What we do have a strong feeling about is the ability and integrity of John Gutfreund, CEO of Salomon, Inc. With that declaration, Buffett takes a hatchet to the rumors that have been sweeping Wall Street for months, in which he is typically presented as wanting A, Gutfreund out, and B, someone like William Simon in. Since Buffett has a policy of not making hostile moves against the managements of companies he invests in, the rumors were always a reach. But the timing of Buffett's push into Salomon last year almost guaranteed that stories would begin to fly. On October 1st, he put $700 million of Berkshire's money, his biggest investment ever, into Salomon Redeemable Convertible Preferred. The stock pays 9%. Is convertible after 3 years into Salomon Common at $38, and if not converted, will be redeemed over 5 years beginning in 1995. The rub is the $38. Salomon stock was around $33 when Buffett made the deal. After October 19, it sank to almost $16 and was recently about $23. The crash transformed the street's perception of Buffett's move. He was originally thought to have bought a dream security, worth more than he paid. Salomon, it was said, had panicked at the prospect that raider Ronald Perlman might try a takeover and had allowed Buffett his own bit of banditry. The post-crash reading, which takes into account many defections and much turmoil at Salomon, is that Buffett has bought a bummer, and that his whole credibility as an investor is at stake. Buffett notes in his annual report that the economics of investment banking are far less predictable than those of most businesses in which he has major commitments. He says that's one reason he went for a convertible preferred. But he also sounds serene in outlook. We believe there is a reasonable likelihood that a leading high-quality capital-raising and market-making operation can average good returns on equity. If so, our conversion right will eventually prove valuable. By the way, he adds, he'd like to buy more convertible preferreds of the Salomon variety, which sounds like Serenity squared. The most fascinating aspect of Buffett's Salomon investment is that it puts him in bed with Wall Streeters, whose general greed he has scored in the past. In his 1982 annual report, he derided the inclination of investment bankers to provide whatever advice would bring in the most income. Don't ask your barber whether you need a haircut, he said. But this year's report suggests he finds Gutfreund's barbering a cut above. In dealings with Gutfreund, Buffett says he has seen him advise clients not to take steps they were itching to take, even though that caused Salomon to miss out on large fees. Note that Buffett's description of Salomon's business does not include those Wall Street buzzwords, merchant banking. To Buffett, the bridge loans that are the current merchant banking fad and that grease the way for many leveraged buyouts all too often look like dangerous commitments, debt so junior that it is almost equity. He and his associate, Charles Munger, are directors of Salomon, and may well argue that the firm should avoid making bridge loans. But, says Buffett, if John Gutfreund ends up thinking he wants to do them, we will support him. We don't go into companies with the thought of effecting a lot of change. That doesn't work any better in investments than it does in marriages. Warren Buffett's Wild Ride at Salomon, October 27, 1997. By Carol Loomis. A harrowing, bizarre tale of misdeeds and mistakes that pushed Salomon to the brink and produced the most important day in Warren Buffett's life. As Sanford I. Weil, 64, the deal-making CEO of Travelers Group, steps up to his biggest acquisition ever, the purchase of Salomon Inc. for $9 billion, a famous Wall Street figure, Warren E. Buffett, 67, steps out of Salomon. His days there began almost precisely a decade ago, in the early fall of 1987, when his company, Berkshire Hathaway, became Salomon's largest shareholder, and he moved in as a director. But that was training wheel stuff, nothing to the high-wire unicycle act that came later. Buffett was physically, emotionally, and really at Salomon for 9 months in 1991 and 1992, when the firm's trading illegalities created a giant sucking sound that brought him in to run the place. Though much has been written about Buffett and Salomon, a lot of what you will read here will be new. I have been a friend of Buffett's for about 30 years and have long been a shareholder of Berkshire, though never a shareholder of Salomon. As a friend, I do some editing every year on Buffett's well-known annual report, and we have for eons talked about collaborating on a book about his business life. All this has given me many opportunities to learn Buffett's thinking. Some of what I've gleaned has ended up in Fortune stories that I wrote, especially in an April 11, 1988 article, The Inside Story of Warren Buffett, and in an accompanying box, The Wisdom of Salomon. But much of what I learned about Buffett's experiences at Salomon in 1991 was confidential, embargoed by him because Salomon was both struggling to regain its footing and dealing with big legal problems. Later on, though those emergencies eased and the embargo might have been lifted, there was no immediate reason to print the story. Now, with the Travelers' deal, there is. To that reason, add another. This drama of 1991 sends a powerful message about the hazards lurking in a financial system that every day grows more complex. This tale should begin with the thought that the 10 months Buffett spent at Salomon were a profound break in the rhythm of his life. Warren Buffett is an executive accustomed to making maybe one big investment decision a year, but Salomon left him dealing with 25 operating decisions a day. At the center of this experience was a single day, what he has called the most important day of my life, Sunday, August 18, 1991, in which the U.S. Treasury first banned Salomon from bidding in government securities auctions and then, because of Buffett's efforts, rescinded the ban. In the 4 hours of suspense between the two actions, Buffett struggled passionately to ward off a tragedy he saw threatening to unfold. In Buffett's opinion, the ban put Salomon, this company now being priced at $9 billion, in sure danger of having immediately to file for bankruptcy. Even more important, he believed that on that day, as he does now, that the collapse of Salomon would have shaken the world's financial system to its core. That Sunday in August was a far cry from the commercialism of another Sunday, September 27, 1987, when Buffett and John Gutfreund, then Salomon's chairman and CEO, agreed that Berkshire Hathaway would buy $700 million of Salomon convertible preferred stock, which equated to a 12% stake in the company. The deal allowed Gutfreund to stave off takeover artist Ronald Perlman, who seemed poised to buy a large block of Salomon common stock from certain South African investors wanting to sell. With Berkshire's $700 million, Gutfreund was able to strike a deal that allowed Salomon itself to buy the South African stock, and with that, Perlman was dispatched. It was easy to see why Gutfreund welcomed Warren Buffett, White Knight. It was less easy to see why Buffett wanted to hook up with Salomon, much less trust it with this mint $700 million, the largest amount he'd ever invested in a single company. Over the years, Buffett had derided investment bankers, deploring their enthusiasm for deals that provided huge fees but that were turkeys for their clients. He has also spoken often of wanting to work only with people he likes. So here he was, handing over mountains of Berkshire's carefully accumulated and husbanded cash to the high-living, cigar-chomping, corner-cutting crowd soon to be made infamous in liar's poker. Several reasons explain the move, none of them really good enough in the light of what followed. One is that Buffett had been having trouble for a couple of years finding stocks he thought reasonably priced and was looking for fixed income alternatives. A second is that the Salomon proposal came from John Gutfreund, whom Buffett had seen do principled, non-greedy, client-friendly work for Geico, in which Berkshire was then a major stockholder, and which is now owned 100% by Berkshire. Buffett liked Gutfreund, still does, in fact. A third explanation was simply that Buffett thought the terms of the deal worth accepting. In effect, convertible preferreds are fixed income investments with lottery tickets attached. In this case, the security was to pay 9% and be convertible after 3 years into Salomon common stock at $38 a share, against the $30 for which the stock had been selling. If Buffett did not convert the stock, it was to be redeemed over 5 years beginning in 1995. To Buffett, it looked like a decent proposition. Quote, "It's not a triple, which is what you'd like to have," he said to me in 1987, "but it could work out okay." To some of the brainy mathematical types at Salomon, That appraisal would have qualified as the understatement of the year. From day one, they thought, and let it be known to the press, that Buffett had exploited Gutfreund's fear of Perlman and had secured a dream security, with a too high dividend or a too low conversion price or some combination thereof. Over the next few years, this opinion did not die at Salomon, and more than once executives of the firm, though never Gutfreund, came to Buffett with propositions for deep-sixing the preferred. It's fair to say that Buffett might have taken those offers more seriously had he known that ahead lay the business-wrecking, profit-shredding scandal that broke in August 1991, and that turned the world upside down for both Salomon and him. A little stage setting here. Before the crisis hit, Salomon was on its way to an excellent business year, marred only by a Treasury investment into a May T-bill auction in which Salomon was thought perhaps to have engineered a short squeeze. Despite that sticky matter, Salomon's stock had climbed to $37 a share, a price very near Buffett's conversion point of $38. For the story of what then happened, we may begin with Buffett in Reno. Yes, Reno, which was the spot two executives of a Berkshire subsidiary had picked for an annual getaway with Buffett. Arriving in Reno on the afternoon of Thursday, August 8, Buffett checked with his office and found that John Gutfreund, en route at that moment from London to New York, wanted to talk with him that evening. Gutfreund's office said he'd then be at Salomon's principal law firm, Watchell, Lipton, Rosen and Katz, and Buffett agreed to call him there at 10:30 p.m. New York time. Mulling this over, Buffett concluded that it couldn't be bad news because Gutfreund hadn't been in New York to attend to it. Maybe, he thought, Gutfreund had made a deal to sell Salomon and needed a quick okay from the directors. Heading out to dinner in Lake Tahoe, Buffett actually told his group that he might be hearing good news before the evening was out, a characterization indicating Buffett was ready to bail from this supposedly plummy deal he'd gotten into 4 years earlier. At the appointed time, breaking from dinner, Buffett stood at a payphone to make his call. After a delay, he was put through to Salomon's president Tom Strauss and its inside lawyer Donald Feuerstein, who told him that because Gutfreund's plane had been held up, they would instead brief Buffett on a problem that had arisen. Speaking calmly, they said that a Watchell-Lipton investigation commissioned by Salomon had discovered that 2 of its government securities traders, including the top gun, managing director Paul Moser, a name Buffett didn't know, had broken the Treasury's bidding rules on more than one occasion in 1990 and 1991. Moser and his colleague, said Strauss and Feuerstein, had been suspended, and the firm was now moving to notify its regulators and to put out a press release. Feuerstein then read a draft of the release to Buffett and added that earlier in the day he had talked at some length to Salomon director Charles T. Munger, Berkshire's vice chairman and Buffett's sidekick in everything important. The release contained only a few details about Moser's sins, but a fuller account dribbled out over the next few days, depicting a man at war with the Treasury over bidding rules that he despised. A new rule, promulgated in 1990 to prevent such behemoths as Salomon from cornering the market, said that a single firm could not bid for more than 35% of the Treasury securities being offered in a given auction. In December 1990, and again in February 1991, Moser simply made hash of this rule by, first, bidding for Salomon's allowable 35%, second, submitting, without authorization, separate bids for certain customers, and, third, simply stuffing the securities that these bidders won into Salomon's own account, never telling the customers a word about the whole exercise. From all this, Salomon emerged with more than 35% of the auctioned securities and with increased power to swing its weight around. On that Thursday night, with other payphoners chatting all around him, Buffett did not hear nearly that much detail, nor detect in Strauss and Firestein's matter-of-fact tones any reason to be particularly alarmed. So he went back to dinner. Only on Saturday, when he reached Munger, then vacationing on a northern Minnesota island, did Buffett get a sense of real trouble. Munger, a lawyer by training, had stopped Firestein's recital 2 days earlier to explore what Firestein meant by saying to use the words that were on a sheet of, quote, talking points drawn up by lawyers for these calls, that, quote, one part of the problem has been known since late April. In writer speak, that is the, quote, passive voice, and it raises an obvious question, quote, who knew? Munger bore down on that question and found out that Moser, believing that he was about to be unmasked, had disclosed the February bidding infractions to his boss, John Merriweather, in late April. Calling Moser's behavior career-threatening, Merriweather immediately went to Strauss with the news, and, days later, met with Strauss, Gutfreund, and Firestein to decide what to do. Firestein advised the others that Moser's act was probably criminal, and the group concluded that the New York Federal Reserve must be told what had happened. But then, no one did a thing about telling, neither in April nor in May, June, or July. That was the inaction that Buffett later said was inexplicable and inexcusable, and that pushed the crisis to its limits. Talking to Buffett on that Saturday, Munger called management's extended failure to act thumb-sucking, which is a term Buffett thinks he heard repeated when he himself was talking to Strauss and Firestein. But he does not otherwise think the two men made any effort to clearly inform him about top management's part in this mess. Some of Salomon's regulators later voiced a similar complaint, saying they were told about top management's dereliction but in soft, shrouded words that failed to get the point across. Even so, that left them better off than the public, which in the August 9 press release learned absolutely nothing about management's having known anything at any time. In his phone conversation with Firestein, Munger sharply challenged the omission. But Firestein said that management and its lawyers worried that too much disclosure would threaten the firm's funding, its ability to roll over the billions of dollars of short-term debt that became due every day. So Salomon's plan was to tell its directors and regulators that management had known of Moser's misconduct, but to avoid saying this publicly. Munger didn't like it, finding this behavior neither candid nor smart. But not considering himself an expert on funding, he subsided. When he and Buffett talked on Saturday, however, with the Salomon story played big on the front page of the New York Times, they resolved to insist on prompt disclosure of the full facts. On Monday, Munger delivered their strong opinions to Gutfreund's close friend and advisor, Martin Lipton of Watchell Lipton, and was told that the matter would be discussed at a telephone board meeting scheduled for Wednesday afternoon. Buffett, meanwhile, was talking to Gutfreund, who allowed that just about all the affair meant was a few points on the stock. At the Wednesday board meeting, the directors heard a reading of a second press release, which included 3 pages of details and a straightforward admission that top management had learned of Moser's February transgression back in April. But a sentence that followed sent the directors into a telephonic uproar. It said that management had then failed to go to the regulators because of the, quote, press of other business. Buffett, listening in Omaha, remembers calling this impossibly lame excuse ridiculous. The explanation in the press release was later changed to incorporate the words, due to a lack of sufficient attention to the matter this determination was not implemented promptly. Another passive voice specimen slightly less lame, but unflinching in its refusal to assign any blame. The real offense of that Wednesday directors' meeting, though, was not language, but a flagrant omission. Gutfreund's failure to tell the board that he had the day before received a letter from the Federal Reserve Bank of New York that contained some doomsday words. The letter was signed by an executive vice president of the bank, but anyone reading it would have known that behind it stood 6 feet 4 inches of Irish force and temper, Gerald Corrigan, the bank's president. Corrigan by then knew enough to have become incensed by these doings on his watch. The letter said that Salamon's bidding irregularities called into question its continuing business relationship with the Fed and pronounced the Fed deeply troubled by the failure of Salamon's management to make a timely disclosure of what it had learned about Moser. It asked for a comprehensive report within 10 days of all irregularities, violations, and oversights Salomon knew to have occurred. Buffett learned later that Corrigan expected the letter to be promptly given to Salomon's directors, whom he believed would just as promptly recognize that top management had to be changed. When the directors didn't act, Corrigan thought they were being defiant, but instead, of course, they were simply in the dark. Buffett did not hear about any Fed letter until later in the week, when he spoke to Corrigan, and even then Buffett assumed the Fed had only sent a request for information. Buffett did not actually see the letter until more than a month later, after he heard Corrigan refer pointedly to it in congressional hearings. In Buffett's opinion, the Fed's belief that its letter had been ignored stoked the fury with which the regulators came down on Salomon a few days later. There is no shortage, Buffett says, of vital matters that Gutfreund, Strauss, and Feuerstein kept from the directors in the previous months, all the while acting as if things were perfectly normal. But not conveying the Fed letter to the board was in his thinking the atom bomb. Or maybe, he says, a more earthy description fits. Understandably, the Fed felt at this point that the directors had joined with management in spitting in its face. You may reasonably ask what was going on in Salomon's stock while all of this was transpiring. It was emphatically down, from above $36 per share on Friday to under $27 on Thursday, when the second press release rocked the market. But the stock was only the facade for a much graver matter, a corporate financial structure that by Thursday was beginning to crack because confidence in Salomon was eroding. It is not good for any securities firm to lose the world's confidence. But if the firm is credit-dependent, as Salomon was to an extreme, it cannot tolerate a negative change in perceptions. Buffett likens Salomon's need for confidence to a mortal's need for air. When the required good is present, it's never noticed. When it's missing, that's all that's noticed. Unfortunately, the erosion of confidence was occurring in a company grown enormous. Salomon in August of 1991 had bulged up to $150 billion in assets, not counting, of course, huge off-balance sheet items, and was among the 5 largest financial institutions in the U.S. Propping the company on the right-hand side of the balance sheet was, are you ready? Only $4 billion in equity capital, and above that was about $16 billion in medium-term notes, bank debt, and commercial paper. This total of about $20 billion was the capital base that supported the remaining $130 billion in liabilities, most of these short-term due to the runoff in 1 day to 6 months. The paramount fact about those liabilities is that short-term lenders have their track shoes on at all times. They have absolutely no enthusiasm for earning an extra fraction of a percentage point in interest if they perceive that their capital is even slightly at risk. Just waving a premium rate in front of them is in fact counterproductive, since it makes them suspect there is hidden danger. Moreover, unlike commercial banks, whose creditors can look to the FDIC or the too-big-to-fail doctrine, securities firms have no declared Big Daddy, whose mere presence is a deterrent to runs. So on that Thursday, Salomon began to experience a run. It materialized out of left field in the form of investors who wished to sell this big league trader and market maker, Salomon, its own debt securities, specifically the medium-term notes that the company had outstanding. Salomon had always made a market in these securities, but that was ordinarily a yawn, since nobody wanted to sell. But now the sellers poured in. Salomon's traders responded by lowering their bids, trying to deter the traffic, dying to do that, in fact, because every repurchase of notes they made melted down the capital base that was holding up the whole Salomon structure. Finally, after the traders had bought about 700 million of the notes, Salomon did the unthinkable. It stopped trading in its own securities. That called a halt on the rest of the street, too. If Salomon wasn't going to buy its own paper, it's for sure nobody else would. That Thursday evening, as newspapers cranked out their stories of the day's extraordinary events at Salomon, when the teller's windows slammed down, there's no keeping it secret. John Gutfreund and Tom Strauss talked by phone to Jerry Corrigan. Trouble was all around, and in the conversation Gutfreund and Strauss questioned their ability to keep leading Salomon. The next morning, at 6:45 a.m. Omaha time, Buffett was awakened by a phone call. On the line were Gutfreund, Strauss, and Marty Lipton. Gutfreund said that he and Strauss were resigning, and the question of who was going to take over sort of hung there. Gutfreund later said he asked Buffett to take the job. Buffett thinks he volunteered. He did not in any case nail down anything while at home, but instead said he would call the New Yorkers when he got to his office 5 minutes away. Once there, he looked at a just-arrived fax of the day's New York Times story whose front-page headlines was, "Wall Street sees a serious threat to Salomon Brothers, high-level resignations, and client defections feared." And at 7:45 a.m. Omaha time, he called the Salomon Group back and said he would take on the job until things got straightened out. To this day, newspapers report that he went in to protect Berkshire's 700 million. But that seems awfully simplistic. Sure, he wished for the safety of that investment. But beyond that, he was a director of a company in deep trouble. And, in a way that few directors do, he felt an obligation to all of its shareholders. In addition, he had a job, CEO of Berkshire, that he could for a while run with one hand while picking up trouble in the other, and for the $1 a year he earned at Salomon, he didn't need to waste time working out an employment contract. Okay, he knew he was changing his life, and not for the better. Quote, "But somebody had to take this job," he said then, and has said since, and I was the logical person. On that Friday morning, Buffett made immediate plans to fly to New York, but the group from Salomon had asked him to stay at his office to await a call from Corrigan, and it was slow in coming. While Buffett waited, the stock market opened, but trading in Salomon stock did not. Then came the call from Corrigan. It was short and contained the word that he was willing to let up a little on the 10-day schedule, now that Buffett was entering the picture. Not having seen the Fed's letter, Buffett didn't have a clue what Corrigan was talking about, but grasped from the context that the Fed must be asking for information. When the conversation ended, Buffett flew to New York, arriving there around 4 p.m. By that time, Salomon had released the news that he was becoming the interim chairman, and the New York Stock Exchange had opened up trading in the stock. In its brief exposure to the light, the stock traded heavily and moved up $1, closing just under 28. Buffett's own exposure that day included an evening meeting with Corrigan at the Fed's office. Gutfreund and Strauss went too, and the three men stepped into a session totally devoid of the cordiality that normally greets Buffett. Corrigan said soberly that he hadn't found that interim chairmanships worked well, warned Buffett that he should not attempt to get around Corrigan by seeking help from Washington friends, and, in a dire but mysterious comment, told Buffett to prepare for any eventuality. Then he asked Buffett to step out while he talked privately to Gutfreund and Strauss, two men who had long been, past tense needed here, friends of his. When the two emerged, Gutfreund told Buffett that Corrigan had emotionally expressed his personal regrets about the part he was playing in ending their careers. Gutfreund, iron tough to the end, angrily dismissed the incident when talking to Buffett, saying he wasn't about to grant Corrigan absolution. Today, Buffett, recalling those strange moments, remembers also that George Washington cried as he was signing the death warrant of Major Andre, a British spy. But, like Corrigan, he signed. For Buffett, the rest of Friday and all of Saturday were given over to crucial operating decisions. One obliged him to address the fate of John Merriweather, who had sped to tell his bosses about Moser's misdeeds when he learned of them, but then had willingly or unwillingly got caught up in the web of non-disclosure. Marty Lipton, terribly visible in these crises days, wanted Merriweather fired, and so did a good many members of the management committee, who were clawing for anything that might save the firm. But Buffett, unclear that it was fair to fire Merriweather, kept searching for more understanding of what had truly happened after April. He gained some knowledge on Saturday, when two Watchell-Lipton lawyers spent more than an hour telling Buffett and the surviving members of Salomon's management committee what they had learned in their investigation, which had begun in early July. Then, late on Saturday, the Merriweather question became moot, because he himself decided it was best that he resign. The still bigger decision facing Buffett was determining which member of Salomon Brothers' executive group would become the new head of the securities operation, now losing its two bosses, Gutfreund and Strauss. So on Saturday, at Watchell-Lipton's offices, Buffett talked serially to about 10 members of Salomon's management committee, asking each man whom, among this group, he thought most qualified to run the business. The great majority said Derek Maughan, then 43, who had recently returned from running Salomon's Tokyo office and been made co-head of investment banking. Maughan himself had a subtle answer. I think that when you ask many of the others whom they want, you'll find it's me. Buffett knew also that Gutfreund thought the choice should be Maughan. So Buffett identified this man that day. But he held off telling both Maughan and the world because the Salomon board, ready to meet in emergency session at 10 a.m. on Sunday, August 18, needed to ratify the decision and indeed to elect Buffett himself. Had the whole regulatory establishment slept through that weekend, the board meeting would still have been a landmark event. But as it was, on Saturday, Salomon's regulators were putting the finishing touches on a guided missile. It hit Salomon's offices in downtown Manhattan just before 10 a.m. on Sunday, by way of a phone call from the Treasury, saying that in a few minutes, It would announce that Salomon would be barred from bidding at Treasury auctions both for its own account and for customers. Buffett got the message in a small room where he was talking with a handful of people, including two, Gutfreund and Strauss, who were set to offer their resignations at the meeting. The three men immediately concluded that the news would put Salomon out of business, not because of the economic loss that would be sustained because of the Treasury's lockout, but because the world would interpret the news as Treasury to Salomon drop dead. Furthermore, this blow would fall on a company already staggered by credit problems and just barely hanging on. Nor was there time to maneuver. Word had already gone out that Buffett would appear at a 2:30 p.m. press conference, and a crowd of journalists was expected. Worse than that, the tyranny of a worldwide market was bearing down on the firm. The Japanese market would be opening in the late afternoon, and then London, and then New York. Bad news would cascade from one market to the other, and center on just one thought. Salomon's credit is shot. In a firm dependent on credit, other thoughts didn't matter anyway. This one alone would destroy the company. In the small room where they got the news, Buffett and the others huddled to consider their options. They saw three possible courses of action. First, get the Treasury to rescind or at least modify the ban. Second, put on a brave face, spout confident statements, and hope that the world would buy the act, or, in other words, lie. Third, liquidate by declaring bankruptcy, hoping thereby to fail honorably, minimize the damage, and spread its effects equitably among Salomon's creditors. The second strategy got ditched almost before it was articulated. The other two lived and were pursued simultaneously. That meant bankruptcy lawyers needed to be called in. A team was summoned from Watchell Lipton and put to work investigating how a mammoth international securities firm goes bankrupt on a Sunday, possibly needing some judge yanked from watching baseball and eating popcorn who might suspect that a careless typist had added an extra zero to that figure of 150 billion, and who would in any case probably never have heard of a derivative or repos or fails to deliver. In short, the bankruptcy filing, if things came to that end, was going to be a nightmare. In a personal sense, it would have been that for Buffett also. His job description was on the verge of drastic changes that would leave him no reason for being there. He had come to save Salomon, not to escort it through the endless process of bankruptcy. All manner of people could do that job, he told himself. So early on that Sunday, Buffett concluded that he would refuse election if bankruptcy ensued. He did not, however, kid himself about the furor that would follow, since he knew that his exit would be viewed as the abandonment of a sinking ship, or, worse yet, as the very cause of its going down. Buffett had long told his three children that it takes a lifetime to build a reputation, but only 5 minutes to tear it down. As he moved along through Sunday, he told himself he might be edging up on the 5 minutes. But that did not short-circuit a ton of energy he was putting into Plan A, getting a reversal of the ban. Buffett assigned himself to calling the Treasury and also talked once that day to Fed Chairman Alan Greenspan. Gutfreund and Strauss were put on the job of finding Corrigan, who proved hard to reach. Merriweather, lending help, was told to track down Richard Breeden, chairman of the SEC. That thrust turned out to be a total non-winner. Breeden, once Merriweather got him, said he had participated in the Treasury's decision, pronounced Salomon rotten to the core, and said it would get no help from him. On the Treasury front, logistics dealt an early blow. When Buffett tried almost immediately to call back the Treasury official who had delivered the awful message, the line was busy. The phone company agreed to interrupt the call. but there was confusion and error and delay. By the time Buffett actually got through to the Treasury spokesman, the announcement of the Treasury ban had hit the wires and gone flashing around the world. The Treasury spokesman then got Secretary of the Treasury Nicholas Brady, at that moment visiting Saratoga Springs, New York, for the horse races, to call Buffett. The two men had been friendly acquaintances over the years, but could hardly have imagined they would be facing off on this Sunday morning. His voice cracking with emotion and strain, Buffett made his case, telling the secretary that Salomon could not cope with the Treasury ban and that it was bringing in bankruptcy experts to prepare for a possible filing. Buffett stressed Salomon's gargantuan size and the worldwide nature of its business. He predicted that a Salomon bankruptcy would be calamitous, having domino effects that would reach worldwide and play havoc with a financial system that subsists on the idea of prompt payments. Doomsday scenarios are not easy to get across. Responding, Brady was friendly and empathetic, but inclined to think this talk of bankruptcy and financial meltdowns was far-fetched. He could not imagine Buffett refusing to take the job or failing in its execution. Brady was also highly aware of where things stood. The announcement had gone out, and reversing it would be an enormous problem. But, to Buffett's enormous relief, Brady did not cut off the dialogue. Instead, he went off to make some calls, and then kept getting back to Buffett. In one of the stranger details of the day, Buffett talked on Salomon's phones that had been programmed not to ring, but instead flashed a tiny green light when someone was calling. For longer than he cares to remember, Buffett stared at the telephone, waiting for the Secretary of the Treasury to create light. With each call, Buffett tried to make Brady realize the seriousness of the situation and his sense that they were rocketing along on a train that had to be stopped. But that could be, once everybody realized that this was an accident that mustn't be allowed to happen. At one point in the Brady conversations, all of Buffett's anguish and sense of futility got jammed into a single sentence. "Nick, this is the most important day of my life." Brady said, "Don't worry, Warren, we'll get through this." But that didn't mean at all that he had changed his opinions. It took Corrigan's entrance into the telephone calls in the afternoon to make a difference. This was the man who told Buffett to prepare for any eventuality and defined his term by endorsing the ban. But Corrigan now listened hard and seemed to assign credence to Buffett's talk of bankruptcy and of his personal plans to leave were a filing to come. Said Corrigan to Brady and another regulator on the phone with them, "We better talk among ourselves." Buffett went back into the boardroom and waited with the other directors. 6 floors below, over 100 reporters and photographers, this author among them, were gathering for the 2:30 press conference. Directly outside the boardroom, some of the managing directors that Buffett had interviewed on Saturday were milling around, summoned because one of their number was to be named operating head of Salomon. And then, just at 2:30, Jerome Powell, an assistant secretary of the Treasury, called Buffett to read a statement the Treasury was ready to go with. It was effectively half a loaf, or maybe 2/3, saying that the ban on Salomon's bidding for its own account was lifted, while the ban on bidding for customers' accounts remained. "Will that do?" asked Powell. "I think it will," answered Buffett. The board then raced through electing Buffett as interim chairman of Salomon, Inc., and Derek Mon as a director and operating head of Salomon Brothers. Buffett found Mon and said, "You're tapped," and the two went down to the press conference, entering at 2:45. The start was abrupt. "I'm Warren Buffett, and I was this afternoon elected interim chairman of Salomon, Inc." A few minutes later, he was into the just-released Treasury announcement, which he read aloud. When he finished, There were muffled cheers from the back of the auditorium and a scrambling of feet as employees ran with the life-saving news. Buffett then moved into more than 2 hours of questions. "How will you handle needing to be both here and in Omaha?" he was asked, and the answer popped right back. "My mother has sewn my name in my underwear, so it'll be okay." On Monday, the headlines didn't say drop dead. They took in the reversal as well as the ban. Salamon's stock opened on time and traded in orderly fashion, falling about 1.5 points. Pointing out a paradox, Buffett says today that the whole Treasury episode, excruciating though it was at the time, probably gave Salomon a boost that it could not have got any other way. The reversal, coming along at 2:30 p.m., sent a message to the market that this almighty regulator, the Treasury, thought Salomon was okay. Had not that endorsement materialized, Monday's debt markets would have been forced to make their own determination about Salomon's credit worthiness, and who knows what kind of thoughts they would have pulled from the ether. As it was, Salomon emerged from that weekend with just enough stamina to limp through some exceedingly tough months, in which the interim CEO reduced leverage by vastly shrinking the balance sheet, haggled with banks about money Salomon badly needed, and hoped above all else that Moser's wrongdoing, which cost him nearly 4 months in prison after he pleaded guilty to lying to the Fed, would not entrap Salomon itself in criminal charges. In the end, the company settled for $290 million, an outcome mainly reflecting the extraordinary cooperation Buffett decreed should be given both regulators and the law in getting things cleaned up. A big broom in this cleanup was a California lawyer who had worked often for Berkshire, Robert Denham, and whom Buffett pulled into Salomon full-time. When May of 1992 rolled around, with many of Salomon's biggest problems under control, Buffett went back to Omaha, and Denham stepped into his place as chairman of Salomon, Inc., and overseer of the shareholders' interests. Having now overseen these folk into $9 billion of Travelers' stock, Denham will be stepping on to something else. And Berkshire's part of the $9 billion? It's about $1.7 billion, though some of the Travelers' stock Berkshire will receive is committed to holders of a Berkshire convertible bond. About that complication you do not wish to know more, nor do you wish to deeply analyze other acrobatics that Buffett has carried out with Salomon stock. Just note this. A share of Salomon is right now worth about $81 in Travelers' stock. Against that, Berkshire owns some Salomon stock that it bought in 1987 at an effective price of $38, and it owns other Salomon shares purchased later at an average price of about $48. In short, Buffett said in 1987 that Salomon wouldn't be a triple, and it hasn't been. On the other hand, this record hardly equates to a strikeout. "I'd say we hit a scratch single," says Buffett, but not before the count got to 0-2. And then inching oh so slightly toward a philosophical summary of Salomon, he hauls out one of his favorite expressions, "All's well that ends." From Now Hear This, January 10th, 1994. Buffett's wry comment 2.5 years after the Salomon crisis broke. Warren Buffett, 63, chairman of Berkshire Hathaway, a big investor in Salomon, Inc., on the fine and jail sentence laid on Paul Moser, who precipitated the firm's Treasury auction scandal. Quote, "Moser's paying $30,000 and is sentenced to prison for 4 months. Salomon's shareholders, including me, paid $290 million, and I got sentenced to 10 months as CEO." Nebraska Special, September 26, 1988, by Terence Paré.
Warren E. Buffett, the Omaha investor who prides himself on producing extraordinary results by doing ordinary things, has now done an extraordinary thing to produce an ordinary result. In a letter to shareholders of Berkshire Hathaway, his hometown conglomerate, Buffett, 58, announced plans to move trading in the firm's shares from the over-the-counter market to the New York Stock Exchange. That's extraordinary because the exchange demands that companies applying for a listing have at least 2,000 stockholders who own at least one round lot of 100 shares. Berkshire doesn't. With shares selling for around $4,300 each, not many people can afford a round lot, and Berkshire has relatively few shares outstanding, less than 3% of the average number among companies listed on the big board. Buffett has always refused to split the stock, in part to discourage speculators, and instead waited for the exchange to change the rule, which it recently did. It will allow Berkshire Hathaway to trade in round lots of 10 shares. As soon as the SEC approves, Buffett will apply for a listing. The move is not intended to boost that astronomical stock price. Indeed, Buffett wrote to his investors, "Berkshire should sell, and we hope will sell, on the NYSE at prices similar to those it would have commanded on the over-the-counter market, given similar economic circumstances." His goal is less exciting. Because the market maker's spread is generally narrower on the New York Exchange, it is a little cheaper to trade securities listed there.
A warm tip from Warren Buffett. It's time to buy Freddie Mac's. December 19, 1988. By Brett Duval Fromsen. This article delivered a true rarity, a stock tip from Buffett. The reason those so seldom materialize is that Buffett will not normally discuss stocks he is buying or selling. But, as a photo caption in this article explained, he made an exception in this case because Berkshire, the owner of a savings and loan company that had the right to buy in early, had reached the maximum number of shares it could own in Freddie Mac. So how good was the stock tip? It was superlative. An investor who bought Freddie Mac in early December 1988, when the December 19 issue of Fortune would have reached subscribers, would have paid a split-adjusted price of about $4 a share. If the investor had then held 10 years until December 1998, he could have sold at prices around $60. Investors looking for cues from Buffett might in fact have held on that long, because Berkshire retained almost all of its Freddie Mac stock, roughly 60 million shares, through the 1990s. But as the decade ended, Buffett was ready to sell. In 2000, a year in which Freddie's stock price ranged from $37 to $70, Berkshire unloaded more than 95% of its position, registering a big capital gain of around $3 billion. The sales were made out of the public eye, because Berkshire had secured the SEC's permission to keep its sales confidential. That is, the company was allowed to omit any mention of Freddie in what are called 13F filings until they were completed. Once they were, Berkshire amended its 13Fs, and Buffett disclosed in the 2000 annual report that Freddie was largely gone. He added no details, though, as to why the sales had been made. The reasons were eventually to come out, however, because of Freddie Mac's own theatrics. In 2003, the news flashed that Freddie had regularly misreported its earnings and would have to restate them. By 2007, Freddie's regulator, the Office of Federal Housing Enterprise Oversight, OFHEO, was trying to force Leland Brenzel, who'd been dumped as CEO of Freddie, to relinquish a large chunk of his compensation. Buffett was then called as a witness by the regulators, who expected him, correctly, to testify that he had sold Berkshire's stock in 2000 because he had lost respect for Freddie's management. Elaborating, Buffett testified that he'd met with Brenzel several times. and found him unwisely striving for double-digit earnings gains of, say, 15%. Gains like that don't come naturally for financial companies, Buffett said, and managements reaching for them can start making up the numbers. Freddie had also made a big, unorthodox investment that Buffett didn't like, and he wondered what else bad it was doing that he didn't know about. Quote, "There's never just one cockroach in the kitchen," Buffett said. The regulators won the case, and Brenzel was fined and penalized a total of $16 million. Turns out that Buffett could have taken his time about selling Berkshire's Freddie stock. A winner during the housing bubble, Freddie sailed along in the stock market, surviving Berkshire's sales, the earnings scandal, and management upheaval until October 2007. Then its stock collapsed, becoming a central casualty of the financial crisis. Recently, Freddie was a penny stock, selling for about 25 cents. CL.
Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. Thus saith the prophet Warren Buffett, chairman of Berkshire Hathaway and stock picker supreme. In his opinion, Federal Home Loan Mortgage Corp., otherwise known as Freddie Mac, is just such an opportunity. A quasi-public corporation like its older cousin Fannie Mae, the Federal National Mortgage Association, it earns an impressive 23% return on equity and sells for less than 8 times estimated 1988 earnings. Freddie Mac is a triple dip, says Buffett. You've got a low percentage earnings ratio on a company with a terrific record, you've got growing earnings, and you have a stock that is bound to become much better known to equity investors. Berkshire Hathaway's savings and loans subsidiary owns or has contracted to buy about $108 million of Freddie Mac stock, the maximum allowed. Lots of Buffett's friends and associates have invested too, including Lewis Simpson, vice chairman of Geico, and William Ruane, chairman of the Sequoia Fund. Should the ordinary investor consider joining the Buffett gang? In a word, yes. Freddie Mac helps make the American dream of owning a house a reality. Chartered by Congress in 1970, the company buys residential mortgages from lenders, guarantees the mortgages against default, packages them as securities, and sells them to investors, including many S&Ls. From 1970 through 1987, the market for conventional residential mortgages grew at a compound annual rate of more than 13%, and never at less than 5.5% a year. Not bad. But what makes the business outstanding is the paucity of competition. Fannie Mae is the only other major player. The chief difference between them is that Freddie resells virtually all its mortgages, while Fannie holds on to a substantial amount of them. Together, Freddie and Fannie control 90% of the market. Says Buffett, it's the next best thing to a monopoly. The future of the Freddie-Fannie family duopoly looks encouraging. The market could expand for years to come. So far, only 33% of conventional residential mortgages are scrutinized, leaving plenty of room for growth. Moreover, savings institutions will soon have another powerful incentive to buy more mortgage-backed securities. In 1990, savings banks and S&Ls holding ordinary mortgages will be required to maintain bigger reserves against loan losses if they owned a diversified portfolio of securitized mortgages. Of the two, Freddie may be the better bet. Over the past decade, its return on equity has averaged more than twice Fannie's. Because Freddie's managers buy only top-quality mortgages, Freddie's delinquency rate for conventional fixed-rate single-family mortgages is a mere 0.4% of its $230 billion portfolio. With holdings of similar size, Fannie has 1.1% delinquencies. President Leland Brenzel and the other Freddie Mac managers minimize their exposure to interest rate spikes, which hurt mortgage bankers by raising their cost of money while lowering the price of mortgages in the secondary market. Brentsell keeps only $15 billion worth of mortgages on the balance sheet versus Fannie Mae's $102 billion. Freddie's lower exposure to rising interest rates may be one reason Berkshire Hathaway's sold shares in Fannie not long ago and bought more of Freddie, says Berkshire Hathaway Vice Chairman Charles Munger. I can't think of a more tangible compliment to the stock than to buy every damn share we are allowed to. By law, no one may own more than 4% of Freddie Mac's outstanding shares. Shares in Freddie Mac have a few peculiarities. First, the stock is properly called participating preferred. Preferred shareholders normally get fixed dividend payments, but Freddies get the first $10 million a year in dividends and are guaranteed 90% of any further distributions. The second wrinkle for the would-be investor is that Freddie trades over the counter on a when-issued basis until January 3rd, when it will be listed on the New York Stock Exchange. Heretofore, Federal Home Loan Bank board rules allowed only its member institutions to own the participating preferred, because they provided Freddie's seed money. The board decided to end that restriction because the resulting illiquidity kept the stock price far below what it would command in a free market. The change should raise some $2 billion for capital-starved S&Ls. Freddie's when-issued stock began trading in October. Most institutional investors have yet to discover its charms or have not bought it because their rules preclude owning when-issued shares. Mutual funds and insurance companies rarely hold them. The pros may seem to rule the equity markets, but with Freddie Mac's, for once the edge goes to the individual investor. And there's a bonus. Because you cannot take delivery of when-issued shares right away, you can put up 30% now and pay the rest later. In this case, you don't have to settle the bill until January 10th.
What happened at the bridge table? A Very Full Deck, June 5, 1989, by Julia Lieblich. Inspired by a Fortune cover story that featured billionaire and bridge player Warren Buffett, the American Contract Bridge League put together a match that pitted Buffett and 5 other big moneymakers against a team made up of elected politicians. The result? Businessmen 54, politicians 39. An audience paid $100 a head to watch the Washington match. The money goes to the league's educational foundation and the Reading is Fundamental program. Quote, "Everyone played well," said CBS Chief Executive Lawrence Tisch, who skippered the winning team. His teammates, in addition to Buffett, were Alan Greenberg, chairman of Bear Stearns, the brokerage house, and Jimmy Kane, its president, Malcolm Forbes, chairman of Forbes magazine, and George Gillespie III, partner in the high-powered law firm Cravath, Swaine and Moore. Said Congressman Arlen Strangeland, Republican from Minnesota, the legislator's captain, of the final score? It was the pits. Raising Cain, January 15, 1990, by Alan Deutschman.
Bear Stearns president James Kane has won national tournaments in bridge. But when a men's magazine interviewed him about his passion for the game, the blunt Wall Streeter didn't know when to pass. M asked him about his teammates, his boss, Bear Stearns' CEO and amateur magician Alan Greenberg, plus Tisch, Forbes, Gillespie, and Buffett, as mentioned above, who compete as corporate America's 6 honchos, cash. Kane not only criticized his partners, they don't know what a good bridge player looks like, but went on to claim that women lack the emotional cool to be top bridge players or stock traders. Under intense pressure, said Kane, 52, a woman will probably have to go to the ladies' room and dab her eyes. Those words won't help Bear Stearns defend itself against 2 sex discrimination claims including one from a female trader. Kane says the M quotes were fabricated, distorted, or taken out of context. In a letter to Bear Stearns employees, he wrote, "I sincerely apologize to everyone for the totally false impression given by the article and assure you I disagree with its contents." The writer, Duncan Christie, says the quotes, transcribed from a tape, were meticulously accurate. What could have possessed Kane? Lawyer George Gillespie gallantly pleads guilty to being a less skillful player than his teammate, but Kane knows that at least one top-notch bridge player who was a woman, his coach, Grandmaster Judy Radin, 39. Her view? Maybe Jimmy got carried away. He's a great guy, but he's just too intense. Before the article came out, he said I wasn't going to like it. Radin now has to prep her crew for the upcoming match against a team from British Parliament. Prime Minister Margaret Thatcher isn't expected to play.
Editor's note: the Americans beat the British House of Commons team, but lost to the House of Lords. From How to Live with a Billion, September 11, 1989. Excerpts from an article by Alan Farnham.
Says Warren Buffett, who still puts in 10-hour days despite his $3.6 billion, "I'm doing what I would most like to be doing in the world, and I have been since I was 20. What keeps him going, he says, is the admiration he holds for his business colleagues. I choose to work with every single person I work with. That ends up being the most important factor. I don't interact with people I don't like or admire. That's the key. It's like marrying." When it comes to personal giving, Buffett feels that picking causes is harder than picking stocks. In stocks, you're looking for things that are obvious and easy to do. You try to identify the 1-foot bars you can step over. But when you get in the charitable arena, you're attacking problems that have been the most intractable and resistant to solution throughout history. The most important ones are all 7-foot bars. Population control and diffusing the nuclear threat, the two causes Buffett's foundation supports, are bars so high up that I can't see them. Real Lulus. Though Buffett has spent only $10 million to $15 million on these causes so far, he intends to give much more. Waldemar Nielsen, an expert on foundations and author of The Golden Donors, thinks Buffett hasn't even warmed up yet. He's one of those very rare guys who is not only one hell of an entrepreneur in business, but one hell of an entrepreneur in the philanthropic field. We haven't had one in a long time. The Buffett Foundation will get almost all of Buffett's stock when he dies, and he doesn't think giving its trustees a narrow charter would be wise. That's like telling them what to invest in 10 years after I die. I would rather have a smart, well-intentioned, high-grade person looking at the problems of the day through eyes that are open, not through eyes that are in a coffin. I've found in running businesses that the best results come from letting high-grade people work unencumbered. Stick around. If you're young enough, you'll see how it all works out.
Editor's note: as described in Warren Buffett Gives It Away, Buffett changed his mind about giving most of his money to the Buffett Foundation after his first wife, Susie, for whom the foundation is now named, died in 2004. He is instead gradually giving most of it to the Bill and Melinda Gates Foundation. The complete text of How to Live with a Billion is available at fortune.com/BuffettBook. From Now Hear This, October 23, 1989. Warren Buffett, 59, billionaire investor and chairman of Berkshire Hathaway, on why he borrowed $400 million and put the cash into treasuries. Quote, "The best time to buy assets may be when it's hardest to raise money." New Warren Buffetts and the old one. carrying a headline almost impossible to resist. The first article in this 1989 combo contained a few words of wisdom from Buffett and descriptions of 12 young money managers the story's writer, Brett Froman, had identified as possibly having investing talents comparable to Buffett's. Fromson, it turned out, had a great eye. More than 20 years after the article's publication, 9 of the 12 profiled are still well known in the investment world. Jim Chanos, Jim and Karen Kramer, who were then married and are now divorced. Glenn Greenberg, with his then partner John Shapiro. They split in 2009. Seth Klarman, Eddie Lampert, Richard Perry, and Michael Pierce. Of the others, John Constable runs a successful money management firm in suburban Philadelphia. Randy Updike, a lone wolf whom Fromson plucked from obscurity to write about, manages an investment partnership in Sun Valley. And Tom Sweeney, a fund manager at Fidelity when the article was published, has retired from investing money professionally. This book is about Buffett, so we are only excerpting his part of the story, not reprinting the profiles of the 12 money managers. But the complete article is available at fortune.com and is also accessible via a Google search, where it appears under the name of almost every person included in the article. The second piece, and now a look at the old one, begins with the engaging tale of how Homer Dodge, a physics professor, went to Omaha and persuaded Buffett to manage his money. To that incident, we will add a postscript about Homer's son, Norton, who died in November 2011 at the age of 84. Norton got a long obituary in the New York Times, its length perhaps surprising for a man who was himself an unheralded professor of economics. But a paragraph in the obit identified Norton Dodge as the son of an early Buffett spotter, and went on to explain what Norton did with a big part of his inheritance. He became an avid collector of nonconformist Soviet art, meaning works created by dissidents clandestinely protesting the Kremlin's oppressive acts. In time, he gave much of his highly valuable collection to Rutgers University. His sister, Alice, was also throughout her life a major giver to education. And therein lies my point. Though Buffett himself has never been the least interested in giving to cultural or educational institutions, other Berkshire shareholders have been, generously. A few instances: Polytechnic Institute of Brooklyn, now part of New York University, benefited significantly from the $750 million estates left by one of its professors, Nebraska native Donald Othmer, and his wife Alice. Kansas City's new Performing Arts Center has its Hellsberg Hall, given by Barnett and Shirley Hellsberg, whose jewelry retailing company was bought by Berkshire, and in Omaha, of course, there's the Holland Performing Arts Center, named for Richard and Mary Holland, and the Sorrell Center for Health Science Education at the University of Nebraska Medical School, to which the lead donors were Bill and Ruth Scott. Both the Hollands and the Scotts began investing with Buffett in his partnership days, when Bill Scott was working as well for Buffett as a securities buyer. As of early 2012, Berkshire had a market value of $202 billion, the 9th highest market cap in the Fortune 500. Buffett's huge portion of that, more than $40 billion, with many billions already given away, has been committed almost entirely to philanthropy. Nobody can know how many other Berkshire holders will be big givers as well, but they seem likely to become a crowd. C.L. From Are These the New Warren Buffetts? October 30th, 1989. An excerpt from an article by Brett Duval Fromson.
Wouldn't you like to become partners with someone who would double your money every 3 to 4 years ad infinitum? To put it another way, Wouldn't you like to invest with the next Warren Buffett? Riches come to investors who early in their lives find great money managers. Buffett is certifiably one of the greatest. His early clients are now worth tens of millions of dollars. He achieved that by compounding money consistently and reliably at about 25% per annum. The young investors you will meet here show comparable signs of talent, but even they can return only 20% a year. Most have done at least that well so far. $10,000 invested with them today would be worth $5.9 million in the year 2025. What reveals their potential? Strong investment performance, of course, but that is not conclusive, especially among young managers who generally lack a 10-year record. More important are certain character traits. Buffett himself starts with high-grade ethics. The investment manager must put the client first at everything he does. At the very least, the manager should have his net worth invested alongside of his clients to avoid potential conflicts of interest. Those profiled here have put the bulk of their assets with their customers. Buffett says he would invest only with someone who handled his mother's money too, as he did. Brains help, but above a certain level, they are not the salient distinction among investment managers. Says Buffett, you don't need to be a rocket scientist. Investing is not a game where the 160 IQ guy beats the guy with the 130 IQ. The size of the investor's brain is less important than his ability to detach the brain from the emotions. Rationality is essential when others are making decisions based on short-term greed or fear, says Buffett. That is when the money is made.
And now a look at the old one, October 30th, 1989, by Brett Duval Fromson.
In the muggy summer of 1956, a 67-year-old physics professor from Vermont pulled his Jeep to a stop on a tree-lined street in Omaha. Looking for the man he thought would be one of the next great American investors, Homer Dodge had driven 1,500 miles alone in hopes of persuading 25-year-old Warren Buffett to manage his family's savings. The perspicacious Dodge had been a client of Buffett's former boss, Benjamin Graham, the father of modern financial analysis, but Graham had recently liquidated his investment company. Recalls Buffett, Homer told me, I'd like you to handle my money. I said, the only thing I'm doing is a partnership with my family. He said, well, I'd like one with you. So I set one up with Homer, his wife, children, and grandchildren. The Dodges placed $100,000 with Buffett. When Homer Dodge died in 1983, that sum had multiplied into tens of millions. What did Dodge spot that most people missed? Says his son Norton, my father saw immediately that Warren was brilliant at financial analysis, but it was more than that. The senior Dodge recognized a uniquely talented craftsman who loved the process of investing and who had mastered all the tools. The Dodges passed the word to friends, and by early 1960s, a small choir of limited partners was singing Buffett's praises. One man was so taken with the music he heard that he wrote the young wizard a check for $300,000 without even having met him. The man simply endorsed a business card on which he had written, "Include me in." The trusting soul? Future billionaire Larry Tisch. Warren's reputation was excellent. He was a believer in value and a man of integrity, says Tisch. I didn't do it casually. $300,000 was a lot more money then, especially to me. Buffett was ably prepared for the craft of stock picking. He had a sound approach on which to ground his investing, buying securities on the basis of value, not popularity. His hometown offered everything he needed: family, friends, good hamburgers, of which Buffett is inordinately fond, and very few distractions. Lastly, Buffett possessed a superior intellect. says his longtime associate, Charles Munger, now vice chairman of Buffett's conglomerate, Berkshire Hathaway. There were 1,000 people in my Harvard Law School class. I knew all the top students. There was no one as able as Warren. His brain is a superbly rational mechanism, and, since he's articulate, you can see the damn brain working. Buffett structured his partnerships to minimize unnecessary interruptions from the backers. Says he, I told them, what I'll do is form a partnership where I'll manage the portfolio and have my money in there with you. I'll guarantee you a 6% return, and I get 20% of all profits after that. And I won't tell you what we own because that's distracting. All I want to do is hand in a scorecard when I come off the golf course. I don't want you following me around and watching me shank a 3-iron on this hole and leave a putt short on the next one. His partners accepted the conditions because they knew he was totally committed to investing. Says Omaha investment banker Charles Hyder, I told my family, look, Warren is going to think about how to invest our money 7 days a week. Buffett dug for information where other investment managers hardly pawed. Take, for instance, his work on American Express in 1963 during the Salad Oil affair. The company's stock had tanked after it was discovered that a subsidiary might be liable for tens of millions of dollars in damage claims arising from the sale of salad oil that did not exist. Buffett and his people determined by visiting retailers that the core business of the credit cards and traveler's checks was as profitable as ever. That convinced him he should load up on the battered stock. It quintupled in 5 years. Like all master craftsmen, Buffett prizes consistency. Marshall Weinberg of the brokerage firm Gruntle & Company recalls going to dinner with him in Manhattan. He had an exceptional ham and cheese sandwich. A few days later, we were going out again. He said, let's go back to that restaurant. I said, but we were just there. He said, precisely. Why take a risk with another place? We know exactly what we're going to get. And that, says Weinberg, is what Warren looks for in stocks, too. He only invests in companies where the odds are great that they will not disappoint.
How I Goofed, April 9, 1990. An excerpt from Buffett's letter to shareholders in the 1989 Berkshire Hathaway annual report. Typically, around 80% of Warren Buffett's annual chairman's letter is Berkshire-specific. The remainder is op-ed, Buffett style. It turns out that excerpts from either portion may work nicely as a Fortune article, and we proved that over the years by turning 6 varied excerpts from the letters into articles, with this one the first. In Berkshire's annual report, we will note, the excerpt printed here had a different title, referring implicitly to Buffett's quarter-century at the helm of Berkshire. It was called Mistakes of the First 25 Years, a condensed version. Our title instead summed things up as How I Goofed. The content of the piece, a CEO pointing out his errors, was obviously unusual, extraordinarily so for an annual report. Of course, it is relatively easy to engage in a confessional when you run a company whose stock has risen more than 400 times in the 25 years at issue, going from about $18 per share to $7,450. Even so, Buffett says in this piece that the record could have been even better, had he just not been so dumb in certain instances. As this book is published in 2012, we are only 3 years away from the 50-year managerial mark for Buffett, at which point he has promised to once again catalog his mistakes. Quote, I will not lack for material, he told me recently. C.L.
To quote Robert Benchley, having a dog teaches a boy fidelity, perseverance, and to turn around 3 times before lying down. Such are the shortcomings of experience. Nevertheless, it's a good idea to review past mistakes before committing new ones. So, Let's take a quick look at the last 25 years. My first mistake, of course, was in buying control of Berkshire. Though I knew its business, textile manufacturing, to be unpromising, I was enticed to buy because the price looked cheap. Stock prices of that kind had proved reasonably rewarding in my early years, though by the time Berkshire came along in 1965, I was becoming aware that the strategy was not ideal. If you buy a stock at a sufficiently low price, there will usually be some hiccup in the fortunes of the business that gives you a chance to unload at a decent profit, even though the long-term performance of the business may be terrible. I call this the cigar butt approach to investing. A cigar butt found on the street that has only one puff left on it may not offer much of a smoke, but the bargain purchase will make that puff all profit. Unless you are a liquidator, that kind of approach to buying businesses is foolish. First, the original bargain price probably will not turn out to be such a steal after all. In a difficult business, no sooner is one problem solved than another surfaces. Never is there just one cockroach in the kitchen. Second, any initial advantage you secure will be quickly eroded by the low return that the business earns. For example, if you buy a business for $8 million that can be sold or liquidated for $10 million, and promptly take either course, you can realize a high return. But the investment will disappoint if the business is sold for $10 million in 10 years, and in the interim has annually earned and distributed only a few % on cost. Time is the friend of the wonderful business, the enemy of the mediocre. You might think this principle is obvious, but I had to learn it the hard way. In fact, I had to learn it several times over. Shortly after purchasing Berkshire, I acquired a Baltimore department store, Hochschild Kohn, buying through a company called Diversified Retailing, that later merged with Berkshire. I bought at a substantial discount from book value. The people were first class, and the deal included some extras, unrecorded real estate values, and a significant LIFO inventory cushion. How could I miss? So, 3 years later, I was lucky to sell the business for about what I had paid. After ending our corporate marriage to Hochschild Kohn, I had memories like those of the husband in the country song, "My wife ran away with my best friend, and I still miss him a lot." I could give you other personal examples of bargain purchase folly, but I'm sure you get the picture. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Charlie Munger understood this early. I was a slow learner, but now, when buying companies or common stock, we look for first-class businesses accompanied by first-class managements. That leads right into a related lesson. Good jockeys will do well on good horses, but not on broken-down nags. Both Berkshire's textile business and Hochschild Kohn had able and honest people running them. The same managers employed in a business with good economic characteristics would have achieved fine records, but they were never going to make any progress while running in quicksand. I've said many times that when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. I wish I hadn't been so energetic in creating examples. My behavior has matched that admitted by Mae West. I was Snow White, but I drifted. A further related lesson. Easy does it. After 25 years of buying and supervising a great variety of businesses, Charlie and I have not learned how to solve difficult business problems. What we have learned is to avoid them. To the extent we have been successful, it is because we concentrated on identifying 1-foot hurdles we could step over, rather than because we acquired any ability to clear 7-footers. The finding may seem unfair, but in both business and investments, it is usually far more profitable to simply stick with the easy and obvious than it is to resolve the difficult. On occasion, tough problems must be tackled, as was the case when we started our Sunday paper in Buffalo, thereby challenging an established competitor. In other instances, a great investment opportunity occurs when a marvelous business encounters a one-time huge but solvable problem, as was the case many years back at both American Express and Geico. Overall, however, we've done better by avoiding dragons than by slaying them. My most surprising discovery: the overwhelming importance in business of an unseen force that we might call the institutional imperative. In business school, I was given no hint of the imperative's existence, and I did not intuitively understand it when I entered the business world. I thought then that decent, intelligent, and experienced managers would automatically make rational business decisions, but I learned over time that isn't so. Instead, rationality frequently wilts when the institutional imperative comes into play. For example, 1. As if governed by Newton's first law of motion, an institution will resist any change in its current direction. 2. Just as work expands to fill available time, corporate projects or acquisitions will materialize to soak up available funds. 3. Any business craving of the leader, however foolish, will be quickly supported by detailed rate of return and strategic studies prepared by his troops. And 4. The behavior of peer companies, whether they are expanding, acquiring, setting compensation, or whatever, will be mindlessly imitated. Institutional dynamics, not venality or stupidity, set businesses on these courses which are too often misguided. After making some expensive mistakes because I ignored the power of the imperative, I have tried to organize and manage Berkshire in ways that minimize its influence. Furthermore, Charlie and I have attempted to concentrate our investments in companies that appear alert to the problem. After some other mistakes, I learned to go into business only with people whom I like, trust, and admire. As I noted before, this policy of itself will not ensure success. A second-class textile or department store company won't prosper simply because its managers are men that you would be pleased to see your daughter marry. However, an owner or investor can accomplish wonders if he manages to associate himself with such people in businesses that possess decent economic characteristics. Conversely, we do not wish to join with managers who lack admirable qualities, no matter how attractive the prospects of their business. We've never succeeded in making a good deal with a bad person. Some of my worst mistakes were not publicly visible. These were stock and business purchases whose virtues I understood and yet didn't make. It's no sin to miss a great opportunity outside one's area of competence, but I have passed on a couple of really big purchases that were served up to me on a platter and that I was fully capable of understanding. For Berkshire's shareholders, myself included, the cost of this thumb-sucking has been huge. Our consistently conservative financial policies may appear to have been a mistake, but in my view, were not. In retrospect, it is clear that significantly higher, though still conventional leverage ratios at Berkshire would have produced considerably better returns on equity than the 23.8% we have actually averaged. Even in 1965, perhaps we could have judged there to be a 99% probability that higher leverage would lead to nothing but good. Correspondingly, we might have seen only a 1% chance that some shock factor, external or internal, would cause a conventional debt ratio to produce a result falling somewhere between temporary anguish and default. We wouldn't have liked those 99-to-1 odds, and never will. A small chance of distress or disgrace cannot, in our view, be offset by a large chance of extra returns. If your actions are sensible, you are certain to get good results. In most such cases, leverage just moves things along faster. Charlie and I have never been in a big hurry. We enjoy the process far more than the proceeds, though we have learned to live with those also. We hope in another 25 years to report on the mistakes of the first 50. If we are around in 2015 to do that, you can count on this confession occupying many more pages than it does here.
From The Children of the Rich and Famous, September 10, 1990. Excerpts from an article by Alan Farnham.
Not spendthrifts, sots, nor simps, these billionaires and billionairesses are working hard, even though they don't have to. They're exotic, some neurotic. They're billionaire children, saplings bent by a green money wind. Some inheritors learn to use their wealth to good effect, like a tool. They escape the pitfalls of their class and lead full, productive lives, accomplishing what they have set out to do. How do they succeed? What motivates them? The reasons range from personal pride to a pining for adventure. Much depends on how they were raised. Telling children early and bluntly whether they will inherit makes for a good start. Warren Buffett's son, Howard, knows that Dad intends to use his Berkshire Hathaway lucre to curb population growth. Yet Howard, 35, has not wasted time complaining. He farms corn and soybeans just outside of Omaha, and in 1989 he was elected commissioner of Douglas County, Nebraska. Having to measure up to one's family name can be daunting. His famous dad is the reason Howard Buffett never had a lemonade stand as a kid. I felt discouraged from trying. It seemed nothing I could do would be as successful as what he did, and what I did might reflect badly on him. The shadow of the elder Buffett's success stretches across the imagination of his 6-year-old grandchild. Says Howard, little Howie owns 10 shares of Coke stock that he bought with money he saved. One day my wife was explaining that there's a first time for everything, and he said, I don't think there'll ever be a first time I can afford to buy a share of Berkshire Hathaway. All rich kids suffer from a form of discrimination that one calls wealthism. Howard Buffett is philosophical. There are jerks with money and jerks without. He regularly suffers from the public's assumption that anyone named Buffett must be rich. One night at a restaurant, he recalls, I pulled out my checkbook to pay the bill, and some guy says, Gee, I wish I had that checkbook. I didn't have the patience to tell him, No, buddy, you really don't. Though he tries to behave as if his father's wealth didn't exist. Doing so for very long is almost impossible. When I get back to the office this afternoon, there will be 9 messages, he says. 8 of them will be from someone wanting something from my dad. Howard Buffett says, There are certain things you need to do with kids whether you have money or not. My mom and dad taught me responsibility. Clean out the gutters and mow the lawn. When you do wrong, pay the consequences. Teaching his own son Howie how to live with privilege has not been easy. When basketball hero Michael Jordan visited Omaha, Howie wanted to sit at the head table with the other dignitaries. Howard Sr. had to explain to him that he wasn't automatically entitled to. Almost all billionaires' children really want to work. They understand that by starting a career or business they will increase their self-esteem and gain independence from their parents. But where parents are bankrolling the experiment, gains can prove ephemeral. Howard Buffett farms 406 acres and loves the work. I've been farming 9 years. It's a very independent form of activity. Everything's up to you. It teaches you a value system and gives you an instrument to achieve that. So far, so good. Except for one thing. Dad owns the land. I pay him a percentage of the gross income as rent. I probably shouldn't tell you this, but the rent is based upon my weight. I'm 5'8" and I weigh about 200 pounds. He thinks I weigh too much. That I should weigh 182.5. If I'm over my weight is 26% of gross income. If I'm under, 22%. It's the Buffett family version of going to Weight Watchers. I don't mind it, really. He's showing he's concerned about my health. But what I do mind is that even at 22%, he's getting a bigger paycheck than almost anybody around. Somehow, he always manages to control the circumstances.
The Midas Touch at a Discount, November 5, 1990, by Edmund Faltermeyer.
Turbulence and trouble occasionally make for good bargains. Consider Berkshire Hathaway, akin to a juggernaut that unaccountably takes a backward step. Already stumbling before Saddam Hussein and recession worries cannonaded the market, the Omaha company's stock has fallen 36% this year to $5,550 a share, more than twice the descent of Standard & Poor's 500 stock index. For CEO Warren Buffett, 60, the investing wizard who owns 42% of the Berkshire stock, that translates into a paper loss of $1.5 billion, or $215,450 an hour. It also spells a buying opportunity for others. Says Michael Price, who runs the $3.1 billion mutual shares fund and is no investing slouch himself, it's a way for the defensive growth investor to be in stocks. Other money managers recommend the stock, including John Tilson, who runs the high-performing $63 million Pasadena Growth Fund for Roger Engelmann Associates. He's been buying Berkshire stock. Buffett himself displays no erosion of confidence, not even on the matter of his paper loss. Says he, "I have not cut back from double hamburgers to single hamburgers." How about the corporate jet dubbed the Indefensible? "That'll be the last thing to go," he jokes. Buffett took over Berkshire Hathaway in 1965, and by the time the stock reached its peak in late 1989, it had advanced 741-fold from $12 a share to $8,900. But a down year is not a new experience for Buffett. Berkshire's stock fell 55% in 1974. A unique creature that leads 3 lives, the company is a property and casualty insurance company that doubles as Buffett's investing vehicle. It also owns a collection of manufacturing, publishing, and retailing operations. In 1989, these companies, which included the publisher of World Book Encyclopedia, collectively earned an astounding 57% on average equity. One possible explanation for this year's slide in Berkshire's stock price: some of its biggest holdings are in broadcasting, publishing, and insurance, industries whose shares have been especially hard hit in recent months. The Buffett name may also have lost some of its magic, which previously helped push the stock price to a lofty premium over book value per share. A few money managers carpet his so-called white squire deals with Salomon Inc., Gillette, U.S. Air, and Champion International. In part to help these companies deter raiders, Buffett bought preferred stock that can be converted into big blocks of common. Portfolio manager John Neff of Vanguard's Windsor Fund says he sees some negatives there because the deals helped to insulate the management of each company. Buffett has said that Berkshire will ultimately achieve satisfactory returns on these preferreds, only if the company's common stocks do well. Says Pasadena's Tilson, "The market could be saying to Buffett, 'You've lost it, pal.' But I don't think so." Using a computer model, Tilson's firm calculated that Berkshire's stock recently sold for $510 less than its real worth. Because of the discount, reasons Tilson, you're buying Warren Buffett's abilities for nothing. For investors, that's an inviting price.
Buffett Buys Junk, April 22, 1991, by Jennifer Reese. Wall Street has long wondered if star investors would find bargains in the disarray of the junk bond market. Enter Warren Buffett. In the 1990 annual report of Berkshire Hathaway, the billionaire CEO discloses that Berkshire has put $440 million into RJR Nabisco's high-yield bonds. Buffett, who last year made an intensive study of the junk market, says in an interview, quote, "There was even more carnage than I'd thought." He concluded that the RJR bonds were a better value than anything else he saw in the field because the company is well run, and its credit better than commonly perceived. Buffett estimates that the market value of his RJR bonds is now some $175 million above his cost. Does he wish he'd bought more? He says, "There are a lot of things I wish I'd done in hindsight, but I don't think much of hindsight generally in terms of investment decisions. You only get paid for what you do." From Now Hear This, April 5, 1993. Warren E. Buffett, 62, billionaire CEO of Berkshire Hathaway, on why the cost of executive stock options should be reorganized on companies' income statements. Quote, "If options aren't a form of compensation, what are they? If compensation isn't an expense, what is it? And if expenses shouldn't go into the calculation of earnings, where in the world should they go?" Buffett and Coca-Cola. Almost 25 years ago, in 1988, the then president of Coca-Cola, Donald Keough, called his long-term friend and one-time Omaha neighbor, Warren Buffett, with a question. "Warren, the trading in Coke stock suggests that someone is buying a lot of it. Could that possibly be you?" Said Buffett, "Well, keep it quiet between you and Roberto, but yup, it's me." Keough, delighted, hung up to tell his boss, CEO Roberto Goizueta, while Buffett went back to buying. The market crash of 1987 had hammered Coke, and Buffett picked up huge amounts of the stock in 1988 and 1989, adhering to his own famous advice: be greedy when others are fearful. He finished his buying in 1994, having accumulated the nice round number of 400 million, split-adjusted, Coke shares. The position, which in 1994 gave Berkshire 7.8% ownership of Coke, cost nearly $1.3 billion, for an average of just under $3.25 a share. That was the start of a great relationship, overall. But Buffett, who served as a Coke director from 1989 until 2007, used his power on one occasion to unseat a Coke CEO and, on another, to kill a management decision he thought bad for the company. Here are 3 excerpts from Fortune articles, the first published in the salubrious early days of the Buffett-Coke relationship, the others during times of controversy. From The World's Best Brand, May 31, 1993. Excerpts from an article by John Huey.
Says Buffett, "If you run across one good idea for a business in your lifetime, you're lucky. And, fundamentally, this is the best large business in the world. Its product sells for an extremely moderate price. It's universally liked. The per capita consumption goes up almost every year in almost every country. There isn't any other product like it." On Goizueta and Keough? If you have the 1927 Yankees, all you wish for is their immortality, Buffett says. As long as we have the kind of people who are focused as they are, I don't worry about the business. If you gave me $100 billion and said, take away the soft drink leadership of Coca-Cola in the world, I'd give it back to you and say, it can't be done.
Goizueta died in 1997. Keough retired, and the new CEO, Douglas Ivester, looked more like a bat boy at the plate than a Ruth or Gehrig. In early 2000, Fortune published an exclusive story whose opening paragraphs follow. From What Really Happened at Coke, January 10, 2000, by Betsy Morris and Patricia Sellers. First of all, let's clear up the mystery about why Doug Ivester, at age 52, and after only a little more than 2 years on the job, suddenly resigned as chairman and CEO of Coca-Cola. He was pushed. Hard. Sure, he was beleaguered by a string of setbacks in his short, unhappy tenure. But aides who worked with him every day, and who were as shocked as anyone when the dogged executive threw in the towel, report that everything was business as usual on the first day of December, a Wednesday, when Ivester flew from Atlanta to Chicago for a routine meeting with McDonald's executives. Upon his return, everything seemed to have changed. What hasn't come to light until now is that while Ivester was in Chicago, he attended another very private meeting, this one called by Coke's two most powerful directors, Warren Buffett and Herbert Allen. At that meeting, the two directors informed Ivester that they had lost confidence in his leadership. For most of the past year, Buffett had remained in the wings, while Allen had numerous conversations with Ivester about his cramped management style. This time it was different, according to well-placed sources close to the situation. Together, Buffett and Allen, the board's two 800-pound gorillas, told Ivester that they had reached an irreversible conclusion. He was no longer the man who should be running Coke. It was time for a change. The meeting was non-confrontational, even sympathetic, and it apparently ended without a conclusion as to the next step. Conceivably, Ivester could have decided to fight. But it's also conceivable that Buffett and Allen could have decided to force the issue, perhaps as early as the next board meeting, scheduled for 2 weeks later. Their leadership as directors is outsized, considering that Buffett's Berkshire Hathaway, of which he owns 31%, controls about 200 million shares, or 8.1% of Coke, while Allen owns or controls about 9 million shares. Whatever they were all thinking when they left the meeting, Ivester returned to Atlanta and called an emergency board meeting for that Sunday, at which he quit. His announcement stunned executives, directors, employees, and Wall Street. Even the man who was named to replace him, Doug Daft, a 56-year-old Australian whose experience has mostly been running Coke's businesses in Asia. Daft came in believing that Coke needed to diversify into non-cola drinks. Months after taking over in early 2000, he championed a $15.7 billion merger with Quaker Oats, which owned Gatorade. The deal was to be done with Coke stock, and that ran into Buffett's strong conviction that using stock in a merger often causes the acquirer to give up more value than it gets. A 5-hour Coke board meeting followed, in which Buffett led the way in arguing against the deal. Here is my account of the Coke debate, part of a sidebar in a 2001 article. A sidebar from The Value Machine, February 19, 2001, by Carol Loomis. Buffett was a true gorilla, though by no means the only director opposed in persuading Coke to drop its plan to buy Quaker Oats. Buffett will hold his tongue in a board meeting if a proposal for discussion just nibbles at shareholder value. But if a monster bite is to be taken, he won't stay quiet. And in this case, he thought the price Coke was proposing to pay, all of it in stock, was just too much. The terms would have left Coke giving up more than 10% of its very valuable self for assets that, even assuming some synergies, did not strike Buffett as granting Coke shareholders an acceptable payoff, even over the long term. By the time Buffett got through presenting his argument, The plan to buy Quaker was effectively dead. Debating Buffett about price is not, for most people, a rewarding experience. He is simply too logical and smart to be sent to defeat. Under Daff and his successor as CEO, Neville Eisdell, Coke's growth stalled and its stock languished. The next CEO, Muhtar Kent, took over in 2008, just in time for the credit crisis. But he has presided over good growth in the last couple of years, and as of mid-2012, Coke stock was selling at $39 per share versus the all-time high of $41 set in the bubble year of 1998. Berkshire still owns all of its 400 million shares. Against their cost basis of about $1.3 billion, they were valued at $15.6 billion in mid-year 2012. Coke's repurchases of stock have raised Berkshire's holding to 8.9% of what Buffett still thinks, well, leaving aside Berkshire, is the best large business in the world. CL. The full text of the 3 Coke articles excerpted here is available at fortune.com/BuffettBook. How Buffett Views Risk, April 4, 1994. An excerpt from Buffett's letter to shareholders in the 1993 Berkshire Hathaway Annual Report.
The strategy we've adopted precludes our following standard diversification dogma. Many pundits would therefore say the standard must be riskier than that employed by more conventional investors. We disagree. We believe that a policy of portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it. In stating this opinion, we define risk using dictionary terms as the possibility of loss or injury. Academics, however, like to define investment risk differently, averring that it is the relative volatility of a stock or a portfolio of stocks, that is, their volatility as compared to that of a large universe of stocks. Employing databases and statistical skills, these academics compute with precision the beta of a stock, its relative volatility in the past, and then build arcane capital investment and capital allocation theories around this calculation. In their hunger for a single statistic to measure risk, however, they forget a fundamental principle. It is better to be approximately right than precisely wrong. For owners of a business, and that's the way we think of shareholders, the academic's definition of risk is far off the mark, so much so that it produces absurdities. For example, under beta-based theory, a stock that has dropped very sharply compared to the market, as had Washington Post when we bought it in 1973, becomes riskier at the lower price than it was at the higher price. Would that description have then made any sense to someone who was offered the entire company at a vastly reduced price? In fact, the true investor welcomes volatility, because a wildly fluctuating market means that irrationally low prices will periodically be attached to solid businesses. It is impossible to see how the availability of such prices can be thought of as increasing the hazards for an insurer who is totally free to either ignore the market or exploit its folly.
Buffett hits $200 billion downdraft. November 17, 1994. By Colin Leinster.
Quick, what's the fastest way to become a millionaire in the airline business? Answer: start with $1 billion. So goes a joke from Warren Buffett, who, by Fortune's estimate, is sitting on a paper loss of about $200 million on his $358 million investment in the embattled U.S. Air Group. But behind the scenes, Buffett is obviously talking tougher. U.S. Air's 1994 proxy contains what amounts to a warning. He and Charles Munger, vice chairman of Berkshire Hathaway, Buffett's company and investing arm, will quit as U.S. Air directors if the company doesn't win cost-cutting concessions from its union. U.S. Air has the highest costs among domestic carriers and aims to slice $1 billion out of its overhead, with $500 million coming from labor. Like other insiders, Buffett declines to comment on where U.S. Air is headed. But the September 8 crash near Pittsburgh, which killed 132 people, made a cloudy future even murkier. Observers at first hoped the disaster would encourage pilots, machinists, and flight attendants to agree to bigger cuts. But that optimism soon faded. Says Robert Flock, a spokesman for the Airline Pilots Association, "Every time before when the company has been in trouble, it has come to the pilots and then squandered what it got." Analyst John Pinkavage of the Transportation Group points out that money-losing, cash-strapped U.S. Air has no control over other big costs such as fuel prices. Says he, "There's not a lot of room for anything to go wrong. No barrier between U.S. Air and sailing into the sunset." U.S. Air spokeswoman Andrea Butler insists that anything like going into Chapter 11 is a last resort. Management is more focused on working out productive labor agreements. The airline may well have to add profit sharing and board representation to its current offer. Such sweeteners were part of how Northwest and TWA settled their union differences.
Editor's note: Buffett's misstep into U.S. Air in the early 1990s drew so much public attention, and no doubt produced so many chuckles, that many people think to this day that the investment was a painful loser for Berkshire. But in 1996, a new CEO, Stephen Wolfe, took over the company and engineered what Buffett described in Berkshire's 1997 annual report as a resuscitation bordering on the miraculous. U.S. Air's stock went from a low of $4 a share to $75 a share, and the conversion rights in Berkshire's U.S. Air convertible preferreds, therefore, shot up in value. Dividends on the preferred that had not been paid were made up and were also, because of their lateness, accompanied by compensatory payments. With the preferred to be called for redemption in 1998, Buffett said in the 1997 annual report, "It is now almost certain that our U.S. Airways share will produce a decent profit, that is, if my cost for Maalox is excluded, and the gain could even be indecent." The dollar gain was never reported, but much later in the 2007 annual report, Buffett called it hefty. He also noted what had happened in the intervening years to U.S. Air. The company went bankrupt twice. Buffett and Gates. We've put these two articles together because they appeared sequentially and have the shared virtue of dipping into the friendship, the surprising friendship, between Buffett and Bill Gates in its early days. What we have here, after all, is not only an age difference of 25 years, but also a yawning gap then, if less exclusively so now, between what the two were obsessively interested in: investments for Buffett and technology for Gates. In 1991, nonetheless, a mutual friend of the two titans, Meg Greenfield, editor of the Washington Post editorial page and a longtime friend of Gates's mother, Mary, brought them together. Greenfield, in fact, was intrigued by her idea. "I was not unaware," Greenfield told Fortune in the mid-1990s, "that this was an interesting pairing." The site of their meeting was the country home, outside Seattle, of Gates's parents, Mary and Bill Sr. Greenfield, who grew up in Seattle and kept a house there, brought her house guests: Buffett and Washington Post Company CEO Katharine Graham. They came to the gathering in Greenfield's ancient, cramped Subaru. Bill and his girlfriend, soon-to-be wife, Melinda French, arrived more grandly, in a helicopter. Bill hoped, even upon landing, to escape early. He hadn't wanted to come, but had given in to his mother's wishes that he be there. His view changed immediately as he began talking to Buffett. Their minds connected, as if each man had quickly realized that, for once, the playing field for brilliance had leveled out. That was the start of a close friendship that lasts to this day, and that, in particular, has gone on to create philanthropic history. Back to the nature of the two articles that follow. The first was a box within a long piece about Gates. The second piece, by Gates himself, is ostensibly his review of a new Buffett book by Roger Lowenstein. But more than half the article is simply Gates presenting, in a wide-ranging way, his impressions of Buffett. The second piece is also, to my knowledge, unique in Fortune's history, being probably the only article in our more than 80 years to have been first published in another business magazine, specifically Harvard Business Review. The article, nonetheless, seemed so interesting to Fortune's editors, one billionaire talking about the other, that we secured permission from Bill Gates to republish it verbatim. Thanks to the author once again. C.L. The Billionaire Buddies, January 16, 1995, by Brent Schlender.
Who says you can't put a value on friendship? When the pals are Bill Gates and Warren Buffett, the total comes to nearly $19 billion, give or take a few hundred million. For 4 years now, America's two richest men, at the moment Buffett is number one, have cultivated an intriguing cross-generational friendship in which their wealth is probably their biggest similarity. We're sort of the odd couple, aren't we, says Buffett, the chairman of Berkshire Hathaway, Inc., and self-professed technophobe. Buffett, 64, is the epitome of the industrial age investor, spinning billions from holdings in the most basic of businesses, companies that make things like shoes, soda pop, and razor blades. Gates, on the other hand, is the Midas of the information age, who made his billions selling pure thought stuff. The two were introduced by mutual friend Meg Greenfield, a Washington Post editorial page editor who, like Gates, is a native of Seattle. The billionaires avail each other of free advice from time to time. For years, Gates tried in vain to convince Buffett that he ought to at least think about buying a personal computer. Buffett finally bought one at the behest of another friend so he could play online bridge. Among his playing partners is Bill Gates' dad. And Buffett, who flies around the country in a used jet he calls the Indefensible, has offered Gates some sage advice about such corporate status symbols. Says Buffett, I told him that I didn't get mine until I was 55, and that maybe he ought to save something for his old age, too. Buffett also helped Gates find a cut-rate deal on a diamond ring when he got engaged a couple of years ago. Gates cooked up a scheme to surprise his wife-to-be, Melinda French, with a trip to Omaha to pick out a ring at Borsheim's, the famous jewelry store owned by Berkshire Hathaway. Gates chuckles as he recalls, Warren had them open the store on the Sunday especially for us. On the way there, he told me that when he first got engaged, he spent 6% of his net worth on the ring, and that as a sign of true loyalty, I should do the same for Melinda. The two occasionally tease each other about who is richer. Knowing that Gates is an inveterate gambler, Buffett once bought a pair of what he calls tricky dice to a get-together. Says Buffett, I was trying to put him in second place permanently, but Bill immediately caught on, of course. Buffett also jokes that if I had known that it was Bill that I was bidding against for Leonardo da Vinci's notebook, I would have bid the price up even higher. What does Gates enjoy most about Buffett? The conversation. Says he, Warren is so humble and yet so good at describing complicated things. At the surface level, it's funny for him to quote, say, Mae West when talking about his investment philosophy, but of course, he is really saying something much deeper. He's like that all the time, so I am always learning something about him.
Gates on Buffett, February 5, 1996, by Bill Gates.
Roger Lowenstein begins his biography of Warren Buffett with a disclaimer. He reveals that he is a long-time investor in Berkshire Hathaway, the company that under Buffett's guidance has seen its share price rise in 33 years from $7.60 to approximately $30,000. In reviewing Lowenstein's book, I must begin with a disclaimer, too. I can't be neutral or dispassionate about Warren Buffett because we're close friends. We recently vacationed together in China with our wives. I think his jokes are all funny. I think his dietary practices, lots of burgers and cokes, are excellent. In short, I'm a fan. It's easy to be a fan of Warren's, and doubtless many readers of Buffett, The Making of an American Capitalist, Random House, 1995, will join the growing ranks. Lowenstein's book is a straightforward account of Buffett's remarkable life. It doesn't fully convey what a fun, humble, charming guy Warren is, but his uniqueness comes across. No one is likely to come away from it saying, "Oh, I'm like that guy." The broad outlines of Warren's career are well known, and the book offers enjoyable detail. Lowenstein traces Warren's life from his birth in Omaha in 1930 to his first stock purchase at age 11, and from his study of the securities profession under Columbia University's legendary Benjamin Graham to his founding of the Buffett Partnership at age 25. The author describes Buffett's secretiveness about the stocks he picked for the partnership and his contrasting openness about his guiding principle, which is to buy stocks at bargain basement prices and hold them patiently. As Warren once explained in a letter to his partners, this is the cornerstone of our investment philosophy. Never count on making a good sale. Have the purchase price be so attractive that even a mediocre sale gives good results. Lowenstein describes how Warren took control of Berkshire Hathaway and cash cowed its dying textile business in order to purchase stock in other companies. The book traces how Berkshire evolved into a holding company and how its investment philosophy evolved as Warren learned to look beyond financial data and recognize the economic potential of unique franchises like dominant newspapers. Today, Berkshire owns companies such as See's Candies, the Buffalo News, and World Book, as well as major positions in companies such as American Express, Capital Cities ABC, about to be Disney, Coca-Cola, Gannett, Gillette, and the Washington Post Company. Readers are likely to come away from the book feeling better educated about investing and business, but whether those lessons will translate into great investment results is less than certain. Warren's gift is being able to think ahead of the crowd, and it requires more than taking his aphorisms to heart to accomplish that, although Warren is full of aphorisms well worth taking to heart. For example, Warren likes to say that there are no called strikes in investing. Strikes occur only when you swing and miss. When you're at bat, you shouldn't concern yourself with every pitch, nor should you regret good pitches that you don't swing at. In other words, you don't have to have an opinion about every stock or other investment opportunity, nor should you feel bad if a stock you didn't pick goes up dramatically. Warren says that in your lifetime, you should swing at only a couple dozen pitches, and he advises doing careful homework so that the few swings you do take are hits. His penchant for long-term investments is reflected in another aphorism. You should invest in a business that even a fool can run, because someday a fool will. He doesn't believe in businesses that rely on their success on every employee being excellent. nor does he believe that great people help all that much when the fundamentals of a business are bad. He says that when good management is brought into a fundamentally bad business, it's the reputation of the business that remains intact. Warren installs strong managers in the companies Berkshire owns and tends to leave them pretty much alone. His basic proposition to managers is that to the degree that a company spins off cash, which good businesses do, the managers can trust Warren to invest it wisely. He doesn't encourage managers to diversify. Managers are expected to concentrate on businesses they know well, so that Warren is free to concentrate on what he does well: invest. My reaction upon meeting Warren took me by surprise. Whenever somebody says to me, "You've got to meet my friend so-and-so, he's the smartest guy ever," my defenses go up. Most people are quick to conclude that someone or something they encounter personally is exceptional. This is just human nature. Everybody wants to know someone or something superlative. As a result, people overestimate the merit of that to which they've been exposed. So the fact that people called Warren Buffett unique didn't impress me much. In fact, I was extremely skeptical when my mother suggested I take a day away from work to meet him on July 5th, 1991. What were he and I supposed to talk about? P/E ratios? Spend all day with a guy who just picks stocks? Especially when there's lots of work to do. Are you kidding? I said to my mom, "I am working on July 5th. We're really busy. I am sorry." She said, "Kay Graham will be there." Now, that caught my attention. I had never met Graham, but I was impressed with how well she had run the Washington Post Company and by her newspaper's role in political history. As it happened, Kay and Warren had been great friends for years, and one of Warren's shrewdest investments was in Post stock. Kay, Warren, and a couple of prominent journalists happened to be in the Seattle area together, and owing to an unusual circumstance, they all squeezed into a little car that morning for a long drive to my family's weekend home, which is a couple of hours outside the city. Some of the people in the car were as skeptical as I was. "We're going to spend the whole day at these people's house?" someone in the cramped car asked. "What are we going to do all day?" My mom was really hardcore that I come. "I'll stay a couple of hours and then I'm going back," I told her. When I arrived, Warren and I began talking about how the newspaper business was being changed by the arrival of retailers who did less advertising. Then he started asking me about IBM. If you were building IBM from scratch, how would it look different? What are the growth businesses for IBM? What has changed for them? He asked good questions and told educational stories. There's nothing I like so much as learning, and I had never met anyone who thought about business in such a clear way. On that first day, he introduced me to an intriguing analytic exercise that he does. He'll choose a year, say 1970, and examine the 10 highest market capitalization companies from around then. Then he'll go forward to 1990 and look at how those companies fared. His enthusiasm for the exercise was contagious. I stayed the whole day, and before he drove off with his friends, I even agreed to fly out to Nebraska to watch a football game with him. When you are with Warren, you can tell how much he loves his work. It comes across in many ways. When he explains stuff, it's never, "Hey, I'm smart about this and I'm going to impress you." It's more like, "This is so interesting and it's actually very simple. I'll just explain it to you and you'll realize how dumb it was that it took me a long time to figure it out." And when he shares it with you, using his keen sense of humor to help make the point, it does seem simple. Warren and I have the most fun when we're talking about the same data that everybody has and coming up with new ways of looking at them that are both novel and, in a sense, obvious. Each of us tries to do this all the time for our respective companies, but it's particularly enjoyable and stimulating to discuss these insights with each other. We are quite candid and not at all adversarial. Our business interests don't overlap much, although his printed World Book Encyclopedia competes with my electronic Microsoft Encarta. Warren stays away from technology companies because he likes investments in which he can predict winners a decade in advance, an almost impossible feat when it comes to technology. Unfortunately for Warren, the world of technology knows no boundaries. Over time, most business assets will be affected by technology's broad reach, although Gillette, Coca-Cola, and See's should be safe. One area in which we do joust now and then is mathematics. Once, Warren presented me with 4 unusual dice, each with a unique combination of numbers, from 0 to 12 on its sides. He proposed that we each choose one of the dice, discard the third and fourth, and wager on who would roll the highest number most often. He graciously offered to let me choose first, and then he said, "Okay, because you get to pick first, what kind of odds would you give me?" I knew something was up. "Let me look at those dice," I said. After studying the numbers on their faces for a moment, I said, "This is a losing proposition. You choose first." Once he chose a die, it took me a couple of minutes to figure out which of the 3 remaining dice to choose in response. Because of the careful selection of the numbers on each die, they were non-transitive. Each of the 4 dice could be beaten by one of the others. Die A would tend to beat die B, die B would tend to beat C, die C would tend to beat D, and die D would tend to beat die A. This meant that there was no winning first choice of a die, only a winning second choice. It was counterintuitive, like a lot of things in the business world. Warren is great with numbers, and I love math too. But being good with numbers doesn't necessarily correlate with being a good investor. Warren doesn't outperform other investors because he competes odds better. That's not it at all. Warren never makes an investment where the difference between doing it and not doing it relies on the second digit of computation. He doesn't invest, take a swing of the bat, unless the opportunity appears unbelievably good. One habit of Warren's that I admire is that he keeps his schedule free of meetings. He's good at saying no to things. He knows what he likes to do, and what he does unbelievably well. He likes to sit in his office and read and think. There are a few things he'll do beyond that, but not many. One point that Lowenstein makes that is absolutely true is that Warren is a creature of habit. He grew up in Omaha, and he wants to stay in Omaha. He has gotten to know a certain set of people, and he'd like to spend time with those people. He's not a person who seeks out exotic new things. Warren, who just turned 65, still lives in the Omaha house he bought for himself at age 25. His affinity for routine extends to his investment practices, too. Warren sticks to companies that he is comfortable with. He doesn't do much investing outside the U.S. There are a few companies that he has decided are great long-term investments. And, despite the self-evident mathematics that there must be a price that fully anticipates all the good work that those companies will do in the future, he just won't sell their stock no matter what the price is. I think his reluctance to sell is more philosophical than optimization-driven, but who am I to second-guess the world's most successful investor? Warren's reluctance to sell fits in with his other tendencies. Warren and I share certain values. We both feel lucky that we were born into an era in which our skills have turned out to be so remunerative. Had we been born in a different time, our skills might not have had much value. Since we don't plan on spending much of what we have accumulated, we can make sure our wealth benefits society. In a sense, we're both working for charity. In any case, our heirs will get only a small portion of what we accumulate, because we both believe that passing on huge wealth to children isn't in their or society's interests. Warren likes to say that he wants to give his children enough money for them to do anything, but not enough for them to do nothing. I thought about this before I met Warren, and hearing him articulate it crystallized my feelings. Lowenstein is a good collector of facts, and Buffett, The Making of an American Capitalist, is competently written. Warren has told me that the book is in most respects accurate. He says he's going to write his own book someday, but given how much he loves to work and how hard it is to write a book, based on my own personal experience, I think it will be a number of years before he does it. When it comes out, I'm sure it will be one of the most valuable business books ever. Already, Warren's letters to shareholders in the Berkshire Hathaway annual reports are among the best of business literature. Much of Lowenstein's analysis comes from those letters, as it should. If, after reading Buffett, you're intrigued by the man and his methods, I strongly commend you to the annual reports, even ones from 10 or 15 years ago. They're available in many libraries. Other books have been written about Warren Buffett and his investment strategy, but until Warren writes his own book, this is the one to read.
From Untangling the Derivatives Mess, March 20th, 1995. An excerpt from an article by Carol Loomis. Here are the last 2 paragraphs of this article. Given the range of complications that derivatives present, outside directors cannot possibly achieve close communion with the contacts their companies hold. Most chief executives won't master the game either. In the end, the choice of what risks to hedge, what derivatives to employ in doing so, and how to draw the bright line between risk management and speculation will be largely left to financial people down the corridor, some of whom, recent train wrecks notwithstanding, may think of themselves as running a profit center. And on the other end of their phones will be derivative salespeople trying to sell the latest innovation, which assuredly will not be a plain vanilla hedge. It's not a particularly cheerful picture, not for a problem as big as derivatives. So maybe what we need is new thinking, a fresh approach, a suggestion so radical it goes off the page. Here's one. Warren E. Buffett, chairman of Berkshire Hathaway, says he'd deal with derivatives by requiring every CEO to affirm in his annual report that he understands each derivatives contract his company has entered into. Says Buffett, put that in, and I suspect you'll fix up just about every problem that exists. In a market that seems to thrive on complexity and obfuscation, such a solution won't happen. It's too simple. But he's right. 2 items from Now Hear This, April 3, 1995. Warren E. Buffett, 64, chairman of Berkshire Hathaway, which sells its candy, shoes, and other products at the annual meeting. Though we'd like to think of the meeting as a spiritual experience, we must remember that even the saintliest of religions includes the ritual of the collection plate. May 29, 1995. Charles T. Munger, 71, vice chairman of Berkshire Hathaway, referred to litigation involving the company. They subpoenaed our staffing papers. Not only didn't we have any staffing papers, we didn't have any staff. From Why Warren Buffett's Betting Big on American Express, October 30th, 1995. Excerpts and a sidebar from an article by Linda Grant. When Buffett is accumulating a stock, he doesn't want it known. When the news gets out, usually because of an SEC filing, and Buffett figures he still might buy more of the stock, he won't say much about why he likes it. That was the case with American Express in 1995. The business press, including Fortune, was calling, but Buffett wasn't talking. So we wrote our story anyway, even flagging it on the cover with a title more skeptical than the inside title above. The cover read, "Why is Warren Buffett betting billions on this house of cards?" The reality is that the Fortune writer and editors working on this story didn't like Amex's prospects at all, but had to deal with the annoying fact that Buffett apparently did. Our approach to this problem was to write a long article beginning and ending with Buffett, and also including a sidebar about him, but that otherwise dealt at length with the difficulties facing Harvey Golub, the company's new CEO. Golub had come from consulting firm McKinsey. Fortune took the view that a consultant's talents, cost-cutting, and selling divisions, in particular, might not be ideal for restoring the prestige that Amex had lost in the early 1990s. Here is what Fortune had to say about Buffett in several paragraphs and the sidebar. At the end, we will report what he eventually had to say about the subject himself. C.L. The story's beginning. Warren Buffett loves to tell a parable about the stock market's irrationality. It was 1963, and a scandal involving fake inventories of salad oil at a small subsidiary of American Express drove down the price of Amex shares. How bad a problem was this? To find out, Buffett spent an evening with the cashier at Ross's Steakhouse in Omaha, seeing if people would stop using their green cards. The scandal didn't seem to give any of the diners indigestion, so Buffett seized the opportunity to buy 5% of the company for $13 million. He later sold his holding for a $20 million profit. Now Buffett hopes to relive the story, with much larger numbers. Over the past few years, the CEO of Berkshire Hathaway has accumulated more than 49 million shares of American Express at a 10.1% stake. Its value, about $2.2 billion, makes it one of Buffett's largest investments, along with Coca-Cola, Gillette, and Capital Cities ABC. Once again, he thinks Wall Street is irrationally down on Amex stock. The trouble this time is not salad oil, but a long and well-publicized catalog of strife. A nearly dysfunctional management team, led by James Robinson III, damaged the brand in the early 1990s. His grand strategy to build a financial supermarket fell like a house of cards, with Amex's Shearson Lehman brokerage subsidiary eating up $4 billion in capital before being sold last year. More recently, the tarnished American Express card has been losing market share to Visa and MasterCard as Amex's principal consumer benefit Prestige becomes a tougher sell. The company's international business, say analysts, is in the doldrums. Always the patient investor, Buffett, worth $14.2 billion at last count, believes the latest troubles are little more than a distraction. What he likes is exactly what has made him rich before: a mighty brand coupled with a healthy cash flow. After all, American Express, according to London marketing group Interbrand, is still one of the 10 most recognized brands in the world. Buffett believes the name remains synonymous with financial integrity and money substitutes around the world. As he explained to Berkshire Hathaway shareholders at last spring's annual meeting, quote, "By far the most important factor in Amex's future for a great many years to come will be the credit card. We think American Express's management thinks well about how to keep the card special." Buffett probably isn't particularly concerned about the company's loss of market share. More likely, he's gambling that Amex, even if it fails to grow dramatically, will become a very profitable niche player in the card market. But if American Express is to fulfill Buffett's expectations, it will have to breathe new life into its brand. No easy task. At the story's end. No matter how tough the challenges that lie ahead for Amex, it's rarely wise to bet against Warren Buffett. After all, he has wagered on strong brands like Coke and Gillette and made a bundle. He also invested successfully in auto insurer Geico, which, like Amex, has a strong cash flow. When Buffett comes up aces, it's usually because he's backing a strong management hand. What's hard to see this time around is how a bunch of consultants can rake in the pot in a truly cutthroat game. How Buffett Rated Amex a Buy, October 30th, 1995. A sidebar by Linda Grant. Just about everyone knows that Warren Buffett is a zealous disciple of value investing, the approach championed by Wall Street legend Benjamin Graham in the 1930s and 1940s. Value investors buy stocks only when they believe the market is temporarily and irrationally valuing a company at far below what they call its intrinsic value. But many are mystified by Buffett's purchase of roughly $2 billion of American Express shares. Wall Street has shunned the stock in recent years as Amex began losing market share and suffered from problems at its former brokerage subsidiary, Shearson Lehman. But maybe it's all the bad news that attracted Buffett in the first place. After all, a primary Graham tenet is to think for yourself and understand the difference between price and value. He also counseled followers to rake the market for bargains. Value investor Robert G. Hagstrom, Jr., author of The Warren Buffett Way and portfolio manager of Philadelphia's Focus Trust, points out that to understand any Buffett investment, investors must start with his philosophy, stated in his 1989 letter to shareholders of Berkshire Hathaway. Buffett wrote that the value of any business today is, quote, calculated by taking all future cash flows, in and out, and discounting them at prevailing interest rates. So valued, all businesses, from manufacturers of buggy whips to operators of cellular phones, become economic equals. In other words, Hagstrom believes that Buffett determines a stock's value as if it were a bond. He starts with net owner earnings, which is reported earnings plus depreciation and amortization minus capital investments. For Amex, this was $1.4 billion last year, the same amount the company reported as its earnings, although that's not always the case. Then, he asks, if Amex were a bond with annual coupons of $1.4 billion, how much would the coupon grow? And what would the bond be worth 10 years out? It's difficult to determine a company's coupon, says Hagstrom, because you have to make best guess estimates about a rate of growth. This is a very basic financial theory, but of course the secret is in the doing. So far, no one has cracked the Buffett valuation code, but Hagstrom has tried. His model calculates Amex's intrinsic value per share at $86.77. The spread between $86.77 and Amex's recent market price of about $44 represents a margin of safety. It is a big buffer, says Hagstrom, that will protect investors even if Amex loses money in a bad year. Liking the equation, Hagstrom himself decided to buy some 8,000 Amex shares for his own account. All that is what Fortune had to say in its October 30th, 1995 issue about Buffett and American Express. And when Buffett finally began talking about the subject himself, that was not until his 1997 annual shareholder letter. Did he also lay out a set of deeply analytical reasons as to why he had bought Amex stock? Absolutely not. Instead, he admitted getting a tip on the golf course. The background of the tip is that in 1991, Berkshire had bought $300 million worth of American Express perks, a security that was essentially a common stock, and that in its first 3 years featured a trade-off. Specifically, Berkshire got extra dividend payments in those years, but was also capped in the price appreciation it could realize. In August 1994, the perks were due to convert into common, and earlier that summer, Buffett was trying to decide whether to keep Amex stock or sell. The facts pushed him in two directions. Buffett wrote in his 1997 letter, he thought Amex CEO Harvey Golub was outstanding and would realize the company's full potential. He was worried, though, about the relentless competition that Amex was getting from other card companies, especially Visa. Weighing the arguments, Buffett said, I leaned toward sale. But then he played golf one 1994 day in Prouts Neck, Maine, with Frank Olson, CEO of Hertz. Wrote Buffett in his letter, Frank is a brilliant manager, with intimate knowledge of the card business. So from the first tee on, I was quizzing him about the industry. By the time we reached the second green, Frank had convinced me that Amex's corporate card was a terrific franchise, and I had decided not to sell. On the back nine, I turned buyer, and in a few months, Berkshire owned 10% of the company. Since the end of 1994, a midway point in Buffett's buying of American Express, Berkshire had realized, through mid-2012, an average annual compounded total return of about 13%. Included in that calculation is the value, at the distribution date, of a company that Amex spun off in 2005, Ameriprise. The distribution was treated as a special Amex dividend, which, like all dividends, went into the calculation of total return. At mid-2012, Berkshire's Amex stock had a cost basis of $1.3 billion and a market value of $8.8 billion. Nice, but that is not to say Berkshire has lacked for drama while holding Amex. Between July 2007 and March 2009, as financial stocks got shellacked, Amex dropped from $65 a share to $10 before it began to climb back. Naturally, Buffett just patiently watched. As this book went to press, Amex stock was $59. Amex has meanwhile bought in large quantities of its own stock, to the degree that Berkshire now owns 13% of the company. CL. The full text of why Buffett's betting big on American Express is available at fortune.com/BuffettBook. Gift That Gives. A Bit o' Buffett, March 18, 1996, by Bethany McLean. The $32,800 price tag on Berkshire Hathaway has thwarted both owners who wanted to give, even one share would trigger gift taxes, and little outsiders who wanted to own Warren Buffett's hot stock. On May 6, shareholders will vote on Buffett's plan to sell at least $100 million of new Class B shares for a mere $1,000 or so each. Current shares, to be renamed Class A, can convert to Bs at any time. Quote, "We just want to attract those who are attracted to us," Buffett says. To deter a slew of converts, he advises that the Bs are, quote, "a tiny bit inferior" to the existing A's. They have fewer voting rights and lack the A's input on corporate donations. But for gift givers and little guys, these baby Bs buy you real Buffett. The Bill and Warren Show, July 20th, 1998. Edited by Brent Schendler. This was Bill Gates and Warren Buffett on a University of Washington stage, lecturing, so to speak, but mostly doing it by answering questions. For an introduction, I will simply reprint, with small edits, the excellent Brent Schendler paragraphs with which Fortune led off this historic duopoly event. CL. The queue of students stretched through the lobby and out the door of the University of Washington's Husky Union Building in Seattle on a balmy Friday afternoon in late May. You could tell by the abundance of pressed chinos and dress shirts, and the shortage of nose rings, that this wasn't the ticket line for a Phish concert. Instead, the well-groomed group was staking out prime seats for, of all things, a lecture, albeit a very special lecture. The students and a few lucky guests were to be treated to a rare public dialogue between the two richest businessmen in the solar system, Bill Gates and Warren Buffett. The billionaire buddies conceived the event to coincide with Buffett's weekend visit to the Gates' home, following Microsoft's annual summit meeting for CEOs. The super investor and the cyber tycoon asked some 350 business school students to participate in the session and invited the public broadcasting system and Fortune to document the affair. While the students milled downstairs, Gates and Buffett bantered with their wives and a small group of friends that included, among others, Katharine Graham, the former CEO of the Washington Post Company, and Bill's dad and sister. They noshed on fresh fruit in a makeshift green room while a makeup artist powdered Bill's nose and trimmed Warren's unruly eyebrows, much to Susie Buffett's amusement. At one point, the Oracle of Omaha entertained the group with a goofy imitation of Richard Nixon's V for Victory sign. As showtime approached, the two gamely posed for photos and traded barbs like old college roomies. The other guest's main concern was that the Titans not be too long-winded, so everyone could get back to Gates's house in time to play bridge. It felt like a convivial family reunion, granted, of one very high-powered family. For a guest in that green room, perhaps the most lasting impression was the cross-generational affection between America's best-known billionaires. For the record, on that day, the 42-year-old Gates' net worth hovered around $48 billion, compared with Buffett's $36 billion. Buffett, who only a few years ago was considerably richer than Gates, has managed to remain 25 years older, though. Buffett's presence seemed to calm Gates, who acted loose and gregarious despite Microsoft's legal fisticuffs with federal trustbusters and the stress of hosting several dozen prominent CEOs for the previous 2 days. Although Bill has finally begun to look his age, nascent crow's feet now crease the corner of his eyes, and he's no longer the beanpole he was. The Buffetts and Graham still dote on him like a wunderkind. He, in turn, treats them with a warm hint of deference, quite a contrast to his usual debater's demeanor. Finally, the two made their way to the stage, pausing in the wings for University of Washington Business School Dean Bill Bradford's introduction. Unfortunately, the dean's remarks, which mainly praised Microsoft for hiring University of Washington students, missed the point. The funny, philosophical, extraordinary conversation that followed would be much more than a pep talk from a local employer and his pal. See for yourself. Brent Schendler. What do you get when you put a billionaire buddy act in front of 350 students? 84 billion of inspiration. In a meeting of incomparable minds and unspendable net worth, Buffett and Gates muse about taking risks, motivating employees, confronting mistakes, and giving back. The result? Something pretty darn close to wisdom.
1. How we got here. Warren and Bill explain how they became richer than God. Buffett. I thought I ought to start this off by announcing that Bill and I have a small bet as to who would get the most applause. I suggested that I bet my house against his. We settled on a small sum, but evidently it isn't such a small sum to Bill, because just before we came out, he gave me this Nebraska Cornhusker shirt to wear, and then he puts on this purple University of Washington shirt himself. They've asked us to start out talking, the two of us, about what got us here, but then it's on to your questions. How I got here is pretty simple in my case. It's not IQ, I'm sure you'll be glad to hear. The big thing is rationality. I always look at IQ and talent as representing the horsepower of the motor, but that the output, the efficiency at which that motor works, depends on rationality. A lot of people start out with 400 horsepower motors, but only get 100 horsepower of output. It's way better to have a 200 horsepower motor and get it all into output. So, why do smart people do things that interfere with getting the output they're entitled to? It gets into the habits and character and temperament and behaving in a rational manner, not getting in your own way. As I said, everybody here has the ability absolutely to do anything I do and much beyond. Some of you will, and some of you won't. For the ones who won't, it will be because you get in your own way, not because the world doesn't allow you. So I have one little suggestion for you. Pick out the person you admire the most, and then write down why you admire them. You're not to name yourself in this. And then put down the person that, frankly, you can stand the least, and write down the qualities that turn you off in that person. The qualities of the one you admire are traits that you, with a little practice, can make your own, and that, if practiced, will become habit-forming. The chains of habit are too light to be felt until they are too heavy to be broken. At my age, I can't change any of my habits. I'm stuck. But you will have the habits 20 years from now that you decide to put into practice today. So I suggest that you look at the behavior that you admire in others and make those your own habits. And look at what you really find reprehensible in others and decide that those are the things you are not going to do. If you do that, you'll find that you convert all of your horsepower into output. Gates. I think Warren's absolutely right about habit. I was lucky enough when I was young to have an exposure to computers which were very expensive and kind of limited in what they could do, but still they were fascinating. Some friends of mine and I talked about that a lot and decided that because of the miracle of chip technology, they would change into something that everybody could use. We didn't see any limit to the computer's potential, and we really thought writing software was a neat thing. So we hired our friends who wrote software to see what kind of a tool this could really be, a tool for the information age that could magnify your brain power instead of just your muscle power. By pursuing that with a pretty incredible focus, and by being there at the very beginning of the industry, we were able to build a company that has played a very central role in what's been a pretty big revolution. Now, fortunately, the revolution is still at the beginning. It was 23 years ago when we started the company, but there's no doubt that if we take the habits we formed and stick with them, the next 23 years should give us a lot more potential, and maybe even get us pretty close to our original vision. A computer on every desk and in every home. I was wondering how you define success personally. Buffett. I can certainly define happiness because happy is what I am. I get to do what I like to do every single day of the year. I get to do it with people I like, and I don't have to associate with anybody who causes my stomach to churn. I tap dance to work, and when I get there, I think I'm supposed to lie on my back and paint the ceiling. It's tremendous fun. The only thing in my job that I don't like, and this just happens every 3 or 4 years, is that occasionally I have to fire somebody. They say success is getting what you want, and happiness is wanting what you get. I don't know which one applies in this case, but I do know I wouldn't be doing anything else. I'd advise you that when you go out to work for an organization of people you admire, because it will turn you on. I always worry about people who say, I'm going to do this for 10 years. I really don't like it very well, and then I'll do this. That's a little like saving up sex for your old age. Not a very good idea. I have turned down business deals that were otherwise decent deals because I didn't like the people I would have to work with. I didn't see any sense in pretending. To get involved with people who cause your stomach to churn, I'd say it's a lot like marrying for money. It's probably a bad idea under any circumstances, but it's absolutely crazy if you're already rich, right? Gates: I agree that the key point is that you've got to enjoy what you do every day. For me, that's working with very smart people, and it's working on new problems. Every time we think, hey, we've had a little bit of success, we're pretty careful not to dwell on it too much because the bar gets raised. We've always got customer feedback telling us that the machines are too complicated and they're not natural enough. The competition, the technology breakthroughs, and the research make the computer industry, and in particular software, the most exciting field there is. And I think I have the best job in that business. Buffett: Don't you think Dairy Queen is more important than that? Berkshire Hathaway bought International Dairy Queen last fall for $585 million. Gates: You can manage Dairy Queen, Warren. I'll go and buy the dilly bars. Buffett: We'll raise the price when you come. Starting a new company is very risky. How do you determine when is the best opportunity to start a new company? Gates: When I started Microsoft, I was so excited that I didn't think of it as being all that risky. It's true, I might have gone bankrupt, but I had a set of skills that were highly employable, and my parents were still willing to let me go back to Harvard and finish my education if I wanted to. Buffett: You've always got a job with me, Bill. Gates: The thing that was scary to me was when I started hiring my friends, and they expected to be paid. And then we had customers that went bankrupt, customers that I counted on to come through. And so I soon came up with this incredibly conservative approach that I wanted to have enough money in the bank to pay a year's worth of payroll, even if we didn't get any payments coming in. I've been almost true to that the whole time. We've had about $10 billion now, which is pretty much enough for the next year. Anyway, if you're going to start a company, it takes so much energy that you'd better overcome your feeling of risk. Also, I don't think that you should necessarily start a company at the beginning of your career. There's a lot to be said for working for a company and learning how they do things first. In our case, Paul Allen and I were afraid somebody else might get there before us. It turned out we probably could have waited another year, in fact, because things were a little slow to start out. But being on the ground floor seemed very important to us. How did you get people to support you? Gates: At first, you'll run into some skepticism. If you're young, it's hard to go lease premises. You couldn't rent a car when you were under 25, so I was always taking taxis to go see customers. When people would ask me to go have discussions in the bar, well, I couldn't go to the bar. That's fun because when people are first skeptical, they say, "Oh, this kid doesn't know anything." But when you show them you've really got a good product and you know something, they actually tend to go overboard. So at least in this country, our youth was a huge asset for us once we reached a certain threshold. 2. The world is our oyster. Why Warren is sure everyone in China will want to drink Coke. How do you as businessmen take the companies global? Buffett: At Berkshire Hathaway, we don't take our businesses global directly. Our two largest commitments are Coke and Gillette. Coke has 80% of its earnings coming from abroad, and Gillette has 2/3 of its earnings coming from abroad. So they are participating in a worldwide improvement in living standards, and we go global by piggybacking on them. I can sit in Omaha and let Doug Ivester, CEO of Coca-Cola, fly all over the world. Gates: Our business is truly global. The PC standard is a global standard. What you need on a spreadsheet in Korea or Egypt is about the same as what you need in the U.S. We have to do some adaptation for the local languages, and that's a fun part of our business. Understanding bidirectional languages and the large alphabets that you have in Chinese, Japanese, and Korean. In fact, our market share is much higher outside the U.S. than it is inside, because it's relatively hard to set up local subsidiaries and to understand local conditions, local distribution, and relationships. Since most of our competitors are from the U.S. and aren't as good at doing international business, we thrive even better in these other countries. Most of our growth will come from outside the U.S. Here, it will get to the point where it is largely a replacement market. Now, that doesn't mean U.S. customers don't want better software that can see, listen, and learn. But outside the U.S., we still have that early growth slope phenomenon. What impelled you to make a trip together to China in 1995, and how has that trip affected your global business decisions since? Gates. We went to China for a lot of reasons. Partly to relax and have fun. We found a few McDonald's there, so we didn't feel too far away from home. It was also exciting to go and see all the changes taking place, to see different parts of the country, and to meet some of the leaders. China is a market that Microsoft had already been investing in. We've upped that a lot since. As a percentage of our sales, though, it's tiny, well under 1%. And so even though it will double every year for the next 5 years, it's really only by taking a 10-year view that we can say it's worth the emphasis we're putting on it. Although about 3 million computers get sold every year in China, people don't pay for the software. Someday they will, though. And as long as they are going to steal it, we want them to steal ours. They'll get sort of addicted, and then we'll somehow figure out how to collect sometime in the next decade. Buffett. My family was amazed that I went. I never traveled beyond the outer reaches of the county in Nebraska. I had a terrific time, and also confirmed my feeling that there's going to be a lot of Coca-Cola sold there in the future. I told everyone over there that it acts as an aphrodisiac. 3. Innovations are us. Warren ponders Internet chewing gum. Both of you are innovators in your given industries. I was wondering what your definition of innovation is. Buffett. I don't do a lot of innovating in my work. I really have just 2 functions. One is to allocate capital, which I enjoy doing. And the second one is to help 15 or 20 senior managers keep a group of people enthused about what they do when they have no financial need whatsoever to do it. At least 3/4 of the managers that we have are rich beyond any possible financial need, and therefore my job is to help my senior people keep them interested enough to want to jump out of bed at 6 o'clock in the morning and work with all of the enthusiasm they did when they were poor and starting. If I do those 2 things, they do the innovation. Gates. The technology business has a lot of twists and turns. Probably the reason it's such a fun business is that no company gets to rest on its laurels. IBM was more dominant than any company will ever be in technology, and yet they missed a few turns in the road. That makes you wake up every day thinking, let's try to make sure today's not the day we missed the turn in the road. Let's find out what's going on in speech recognition or in artificial intelligence. Let's make sure we're hiring the kinds of people who can pull those things together, and let's make sure we don't get surprised. Sometimes we do get taken by surprise. For example, when the Internet came along, we had it as a 5th or 6th priority. It wasn't like somebody told me about it and I said, "Oh, I don't know how to spell that." I said, "Yeah, I've got that on my list, so I'm okay." But there came a point when we realized it was happening faster and was a much deeper phenomenon that had been recognized in our strategy. So as an act of leadership, I had to create a sense of crisis, and we spent a couple of months throwing ideas and email around, and we went on some retreats. Eventually, a new strategy coalesced, and we said, okay, here's what we're going to do. Here's how we're going to measure ourselves internally, and here's what the world should think about what we're going to do. That kind of crisis is going to come up every 3 or 4 years. You have to listen carefully to all the smart people in the company, That's why a company like ours has to attract a lot of people who think in different ways. It has to allow a lot of dissension, and then it has to recognize the right ideas and put some real energy behind them. What countries and companies are best prepared to take advantage of the information age that is revolutionizing society? Buffett. When you think about it, 15 years ago, this country almost had an inferiority complex about its ability to compete in the world. Gates. Everybody was talking about how the Japanese had taken over consumer electronics, and that the computer industry was going to be next, and that their system of hard work somehow was superior, and that we had to completely rethink what we were doing. Now, if you look at what's happened in personal computers, or in business in general, or at how we allocate capital, and how we let labor move around, the U.S. has emerged in a very strong position. So the first beneficiary of all this information technology has been the U.S. In places like Singapore, Hong Kong, and the Scandinavian countries, people are adopting the technology at basically the same rate that we are. And there are a few countries that, relative to their level of income, are going after the technology at an even higher rate than we are because they believe so much in education. In Korea and in many parts of China, we see incredible penetration of personal computers even at very low income levels because people there have decided it's a tool to help their kids get ahead. The whole world is going to benefit in a big way. There will be this shift where instead of your income level being determined by what country you are from, it will be determined by your education level. Today, a PhD in India doesn't make nearly as much as a PhD in the US. When we get the internet allowing services and advice to be transported as efficiently as goods are transported via shipping, then you'll get essentially open market bidding for that engineer in India versus an engineer here in the US. And that benefits everyone because you're taking better advantage of those resources. So the developed countries will get the early benefit of these things, but in the long run, the people in developing countries who are lucky enough to get a good education should get absolutely the biggest boost from all of this. Buffett. I didn't grasp it at first, but it's huge. The technological revolution will change the world in dramatic ways and quickly. Ironically, however, our approach to dealing with that is just the opposite of Bill's. I look for businesses in which I think I can predict what they're going to look like in 10 or 15 or 20 years. That means businesses that will look more or less as they do today, except that they'll be larger and doing more business internationally. So I focus on an absence of change. When I look at the internet, for example, I try and figure out how an industry or company can be hurt or changed by it, and then I avoid it. That doesn't mean I don't think there's a lot of money to be made from that change. I just don't think I'm the one to make a lot of money out of it. Take Wrigley's chewing gum. I don't think the internet is going to change how people are going to chew gum. Bill probably does. I don't think it's going to change the fact that Coke will be the drink of preference and will gain in per capita consumption around the world. I don't think it will change whether people shave or how they shave. So we are looking for the very predictable, and you won't find the very predictable in what Bill does. As a member of society, I applaud what he's doing, but as an investor, I keep a wary eye on it. Gates. This is an area where I agree strongly with Warren. I think the multiples of technology stocks should be quite a bit lower than the multiples of stocks like Coke and Gillette, because we are subject to complete changes in the rules. I know very well that in the next 10 years, if Microsoft is still a leader, we will have had to weather at least 3 crises. 4. See you in court. Bill and Warren talk about tangling with trustbusters. What is the appropriate role for antitrust law in American business? Buffett. We had one civil antitrust case at the Buffalo Evening News in 1977, and believe it or not, in the Salomon situation in 1991, in addition to having problems with the Federal Reserve in New York, and the SEC, and the U.S. Treasury, and the U.S. Attorney for the Southern District of New York, we also had the Department of Justice Antitrust Division after us. I don't know what happened to the Bureau of Indian Affairs. They missed us for some reason. Those are the only two experiences I had, and in neither case did I feel that we had done anything wrong. I might add that there was never any adjudication against us either time. I am no antitrust scholar. I met Bill 8 years ago, and he's a terrific teacher. He spent 6 or 7 hours explaining Microsoft to me. Here I am, the world's biggest dummy on technology, and he explained it to me pretty darn well. When he got through with it, I bought 100 shares of stock so I could keep track of it. That shows two things. One is that I've got an IQ of about 50, and the second is that I don't think he had any monopoly. Gates. The key role of competition law is to protect consumers and to make sure that new products get created and that those products are very innovative. And you can look at different sectors of the economy and ask, where is that happening very well? No matter how you score it, there's no doubt that one sector of economy would stand out as absolutely the best, and that's the personal computer industry. I don't say the computer industry at large because you have to remember that before personal computers came along, the structure was very different. People were stuck. Once you bought a computer from Digital or IBM or Hewlett-Packard or anyone else, the software that you created only ran on that computer. The vision of Microsoft is that all of these computers would work the same. The reason for that is that if you want to get a lot of great software, you have to have a lot of computers out there, millions and millions of them. So you've got to make them cheap and make them so you don't have to test the software on all the different ones. The goal of the PC industry was to have every company competing to make the most portable one, or the fastest one, or the cheapest one. That would be great for consumers, and it would spark a big software market. The price of computing before the PC came along was going down at a certain rate, and since the PC came along, it's gone down at an incredible rate. The variety and quality of software has also increased at a phenomenal rate. We're absolutely at the peak of that today. The number of new software companies being started, the number of new jobs being created, the level of investment, the number of companies going public, you name it. It's way beyond what it was 3 years ago. So consumers are doing very well. Part of the PC dynamic is that instead of asking software developers to duplicate one another's work, we take anything that's typical in all those applications and put those features in Windows. So for things like connecting to the internet, instead of somebody having to do that themselves, we put that in. That's been the evolution. Graphical user interfaces came in, hard disk support, networking support, now internet support, including the browser. I think antitrust laws as written are fine. There are people who will debate whether they should be weaker, but that's of academic interest. When I come in to do business, I'm very careful to check with our lawyers to be sure we're steering 100 miles away from anything that would be questionable. So it is somewhat of a surprise to find ourselves in an antitrust controversy. Thank goodness for the judiciary, which is an environment in which facts are tested and people can see if competition worked in a way it should and has been beneficial to consumers. There's no doubt in our minds where that is going to come out. In the meantime, we're going to be the focus of a lot of controversy because the filing of a lawsuit is a very big deal. You've got the government taking on that challenge and saying a lot of righteous things, and that's just something we'll have to be sure doesn't distract us from what we're really all about. 5. What's a company really worth? Warren explains why Berkshire stock costs more than a Lexus. Mr. Buffett, I was told that you have a policy against splitting stock. and I wondered if you might comment on Microsoft's history of splitting stock. Buffett: I've never really felt that if I went into a restaurant and said, I want 2 hat checks instead of 1 for my hat, I'd really be a lot better off. But I also don't like having any quarrel with companies that do split their stock, and I don't think Microsoft's been hurt by it. I think that our policy fits us very well. There's nothing in my religious upbringing that causes me to recoil from stock splits. I'm on the boards of 3 companies, 2 of which have split their stock in the last couple of years. I happen to think that by not splitting Berkshire stock, we attract a slightly more long-term oriented group of investors. What you want to do is to attract shareholders that are very much like you, with the same time horizons and expectations. We don't talk about quarterly earnings, we don't have an investor relations department, and we don't have conference calls with Wall Street analysts because we don't want people who are focusing on what's going to happen next quarter or even next year. We want people to join us because they want to be with us until they die. If I were to split the stock dramatically, would I change that shareholder composition much? No, but I'd change it just a little. And remember, all the shareholder seats are filled, just like this auditorium. If I say something that offends all of you and you all leave, and another group comes in, am I better off or worse off? Well, that depends upon what they're like and what you're like. But I think I already have a very good group of shareholders who are attracted to these policies, and I think this policy reinforces it slightly. Gates: Warren has done something admirable by signaling to people that it's a different stock, and that they ought to think of Berkshire Hathaway as being a little different from your typical company. Having that unusual stock price is probably a good thing, as long as the newspaper doesn't screw it up. He's caused a lot of problems, with the widths of those columns in the stock tables. Mr. Buffett, what's your response to those who say that traditional methods for valuing companies are obsolete in this market? Buffett: I think it's hard to find companies that meet our tests of being undervalued in this market, but I don't think that the methods of valuation have changed. It's just that in some markets, like in the mid-1970s, every security you looked at was really dramatically undervalued. I once ran an investment partnership for about 13 years, ending in 1969, and I closed it up because I couldn't find anything. I hadn't lost the ability to value companies, there just wasn't any left that were cheap enough, and I wasn't in the business of shorting stocks. But I think that there's no magic to evaluating any financial asset. A financial asset means, by definition, that you lay out money now to get money back in the future. If every financial asset were valued properly, they would all sell at a price that reflected all of the cash that would be received from them forever until Judgment Day, discounted back to the present at the same interest rate. There wouldn't be any risk premium because you'd know what coupons were printed on this bond between now and eternity. That method of valuation is exactly what should be used whether you're in 1974 or you're in 1998. If I can't do that, then I don't buy, so I'll wait. Would you look for a higher price-to-earnings ratio at this point than you did in 1969? Buffett: That ratio would be affected by interest rates. The difference between now and 1969 or any other time, in terms of calculating a valuation, wouldn't be affected by anything else. Now, if you looked at the overall market, returns on equity are much higher than they were in 1969 or 1974 or any other time in history. So if you're going to say you're going to value the overall market, the question becomes, do you crank in the present 20% returns on equity for American business in aggregate and say that's a realistic figure to stick on for this future that runs out until eternity? I'd say that's a fairly reckless assumption and doesn't leave much margin for safety, and I would say that present market levels discount a lot of that. So that makes me quite cautious. Do you feel that technology has made businesses more efficient to the point that you can pay more for them? Gates: There is definitely a one-time lift when you start using technology, and particularly if U.S. companies are using it better than their competitors outside the U.S. You get the ability to communicate better, and you get global scale in a lot of businesses that wouldn't have had it before. When you look at the really big earners, the ones generating this 20% return on equity and going to that worldwide marketplace, companies like Coca-Cola or Microsoft or Boeing or GE, I know that every one of those has been helped by technology. But that cannot explain why 10 years from now they'd be getting that kind of return on equity. Almost certainly there's something ephemeral about current conditions. Buffett: I'm sure technology has made companies more efficient, and if I thought otherwise, I'd be afraid to say so with Bill sitting right here beside me. But the question you might ponder is this. Let's just say that I found a way to clone Jack Welch and ran off 499 clones of him. Jack continued to run General Electric, and these other 499 ran the rest of the Fortune 500. Is the Fortune 500 going to have a higher return on equity 5 years from now or not? I don't think the answer to that is easy, because if you get 500 Jack Welches out there, they are going to be doing things in a competitive way that may well produce lower returns for American businesses than if you've got a bunch of clods out there and a guy like Jack competing with them. If you've got great variation in the quality of management, it improves the chances enormously of a relatively significant number getting terrific returns. So I would say that a lot of things in business, including technology, really have the same effect as if you went to a parade and the band started coming down the street, and all of a sudden you stood up on tiptoe. In another 30 seconds, everybody else is up on tiptoe, and it would be hell on your legs, and you still wouldn't be seeing any better. Capitalism tends to be self-neutralizing like that, in terms of improvements. That's marvelous because it means we have better everything than otherwise, but the real trick is to stand up on tiptoe and not have anyone notice you. The recent wave of mergers has been staggering. Could you comment on how any of these mergers will create value for shareholders? Buffett: Actually, the two of us have a small announcement we'd like to make. Laughter. It won't stop. Mergers will be motivated by very good considerations. There truly are synergies in a great many mergers, but whether there are synergies or not, they are going to keep happening. You don't get to be the CEO of a big company by being a milquetoast. You are not devoid of animal spirits, and it gets contagious. I've been a director of 19 different public companies over the years, and I can tell you that the conversation turns to acquisitions and mergers much more when the competitors of the particular company are engaging in those. As long as our economy works the way it does, and I think it works very well, you're going to see a lot of it. A generally buoyant market tends to encourage mergers because everybody's currency is more useful in those circumstances. A few weeks later, Berkshire Hathaway agreed to pay $23.5 billion in stock to acquire General Re, the world's third largest reinsurance company. Gates: I think it's good to have a healthy skepticism, but General Motors was created out of a restructuring of the automobile industry for specialized orientation to companies that did the whole job, and anybody who missed that was basically wiped out. We've bought a lot of small companies, and I'd say that's been vital to us. These are companies that on their own probably wouldn't have made it, but when their abilities are combined with ours, both of us were able to create a much better set of products than we could have otherwise. I think in banking today, if you're a medium-sized bank, you're probably going to need to participate in all this stuff that's going on. It doesn't make that much sense to have so many banks in this country, and so there will be certain ones going after scale. But there are a lot of silly mergers, too. At the end of the day, is the shareholder better off after a merger? Buffett: In most acquisitions, it's better to be the target than the acquirer. The acquirer pays for the fact that he gets to haul back to his cave the carcass of the conquered animal. I am suspicious of people who just keep acquiring almost by the week, though. If you look at the outstanding companies, say a Microsoft or an Intel or a Walmart, their growth overwhelmingly has been internal. Frequently, if some company is on a real acquisition binge, they feel they're using funny money, and it has certain aspects of a chain letter game. Beyond that, I'd like to see a period where merged companies just run by themselves after a deal, rather than moving around the accounting and putting up big restructuring charges. I get suspicious when there's too much activity. I like to see organic growth. 6. Aw shucks. Warren and Bill muse on their mistakes, their business partners, and managerial succession. What was the best business decision you made? Buffett. It was just jumping in the pool, basically. The nice thing about the investment business is that you don't need very many deals to succeed. In fact, if when you got out of business school here, you got a punch card with 20 punches on it, and every time you made an investment decision, you used up one punch, and that's all you were going to get, you would make 20 very good investment decisions, and you could get very rich, incidentally. You don't need 50 good ideas at all. I hope the one I made yesterday was a good one, but they've always been kind of simple and obvious to me. The truth is, you know them when you see them. They're so cheap. When I got out of Columbia University, I went through the Moody's manuals page by page. The industrial manual, the transportation manual, the banks and finance manual, just looking for things. And I found stocks at 1 time's earnings. One was Genesee Valley Gas, a little tiny company up in upstate New York, a public utility selling at 1 time's earnings. There were no brokerage reports on it, no nothing. But all you had to do was turn the page. It worked out so well I actually went through the book a second time. Bill was reading the World Book at the time. He's since put it out of business. Gates. We were talking at breakfast this morning about which of all Warren's investment decisions was the worst one. They're tough to find because his track record is unbelievable. But we decided that, by some metric, buying the one that his company is named after, Berkshire Hathaway, was probably his worst investment decision. Buffett. That's true. We went into a terrible business because it was cheap. It's what I refer to as the used cigar butt approach to investing. You see the cigar butt down there? It's soggy and terrible, but there's one puff left, and it's free. That's what Berkshire was when we bought it. It was selling below working capital. But it was a terrible, terrible mistake. I've made all kinds of bad decisions that have cost us billions of dollars. They've been mistakes of omission rather than commission. I don't worry about not buying Microsoft, though, because I didn't understand that business, and I didn't understand Intel. But there are businesses that I did understand. Fannie Mae was one that was within my circle of competence. I made a decision to buy it, and I just didn't execute. We would have made many billions of dollars, but we didn't do it. Conventional accounting doesn't record that, but believe me, it happened. Gates. In my case, I'd have to say my best business decisions have had to do with picking people. Deciding to go into business with Paul Allen is probably at the top of the list, and subsequently, hiring a friend, Steve Ballmer, who has been my primary business partner ever since. It's important to have someone who you totally trust, who is totally committed, who shares your vision, and yet who has a little bit different set of skills, and who also acts as something of a check on you. Some of the ideas you run by him, you know he's going to say, "Hey, wait a minute, have you thought about this and that?" The benefit of sparking off somebody who's got that kind of brilliance is that it not only makes business more fun, but it really leads to a lot of success. Buffett. I've had a partner like that, Charlie Munger, for a lot of years, and it does for me exactly what Bill is talking about. You have to calibrate with Charlie, though, because Charlie says everything I do is dumb. If he says it's really dumb, I know it is. But if he just says it's dumb, I take that as an affirmative vote. It seems that in both of your companies, your success is driven by yourselves and your leadership skills. What will happen when you're gone? Buffett. Your assumption is wrong. I will keep working until about 5 years after I die, and I've given the directors a Ouija board so they can keep in touch. But if the Ouija board doesn't work, we have outstanding people who can do what I do. People are not going to stop drinking Coca-Cola if I die tonight. They're not going to quit shaving tonight. They're not going to eat less C's candy or fewer dilly bars or anything of the sort. Those companies have terrific products. They've got outstanding managers, and all you need at the top of Berkshire is someone who can allocate capital and make sure you have the right managers down below. We've got the people identified to do that, and the board of directors of Berkshire knows who they are. In fact, I've already sent out a letter that tells what should be done. And I've got another letter that's addressed that will go out at the time, and it starts out, "Yesterday I died," and then tells what the plans of the company are. Gates. My attitude is a lot like Warren's. I want to keep doing what I'm doing for a long, long time. I think probably a decade from now or so, even though I'll still be totally involved with Microsoft because it's my career, I will pick somebody else to be CEO. Buffett. I see some hands in the audience here. Gates. That's a long time hence, and our top managers are always sitting down and talking about succession in general, because we want to make sure that we're giving people the opportunity to move up. We don't want to ever create a situation where they feel like it's clogged and they have to go off somewhere else to get big challenges. Our growth helps a lot. We're able to spawn off very, very big jobs for people. Picking that next person is something I give a lot of thought to. But it's probably 5 years before I have to do something very concrete about it. If there was a surprise, well, there's a contingency plan. 7. Charity begins when I'm ready. Bill and Warren explain why they'll give away 99% of their wealth someday. As two of the world's most successful business people, what role do you see for yourselves in giving back to your communities? And how do you use your influence to get others to give back as well? Buffett. We both have a similar philosophy on that. I know in my own case that 99% plus will go back to society, just because we've been treated extraordinarily well by society. I'm lucky. I don't run very fast, but I'm wired in a particular way that I thrive in a big capitalist economy with a lot of action. I'm not adapted for football. I'm not adapted for violin playing. I happen to be in something that pays off huge in this society. As Bill says, if I had been born some time ago, I would have been some animal's lunch. I do not believe in the divine right of the womb. Frankly, I don't think it's right that the quarterback of the Nebraska football team next year should be the eldest son of the quarterback of the Nebraska football team of 22 years ago. Nor do I think that our Olympic team in 2000 should be chosen from the same family that was on the Olympic team in the various respective sports in 1976. We believe in a meritocracy when it comes to athletics and all sorts of things. Now, why not have a meritocracy in terms of what you go out into the world with in terms of the productive goods? Let the resources flow to those who use them best. And then I believe they should give them back to society when they get through. Gates. That's a great philosophy, not to mention that passing along a lot of money can be bad for the people who receive it. Buffett. You better not put it to a vote. How do you use your role as successful businessmen in influencing others, even those who are not as successful, to give back? Buffett. Let me suggest another way to think about this. Let's say that it was 24 hours before you were born, and a genie appeared and said, "You look like a winner. I have enormous confidence in you, and what I'm going to do is let you set the rules of the society into which you will be born. You can set the economic rules and the social rules, and whatever rules you set will apply during your lifetime and your children's lifetimes." And you'll say, "Well, that's nice, but what's the catch?" And the genie says, "Here's the catch. You don't know if you're going to be born rich or poor, white or black, male or female, able-bodied or infirm, intelligent or retarded. So all you know is that you're going to get one ball out of a barrel with, say, 5.8 billion balls in it. You're going to participate in what I call the ovarian lottery. It's the most important thing that will happen to you in your life, but you have no control over it. It's going to determine far more than your grades at school or anything else that happens to you. Now, what rules do you want to have? I'm not going to tell you the rules, and nobody will tell you. You have to make them up for yourself. But they will affect how you think about what you do in your will and things of that sort. That's because you're going to want to have a system that turns out more and more goods and services. You've got a great quantity of people out there, and you want them to live pretty well, and you want your kids to live better than you did, and you want your grandchildren to live better than your kids. You're going to want a system that keeps Bill Gates and Andy Grove and Jack Welch working long, long after they don't need to work. You're going to want the most able people working more than 12 hours a day. So you've got to have a system that gives them an incentive to turn out the goods and services. But you're also going to want a system that takes care of the bad balls, the ones that aren't lucky. If you have a system that is turning out enough goods and services, you can take care of them. You don't want people worrying about being sick in their old age or fearful about going home at night. You want a system where people are free of fear to some extent. So you'll try to design something, assuming you have the goods and services, to solve that sort of thing. You'll want equality of opportunity, namely a good public school system, to make you feel that every piece of talent out there will get the same shot at contributing. And your tax system will follow from your reasoning on that. And what you do with the money you make is another thing to think about. As you work through that, everybody comes up with something a little different. I just suggest you play that little game. How do you see yourselves as leaders in facets of human experience other than business? Gates. You have to be careful if you're good at something to make sure you don't think you're good at other things that you aren't necessarily so good at. I come in every day and work with a great team of people who are trying to figure out how to make good software, listening to the feedback and doing the research. And it's very typical that because I've been very successful at that, people come in and expect that I have wisdom about topics that I don't. I do think there are some ways that we've run the company, the way we've hired people and created an environment and used stock options, that would be good lessons for other businesses as well. But I always want to be careful not to suggest that we've found the solutions to all problems. Buffett. You can learn a lot by studying Microsoft and Bill, and you can learn the most by studying what it is he does year after year. But if he devoted 5% or 10% to what he's doing now, and then spread the remainder of his attention over a bunch of other things, well, society would be worse off, in my view. Bill's right. Occasionally there are things, like campaign finance reform, that he may want to take a position on. But you still don't want to say that the whole world ought to follow you on it. I'm very suspect of the person who is very good at one business. It also could be a good athlete or a good entertainer who starts thinking they should tell the world how to behave on everything. For us to think that just because we made a lot of money, we're going to be better at giving advice on every subject, well, that's just crazy.
Editor's note. Having fielded their last question, the two billionaires briefly acknowledged the applause and bolted off the stage. leaving behind an audience that clearly would have relished another 2 hours of them. But no, they had a bridge game to play. C.L. A House Built on Sand, October 26, 1998, by Carol Loomis. Of all the feats that Bill Gates has pulled off, one of the most remarkable is having persuaded Warren Buffett to go on vacations. Since Buffett regards his office in Omaha as the most pleasurable place to be in the world, being anywhere else does not intuitively appeal to him. Even so, Bill and Melinda Gates got him and his first wife, the late Susie Buffett, to come along for 2 weeks in China in 1996 and nearly 2 weeks in Alaska and U.S. Western parks in 1998. Unfortunately for Buffett, his August departure for Alaska that year coincided with his decision just hours before to try to buy the huge, trouble-fraught trading portfolio held by the collapsing hedge fund Long-Term Capital Management, LTCM. This story chronicles how that firm, under John Meriwether, floundered and how Buffett, operating at times from the fjords of Alaska, did not succeed in doing the deal. Instead, a consortium of 14 banks reluctantly put up $3.6 billion to keep LTCM afloat because they feared that the firm's bankruptcy would lead to unbearable losses in their own trading positions. An oversight group established by the banks set about unwinding LTCM's huge 60,000 positions, working, ironically, with Meriwether and partners, who had insistently negotiated a place for themselves in the picture. By the end of 1999, the oversight group managed to return the $3.6 billion put up by the banks, and in 2000, LTCM was liquidated. Just how the deal would have worked out for Buffett, had he instead bought that portfolio of 60,000 positions, is unknowable because there is no way of telling how his bidding group, which included Goldman Sachs, would have fared in dismantling the portfolio. Asked recently to reflect on his LTCM experience, Buffett says it still astounds him that the firm's managers, celebrated for their brilliance, let themselves get into a position in which they could lose all their money. Behavior of that kind is not socially acceptable at Berkshire, where there is a counter-reminder. You only need to get rich once. Apparently, having never quite absorbed that message, Meriwether has since the LTCM debacle been working, none too successfully, on a second effort to get rich, in the same business yet. In 1999, he started hedge fund JWM Partners, which made money for years, grew to about $3 billion in size, and then suffered huge losses in the credit crisis. The fund liquidated in 2008. The following year, Meriwether opened JM Advisors Management, whose investment record has not been publicly disclosed. C.L. It is a curiosity of the long-term capital debacle that, although it has been endlessly and ably explained in the newspapers, it remains a mystery to many readers. Indeed, the affair has so many facets and is so complicated that it almost confounds complete understanding. For that reason, Fortune does not claim that this story will tell you all you need to know about long-term capital or give more than a glimpse of all that is surely yet to unfold. But we do know we understand, to an extent that no other publication can, the role played in this affair by noted investor Warren Buffett, who is a longtime friend of this writer. Buffett's role in this saga was important, dramatic, and not without humor, coming to a climax in 4 particular September days. Moreover, his role is possibly not ended. The outlines of what happened to long-term capital in September are among the few clarities of this affair. For most of the month, the huge hedge fund, hung on the edge of bankruptcy and was finally saved only by a $3.6 billion infusion from a consortium of 14 banks and brokerage firms, all creditors who feared what the bankruptcy of a fund that owed upwards of $100 billion would do to their finances. Very much in the act, also, was the Federal Reserve Bank of New York, which wished to avert the domino effects that a fast liquidation of the fund's holdings might have exerted on an already reeling global securities market. So the New York Fed played godfather to the rescue deal, bringing the creditors together at its own offices and overseeing their negotiations. In the center of this affair, always, was the hedge fund's founder and principal manager, former Salomon Brothers whiz John Meriwether. Meriwether had surrounded himself with brilliant colleagues, many of them PhDs in mathematics and finance, and put them to work devising computer-driven trading strategies that were supposedly bulletproof. In the Greenwich, Connecticut office of the hedge fund's management firm, Long-Term Capital Management, there may be more IQ points per square foot than in any other institution extant. There are certainly more Nobel Prize winners per square foot. LTCM has two, Myron Scholes and Robert Merton, who less than a year ago went jubilantly to Sweden to receive the world's highest accolade for achievement in economics. The disaster that befell this brain trust recalls the first line of Allen Ginsberg's beatnik poem, Howl. I saw the best minds of my generation destroyed by madness. At LTCM, the best minds were destroyed by the oldest and most famously addictive drug in finance, leverage. Had the fund not grievously overextended itself, it might still be trucking along, doing its thing, working those brain cells. But now, its strategists have swapped their laurels for the booby prize of the financial markets, which is the ignominy of being largely wiped out and viewed as bumbling losers. All of which raises the question of why Warren Buffett would want to pick up this particular piece of roadkill. And yet he made a stab at doing exactly that. His move came on Wednesday, September 23rd. It interrupted days of meetings that the New York Fed had been holding with the banks and brokerage firms that long-term capital owed huge amounts of money to, which were being asked, in their own self-interest, to put up new money to stave off the fund's bankruptcy. The participants were an extraordinarily powerful group. Every bank and firm that attended had sent its CEO or another top honcho, and the atmosphere was contentious. None of the members really wanted to ante up the money, and yet they dreaded a bankruptcy. As the creditors' group was about to reconvene on this Wednesday morning, William McDonough, president of the New York Fed, learned from Goldman Sachs, itself one of long-term capital's creditors, that it had an alternative financing proposition to present. McDonough recessed the meeting and listened to Goldman make the case for a bid, headed by Buffett's Berkshire Hathaway, to take over the fund. The terms were complicated. More on that later. But essentially, the Buffett Group proposed to put up $4 billion and make itself the manager of long-term capital. Of the $4 billion, $3 billion was to come from Berkshire, $700 million from insurer American International Group, and $300 million from Goldman Sachs. This bid then went to Meriwether, and that's when it began to die. There is disagreement as to why. Buffett believes that the deal did not happen because Meriwether and the other LTCM principals simply did not want to accept his terms, which would have left LTCM's principals with little money and no jobs. For their part, Meriwether and other LTCM partners told McDonough that the Buffett bid was structurally flawed and therefore not feasible. Buying that argument, McDonough reconvened the meeting and told the creditors, in effect, that they were back to being the only game in town. One of the CEOs there told Fortune recently that McDonough explained that the other deal was not going to happen because it had structural problems. Grudgingly, the CEOs went back to negotiating their rescue plan, with each participant ultimately putting up very big money, $100 million to $350 million. Suppose, Fortune asked that same CEO, that McDonough had said the deal would not happen because long-term capital did not like its terms. I think, answered the CEO, that I would probably have told Merriweather to go screw himself. Of course, he adds, negotiations might then have turned into a game of chicken. Perhaps Merriweather would have countered that he preferred bankruptcy to Buffett. Then the creditors would be back to the question of whether they could stand bankruptcy. Squawk, squawk. Which side flinches first? To understand how both long-term capital and the creditors, and the Fed, to boot, got themselves into this amazing bind, and why Buffett volunteered to step into apparent chaos, it is necessary to look at the character of this hedge fund and its boss, John Merriweather. Until August 1991, Merriweather, now 51, was a vice chairman of Salomon, with responsibility for fixed income trading and also proprietary trading, which is a firm's investment of its own money. Merriweather was a huge moneymaker for the firm and was liked and admired to the point of reverence by the people who worked for him. Quote, British Guiana actually comes to mind, said a former Salomon Brothers executive recently. John had a kind of cult-like following. Then came Salomon's treasury bond scandal, precipitated by Paul Moser, one of Merriweather's senior people. In the chain of disclosure, Moser admitted to Merriweather in April 1991 that he had falsified bids for Treasury securities. Merriweather immediately went to his bosses, John Gutfreund and Thomas Strauss, with the news everybody concluded that the Fed must be told, and then nobody did the telling. When the scandal finally erupted in August, Moser was fired, and Gutfreund and Strauss resigned under pressure. To the rescue came Buffett, head of Salomon's biggest shareholder, Berkshire. In the first 2 days of Buffett's regime as chairman of Salomon, Merriweather's fate was uncertain. Many of Salomon's managing partners had turned against him and wanted him out. But Buffett was not sure that it was fair to fire Merriweather, since he had acted responsibly in immediately disclosing Moser's sins to the firm's bosses. In the end, Merriweather himself made the decision to resign, telling Buffett that he thought it was the best thing for the firm. Gradually, a number of men who had worked for Merriweather left Salomon to join him in business. The specifics about what they were to do surfaced in 1993, when Merriweather announced plans to start a hedge fund called Long-Term Capital. Actually, long-term capital is made up of a variety of investment vehicles, some partnerships, some corporations, some domiciled in the U.S., some in the Cayman Islands. Why the Caymans? So that offshore investors, as well as certain kinds of U.S. investors, can avoid U.S. income taxes. A point that grates, of course, when we recall that the Fed was scrambling around in September on the fund's behalf. However, all of these instruments feed their money into a master fund called Long-Term Capital Portfolio LP, a Cayman partnership. It is this fund that has taken the positions that its investment managers, Merriweather and crew, dictated. From its beginning, the fund was distinctive in that its managers proposed to carry out trading strategies that would take time, 6 months to 2 years or more, to deliver profits. For that reason, LTCM ruled that it would not allow investors in the fund to withdraw their money quarterly or annually, which are the common practices of hedge funds, but would instead lock up their money until the end of 1997. As for the strategies, the fund's managers proposed to make relatively few trades that carried directional risk and instead to concentrate on capturing small profits from carefully hedged positions, particularly in the fixed income markets. A couple of illustrations will illuminate some distinctions in risk which are important in this tale. Imagine that an individual investor decided to buy the stock of Cendant on the theory that it was headed up. That would be a directional trade or a position risk. Assuming the investor didn't buy on margin, the percentage gain or loss on each dollar at risk would be exactly equal to the percentage rise or fall in Cendant stock. Long-term capital's main strategy, in contrast, was to make hedged trades that it thought would succeed regardless of the general trend of the markets. The fund put its financial technology and brains to work, for example, at identifying sectors of the market in which yields had gotten out of line with yields in related sectors. It would then buy one of the securities and short the other. A trade of this type can deliver a profit regardless of whether interest rates in general go up or down or stay flat. All that matters is that the two yields eventually converge. In this kind of trading, the fund never expected to earn a large return on each dollar at risk. An investor in long-term capital recalls talking by phone to some of its top managers in 1996 and asking them just how much they were annually realizing per dollar. The answer was 67 basis points, or 0.67 of a cent. Returns like that were never going to make investors happy unless the invested capital could be greatly enlarged, and that's where the leverage came in. Confident that its position was very low, the fund took on a colossal amount of what's called balance sheet risk, piling a huge slab of debt on top of its relative sliver of capital. At the moment in 1996, when that investor was getting his answer of 67 basis points, the fund had a ratio of $30 in balance sheet debt for every dollar in capital. Leveraged 30-to-1, a 0.67% return on each dollar at risk produces a healthy 20% return on capital. Leverage that steep sounds terrifying. And eventually, it was. But LTCM always maintained that its financial technologies and its meticulously constructed hedges gave the fund a conservative risk profile. In October 1994, LTCM spelled out this proposition in a paper sent to its investors. In the paper was a table that delineated a range of returns that the fund might aim for in a year and pair them with the probabilities of loss if things went bad. For example, the table said that if the fund were shooting for a 25% return, which was indeed a typical goal for the operation, the probability that it actually would end up losing 20% or more was an insignificant 1 in 100. The table never even contemplated a steeper loss. That would all be funny if it weren't tragic. In the first 8 months of 1998, the fund lost nearly 50% of its capital, and in September it hemorrhaged still more, with the loss going to around 90%. What this tells you, says Warren Buffett, is that underneath the mathematical elegance, underneath all those betas and sigmas, there is quicksand. At least one of long-term capital's investors was troubled by the same thought. The investor who told about the fund's 67 base point return wrote himself 2 notes for the file after that conversation. He recently showed them to Fortune. One note said, quote, Are they no different from any Wall Street firm, Baer or Solomon or Goldman? It's the proprietary desks, without the people, overhead, or agency business. The second note leaned on a Yiddish word, kishka, which figuratively means gut instincts. Said the note, there is no kishka override over the portfolio. One gets a Nobel Prize-winning computer system. Will that collapse one day? Would one prefer a person with kishkas at the control? From the looks of the fund's vitality in its first 4 years, from the late winter of 1994 until the spring of 1998, not many investors were worrying about kishkas. The structure of long-term capital calls for its investors to pay the management company unusually steep fees. First, an annual 2% on the capital that an investor has in the fund, and second, 25% of profits earned. Even so, the fund's investors earned 20% in the 10 months of 1994 that it was in operation, 43% in 1995, 41% in 1996, and 17% in 1997. Furthermore, monthly performance figures showed that the fund was having a smooth ride, experiencing very little volatility in its results. Like a siren song, these facts brought in a flood of new money. That was true even though the fund's managers kept a tight veil of secrecy over their specific trading strategies, leaving their investors with little clue as to just how the fund was making its profits. By the fall of 1997, the combination of contributions and reinvested earnings had raised the capital of the fund to around $7 billion. At that point, things took an unexpected turn. LTCM itself concluded that the fund had too much capital for the investment opportunities open to it and forced many of its investors, notably those who had come in late, to withdraw their money. Many of those expelled went kicking and screaming, and at least one protested so angrily that LTCM allowed him to stay on board. The anger arose in part because LTCM's principals and other insiders were allowed to maintain their full stakes in the fund. In other words, maybe attractive investments weren't so scarce after all. When the smoke had cleared, at the end of 1997, the fund had $4.7 billion in capital, of which about $1.5 billion belonged to insiders. At that time, the fund also had about $125 billion in debt, which means that its balance sheet leverage ratio was about 25-1. But that far understates the true exposure, since the fund has always aggressively entered into off-balance sheet derivatives contracts that by their nature create additional leverage. Only an insider would know, at any point, what the derivatives exposure amounted to. But be assured that if the balance sheet leverage at year-end 1997 was 25-1, the overall leverage was greater. In a sense, all this debt owed its existence to another kind of near-cult following that Merriweather had acquired. This one made up of banks and brokerage firms enamored with the prospect of lending to him. Creditors love customers who are big, active, and solid, and that was precisely the image that long-term capital projected. Most of the fund's creditors do not appear to have looked critically at its leverage. In fact, many were accommodating in granting favorable terms on loans, the waiving of collateral, for example. Many also happily entered into derivatives contracts with the fund, increasing their total exposure to what, unknown to them, was about to become a train wreck. This year of the wreck, 1998, began calmly enough. But in May, volatile markets cost the fund a 6% loss, and in June, another 10%. Those lashes of the whip, unheard of in the fund's history, were enough to make Merriweather shoot off a special letter to his investors. It said that LTCM was, quote, understandably disappointed with the May and June results, but nevertheless believed that, quote, the future expected returns for the fund's investment strategies are good. In July, the fund was essentially flat. And then came August. Terrible, terrible August. Russia devalued its currency, and the world's investors fled to quality. That was not what LTCM had been banking on in several different trading strategies. For example, it had at some point done paired trades that, in essence, bet on a narrowing of the spread between the yields of AA-rated corporate bonds and comparable U.S. Treasuries. The bet looked good because the spread was relatively wide compared with its historical levels. But when the flight to quality began, Treasury yields plunged, and the gap between government and corporate yields dramatically and incredibly widened still more. The outcome was disastrous. The fund lost 40% of its capital in August alone, leaving it with just $2.5 billion. Astoundingly, it was still carrying about $100 billion in debt. Around this time, the fund's principals and at least some creditors got really nervous. Stuffing their pride into the closet for the moment, the LTCM crew went on a search for investors who might buy out some of their trading positions or, alternatively, put fresh capital into the fund, thereby giving it a stronger base. The team solicited, among others, certain investors who'd been pushed out of the firm in 1997, as well as the hedge fund moguls George Soros and Julian Robertson. All said no. On the night of Sunday, August 23rd, LTCM opened the Omaha front. The man assigned to call Buffett was Eric Rosenfeld, an LTCM principal and one-time Salomon trader who had earned Buffett's regard by loyally helping Salomon climb out of its hole after the 1991 crisis. Rosenfeld, 45, is normally laid back, but on this occasion, Buffett says there was a sense of urgency in Rosenfeld's offer to sell him some of the fund's large equity arbitrage positions. Buffett said no. By Wednesday, Rosenfeld was back on the phone, joined this time by Merriweather. Could Buffett meet the following morning in Omaha with still another LTCM principal, Lawrence Hillebrand? At the meeting, Hillebrand, 39, also a former Salomon trader, well regarded by Buffett, presented a rough, though still guarded, picture of the long-term capital's portfolio and urged Buffett to become a large investor in the fund. Hillebrand also pinpointed a reason for hurry. When August ended a few days later, the fund was going to have to tell its investors and lenders how much it had lost for the month, and would be pleased to tell them also that it had secured financing arrangements that would ease the fund's leverage. Sorry, said Buffett politely, but he simply had no interest. Later, Buffett talked to Berkshire's vice chairman, Charles Munger, and remembers telling him that though the fund's positions might have been logical, he had no desire to make Berkshire a hedge fund investor. He also pointed out the absurdity of, quote, 10 or 15 guys with an average IQ of maybe 170 getting themselves into a position where they can lose all their money. After that, Buffett did not again think much about long-term capital until late Friday afternoon, September 18, when he returned a call from Goldman Sachs partner he knew, Peter Krause. Krause said that long-term capital's net assets, its capital, had sunk to $1.5 billion, and that Goldman was calling around looking for people who might want to become big investors in the fund. No interest, Buffett said once again. But the two men then bounced around other ideas relating to long-term capital. Finally, Buffett got to focusing on the very big picture thought that Berkshire and Goldman might jointly bid for the entire fund, chuck the Merriweather management, and take on the fund's management themselves. The concept, says Buffett today, was to patiently stick with most of the fund's positions and gradually liquidate at what Buffett thought could be a decent profit. It was a major idea, of a size suitable for Berkshire's billions in available cash, but it could not have come at a worse time. Buffett was trying to leave his office to get to a granddaughter's birthday party. That night he was scheduled to fly to Seattle to join a Bill Gates group that was going to spend nearly 2 weeks touring Alaska and a galaxy of western parks. It was a highly uncharacteristic move. Buffett ordinarily had no interest in scenery of any kind, but his close friendship with Gates had lured him and his wife, Susan, into signing on for the trip. If a bid was to be made, then Buffett would have to work it out with Krause over the phone from the wild. And that's how it happened, although not without moments of exquisite frustration. Suffice it to say that not even a mega-billionaire can establish and keep a phone connection from the canyon-like depths of an Alaskan fjord. Nevertheless, the $4 billion bid took shape over 4 hectic days, with Goldman declining to be more than a $300 million partner with AIG, at Buffett's suggestion, asked in. That invitation occurred because Buffett has had good relations with AIG's chairman Maurice Hank Greenberg, and thought this gesture might further cement them. Another facet of the deal called for Goldman to be the fund's administrator once the property was in the bidding group's hands. It is essential to understand what the group proposed to buy and at what price. It wanted to own the fund's entire portfolio, and to accomplish that, it wished to purchase the master fund, Long-Term Capital Portfolio LP. This is the fund that had $1.5 billion of capital on Friday, September 18th. By the following Wednesday, though, when the Buffett bid was made, the fund's net assets were maybe in the range of $600 million. Nobody knew for sure. In any case, Buffett, never a man to overpay, wanted to buy the fund at a discount, and his bid was $250 million. Had it been accepted, the sum would have gone to the fund's old investors, Merriweather's management team included, and would have tactically said that a fund worth $4.7 billion at the start of 1998 had sunk in value to about a 20th of that. Once the $250 million was paid over, the Buffett Group would have immediately put up an additional $3.75 billion, which would have restored capital adequacy to the fund. Think a bit more about the $250 million. Once it went on the table, it would become the figure that Merriweather, given time, would quite understandably try to shop, looking for more dollars. Also, when you are talking a $4 billion proposition and the markets are turbulent, it is not good to let a bid sit around and go stale. So Buffett put a tight time limit on his offer. The bid was faxed to Merriweather at 11:40 on Wednesday morning, and he was advised it would expire within an hour at 12:30. Meanwhile, McDonough and the creditors' group had already been trying for days to assemble its rescue plan and were meeting again that day. So even before the bid was faxed to Merriweather that morning, Goldman briefed McDonough on the deal, and McDonough called Buffett, now at a Montana ranch, to confirm the offer. Buffett says that McDonough seemed elated at the sudden appearance of an alternative plan to the one he'd been nursing with the creditors. Buffett then called Merriweather and told him a bid was on its way. Buffett made it clear that his group wanted to buy Long-Term Capital Portfolio in its entirety. Merriweather was non-committal. But when the call ended, Merriweather went into action, fast. After a quick conversation with LTCM's in-house lawyer, he got on the phone to McDonough and told him that Buffett's bid wouldn't work because Merriweather did not have the authority to sell. Merriweather is a general partner of the so-called portfolio company, but it also has other partners, and Merriweather contended he would have to seek the vote of each one before agreeing to sell. And obviously, he said, that could not be done before 12:30. Backing Merriweather up in the conversation was another LTCM principal and a former colleague of McDonough's, David Mullins, who was vice chairman of the Federal Reserve Board until he joined LTCM in 1994. Buffett's group had not gone into its bid without its own legal opinion. Studying the long-term capital documents available, incomplete though they were, the group's lawyers concluded that the bid was workable from Merriweather's side. Besides, everyone on the Buffett side believed that if Merriweather really had any interest in the bid, he could tentatively accept it and then tangle with the complications later. But Merriweather displayed absolutely no interest when he spoke to McDonough. The Fed president concluded that he could not dismiss Merriweather's legal argument or, for that matter, stretch his authority as a central banker to force Merriweather to sell. Resignedly, McDonough returned to his surly band of creditors and flogged along their $3.6 billion rescue plan. How do Merriweather and the fund's other investors fare under that scheme? Part of the answer is they keep whatever shrunken capital they still have in the fund, which totaled something around $400 million in late September. That is the correct figure to compare with Buffett's $250 million, though it is worth mentioning that Buffett was to hand over cash, whereas the $400 million remains tied up in the fund. As for Merriweather and the LTCM crew, they still run the fund, though the creditors have roughly halved their fees. The creditors have also put 6 of their people in LTCM's offices with instructions to liquidate the fund as fast as it can be sensibly done. Finishing within a year would be splendid, says one senior Wall Streeter. There is, of course, another scenario. A prompt move by the creditors to find a bidder. A Buffett, say, who would step up and take this mess off their hands immediately. Would Buffett do that? Who knows, since he never telegraphs his moves, but he is aware that certain creditors have been thinking about him. In any event, Buffett has returned from vacation, and he managed to catch C-SPAN's October 1st coverage of the House hearings on long-term capital. The vignette he liked best? Congressman James Leach's memory that his father had told him to avoid anyone doing business out of the Cayman Islands. That reminded Buffett of a favorite line that seems just about the perfect wrap-up for long-term capital. You never know who's swimming naked until the tide goes out.